Kindly watch this introduction video of mine before you directly proceed to the respective timestamp. Most important instructions I'm giving you so that you can get maximum output, maximum, benefit by watching this marathon. Very simple. The first and foremost instruction. In the marathon, we have used materials, right? Like some material we have used. That material is available at free of cost in PDF format in our website, sreshtafacma.com. Just open our website. Inside there, something called free resources is there. Inside that, you just have to select a CMA Inter option. Then you will find all the subjects. That is first important thing. Second, now these marathons are being handled by our Sreshta team. I think many of you, whoever is watching this revision class, are well aware of our faculty team. The law is being handled by Subramaniam sir. And financial accounting, P6 and P10 is being handled by Sai Babu sir. Remember, for all the 8 subjects, we are uploading marathon. Not just for 1 or 2 subjects, for all the 8 subjects of CMA Inter, under one roof, that is under Sreshta for CMA, you are going to get revision classes, access. Then P6 and P10A, accounting, both the accounting in group 1 and group 2 are being handled by Sai Babu sir. P7A, income tax, my classes will be there. Whatever my CA Inter revision class is there, part 1 and part 2, the same revision class you can use for CMA Inter for December as well. Then GST is handled by Pawan sir. P8, cost accounting. P12, management accounting. Both are costing related. Is handled by Ganesh Bharadwaj sir. Then P9A, O&M, operations management is again handled by Subramaniam sir. P9B, strategic management. P10B, auditing. P11B, analytics. All the 3 papers revision classes are being handled by Harish Krishnan sir. P11A, financial management again by Funny sir. So these are the subjects and the faculties who are handling it. So I just want to give you an information about what subjects we are uploading for marathon. Coming to income tax, like I don't know whether you're going here, whether you're a group 1 student or group 2 student, I just want to give one clarification. For December 24 attempt, there are no separate amendments for any subject, including tax. Even for income tax, whatever amendments that are there for June attempt, the same amendments will be applicable for December. You need not even think about amendments. Just to watch the marathon we uploaded. Whatever marathon I have uploaded for recently September attempt of CA Inter, the same marathon you can use it for, December attempt of CM Inter, because the same is applicable for even CA Inter January 25 attempt. So you can use absolutely the same. And the respective material you can find in the, as I already told, in our free resources in the website, you can find under CM Inter option the respective materials. And third important thing, we have given for all the subjects 3/4 preparation strategy. What is 3/4 preparation strategy? In every subject, we identify 1/4 of the chapters, nothing but, suppose if financial accounting is there, in that let us assume 12 chapters are there. We will identify 3 to 4 chapters that occupy 25 to 30 marks of the weightage in the exam. 25 to 30 or some worst case 35 marks. From these chapters, worst case 25 to 30 or 35 marks is what going to come in the exam. You have to leave it. These chapters you should ignore it completely. Sir, what does it mean? Remaining chapters you have to be 100% pakka. This is called 3/4 preparation strategy. Like many students are asking, sir, we are unable to complete syllabus in time in the exam. So can you suggest us some important questions in each and every chapter? I tell them that is a very risky strategy. Choosing important questions in every chapter is a risky strategy. Don't do it. If you don't have time, take some 3 or 4 chapters in every subject which occupy 30 to 35 marks weightage. Keep them aside. Remaining chapters, 100% you should prepare. By doing so, no matter how tough the paper, let it come, no matter how tough the paper it might be in the CMA Inter. It may be like in every chapter they might be asking C category questions. Let us assume, you need not worry because 75 to 85 marks worth of syllabus you studied 100%. So you can handle any level of paper even with limited preparation. Like you ignored 1/4 syllabus straight away. So that is what 3/4 preparation strategy is all about. Regarding that, in each subject, in paper 5, law and ethics, what are the 1/4 chapters that you can keep them as a last priority? In financial accounting, what chapters are last priority? In income tax and GST, what are last priority? For every subject in group 1 and group 2, we have identified what are the chapters that you can absolutely ignore without any second thought. Or you don't want to ignore, keep them as a last priority. First finish, suppose you might be group 1 or you might be group 2. First finish each and every subject, 3/4 chapters, 3/4 chapters, 3/4. Like take P5, all first priority chapters as per our PDF, finish it off. P6, all first priority, finish it off. P7, all first priority, finish it off. P8, P9, P10, P11, P12, finish all the first priority. Whatever you are targeting for the coming December exam. After finishing that, you still have time. Then do focus on the remaining chapters which you originally ignored. This is called 3/4 preparation strategy. Now, one more important advice. You please focus single group only for the coming December, especially if at all you are a repeater. Means you gave an attempt in June or that before attempt, but you failed. I request you to focus only single group for the December. And by the way, what should be your preparation strategy for December attempt? I have already uploaded a video on preparation strategy in the same YouTube channel. Go to that YouTube channel. So, you go to that particular video, you will understand how to plan your preparation for the coming December. And not just that, we even gave timetable for CMA inter students who are planning to write single group for the December exam. If at all you do not have any control on your preparation process, all that, daily 7 to 8 hours of study timetable we have already given. Actually, there's a timetable which we give for our subscription course students who are watching classes. The same timetable you can use for preparing the subject also. It is like a study timetable as well as it is a timetable for watching our classes. Actually, the timetable is made for watching our classes. Every day, what subject, which class you need to watch for how many hours. Instead of watching class, if at all you want to prepare on your own, instead of watching class, you study that particular chapter, that particular subject. So, timetable is also provided. The timetable also you can find in the same website, restofuscsema.com. Under, free resources, you can find the timetable as well. So that's it. I just want to give some, these instructions. Make use of this marathon carefully. And by the way, do not watch at higher playback speed. Kindly watch at standard speed. Do not rush up. You have enough time. Getting it? Plan your preparation carefully. That's it. Continue watching the marathon class and do very well. All the very best. And please do comment below. How is this marathon session? Getting it? Your suggestions, your appreciation definitely motivates us a lot. So kindly do comment how do you felt after listening to our marathon sessions. So that's it. Thank you. All the very best.
Hello CMA students. In this lecture, I will revise paper 5 business laws and ethics. In paper 5, we are having 4 sections. Section A, commercial laws with weightage 30 marks. Section B, industrial laws with weightage 15 marks. Section C, corporate laws with weightage 40 marks. And section D, business ethics with weightage 15 marks. First, I will start revision with corporate laws as it is having the highest weightage in the entire paper. Coming to the corporate laws, the syllabus is section 1 to section 122 and directors, accounts, auditors, topics, basics. So total we are having 9 chapters under corporate laws. The word corporate and company both are not same. Corporate includes company. Corporate includes company, a limited liability partnership, companies incorporated outside India, foreign companies, foreign LLP, etc. So that's why corporate is wider than company. Coming to company, company means company incorporated under Companies Act 2013 or previous company law. Are you all getting my point, students? Next one, law is different, act is different. Law is different, act is different. Law includes act, rules, judgments, circulars, notifications. You all know how act comes into the picture. Once a bill is approved by both the houses of the parliament and president, then it becomes act. During implementation of act, central government is empowered to frame rules from time to time. And during implementation of act, any practical difficulties, interpretation related problems will be referred to court and court will give judgments by resolving the interpretation issues. Now act approved by the parliament and president, rules framed by the central government, judgments given by the court, all these put together we call it as law. Even when you are reading the law, you will read not only sections, you will also read rules and you will also read case laws. Clear? Now coming to our Act, Companies Act 2013, it is total 29 chapters, 470 sections and 7 schedules. And next one, definition of the company. Company means company incorporated under Companies Act 2013. Companies Act 2013 or previous company law. All the companies which are getting incorporated under Companies Act 2013, I call them as new companies. And companies incorporated under previous company laws, I call them as existing companies. Clear? So this act, Companies Act, is applicable not only to the new companies but also to the existing companies which were incorporated before 2013. Understood? Next one, section 1. Section 1 will give answers to the 3 questions. One is title of the act, Companies Act 2013. Extent, it is applicable to whole of India. That means Companies Act 2013 is applicable to all the companies which were incorporated in India. Next one, applicability. Companies Act is applicable to all new companies, existing companies, banking companies, insurance companies, generation and distribution of electricity companies, except inconsistent provisions. State Bank of India, it is a banking company, moreover it is a company. So to the State Bank of India, our Companies Act is applicable. To what extent our Companies Act is applicable, sir? To the extent of consistent provisions. If there is any inconsistency between Banking Regulation Act and Companies Act, then follow Banking Regulation Act. Next one, statutory companies, body corporates as may be notified from time to time. Next one, classes of companies, various kinds of companies. So this classification is based on various aspects. First aspect, members. On the basis of members, companies are classified into 2 types. Actually 2 types. So don't tell that 3 types. Only 2 types are there. One is public company and next one is private company. Sir, what is a public company? A company which is not a private company and which is having a paid up share capital as may be prescribed. So public company means it is a company other than private company with a paid up share capital minimum as may be prescribed. Central government will prescribe. So far, central government didn't prescribe any amount for public companies as well as private companies as minimum paid up share capital. Next one, any company which is subsidiary to public company, it is also a public company. In public company, we are having 2 points. One is a company which is not a private company and having a minimum paid up share capital as may be prescribed. It is a public company. Next one, any company, if it is a subsidiary to public company, then also it is a public company. For example, C Private Limited is there. In this, more than 50% of paid up share capital was held by A Limited. A Limited is a public company. A Limited is a public company. It is holding more than half of the paid up share capital of C Private Limited. Now C Private Limited becomes subsidiary company. Private limited company which is a subsidiary to public company, it is also treated as or deemed to be public company. Deemed to be public company. Are you all getting my point, students? Of course, when I read the definition of subsidiary company, I'll tell the exact definition of a subsidiary company. In subsidiary company, instead of using paid up share capital, we will use the word called voting power. And you all know voting power comes from equity share capital only. Yes or no? So that's why I used the word more than half of the paid up equity share capital. Understood? Next one, private company. So private company must have a share capital, minimum paid up share capital as may be prescribed, and its articles must contain 3 conditions. 3 conditions. Sir, what are those 3 conditions? First one, restriction on transfer of shares. See, transfer of shares is not prohibited. There is no ban on transfer of shares. Transfer of shares is allowed but subject to some restrictions. Sir, what are those restrictions? Yes, whenever you want to transfer shares, first you need to take consent of directors. And first you need to offer shares to the existing shareholders. If existing shareholders are not having intention to purchase shares from you, then board of directors will identify the persons and you need to sell shares to them only. Sir, at what price? Price fixed by the directors, certified by the company auditor. So transfer of shares is allowed subject to restrictions. Next one, limits number of members to 200. Maximum number of members in the private company is 200. And while counting this 200, you have to take certain precautions like, joint shareholders. If a share certificate is held by 2 or more persons, you have to consider them as only one. In register of members, there may be 10 members or 20 members. But if these 10 or 20 members are holding share certificate jointly, then all these 10 or 20 members shall be counted as one. Next one, employees who became members during employment period shall be excluded. They may be present employees or past employees who became members during the employment period shall be excluded. And last condition is prohibition on invitation to public to offer securities. See the word private company, privacy. So don't go with public. Don't go with public. If you want to offer securities to the existing members or offer securities to the identified persons, but don't go to public. Don't invite them to subscribe your securities. So if articles of association of a company is having these three conditions, then it is a private company. If someone asks you, how can you differentiate, how can you identify whether a company is a public company or private company? The answer is very simple. Open articles of association. In the articles of association, if you are able to find restricts, limits, prohibits, then it is a private company. If you can't find these three conditions, then it is a public company. Understood? Now, one more point already discussed with you. Sometimes a private company is also a public company. When, if a private company is a subsidiary to public company, then it is deemed to be public company. Understood? Next one. On the basis of control, companies are classified into three types. One is holding company, subsidiary company, and the last one is associate company. I forgot to tell you. So many students, what they think is, on the basis of members, companies are classified into three types: public, private, OPC. See, OPC is not a separate category company. It is not a separate category. It is a part of private company. Generally, private companies must have minimum 2 members. But to that rule, there is one exception. That exception is 1-person company. I hope I gave clarity to you. Next one, on the basis of control, companies classified into 3 categories: holding company, subsidiary company, associate company. Holding company, very simple. Any company, if it is having subsidiary company, then that company is known as holding company. Simple definition. But subsidiary company definition is different. Understood? Subsidiary company means, it's a company in which other company holds more than half of the voting power. How much? More than half of the voting power. Suppose 2 companies are there, A Limited, B Limited. B Limited is having a equity share capital of 1 lakh rupees. 1 lakh rupee. 10,000 shares into 10 rupees face value each. Okay. Now A Limited subscribed or A Limited acquired 5,001 shares of B Limited. In terms of percentage, it is more than 50%. Understood? As I told you, voting power comes from equity shares. If you hold more number of equity shares, you'll get more voting power. Less number of shares, you'll get less voting power. Everyone. So more than half of the voting power. If one company is able to control another company, and if that company is having more than half of the voting power, then the first one is a holding company and the second one is a subsidiary company. And this relationship, subsidiary relationship, will get not only through voting power but also in another way. That another way is control over composition of board of directors. Suppose B Limited is having a total 7 directors. How many? 7 directors. Out of 7, 4 directors can be removed, 4 directors can be appointed by A Limited. Suppose A Limited, if A Limited is having a power to appoint or remove 4 out of 7 directors, then also B Limited becomes subsidiary to company A Limited. Understood? And this control may be of 3 types: direct control, indirect control, partly direct and partly indirect. Example, A Limited is having 60% voting power in B Limited. A Limited is having 60% voting power in B Limited. Now B Limited is a direct subsidiary to A Limited. Next one, A Limited is having 60% voting power in B Limited, and B Limited is having a 55% voting power in C Limited. Now if you observe carefully, A is controlling B, B is controlling C. Indirectly, A can control C, not directly. So A will ask B to cast vote in this manner. Now B can control C. B is following the instructions of A and B is controlling the C. So indirectly, yes, C is controlled by A. This is indirect control. Next one, partly direct and partly indirect. A is having 60% voting power in B, and A is also having 40% voting power in C Limited. And B Limited is having a 20% voting power in C Limited. If you observe carefully, A Limited is controlling C Limited. How much? 40%. B Limited is also controlling C Limited. How much? 20%. And B is already subsidiary of A Limited. Now, directly 40%, indirectly 20%. Sir, indirectly 20% how? See, A can control B. B will listen to A and B will cast votes. B will exercise voting power in C Limited according to the instructions of A Limited. So, partly direct and partly indirect. Understood? Next one, coming to the number of layers. A company can have a subsidiaries maximum 2 layers. One layer and below another layer. See, a company can have thousands of subsidiary companies. There is no problem. But below the 1000 subsidiaries, it can have one more layer. So, maximum, 2 layers. A company can have, one subsidiary and below this another subsidiary. So, like this, 2 layers were permitted. 2 layers are permitted. And below that is permitted. Yes, that's what I am telling you. Everyone. Direct subsidiaries. Okay, let me tell you one more point. Suppose A Limited company is there. So it is having subsidiaries. So like this, there is no problem. It can have 1000, 2000, 5000 subsidiaries, no problem. But below that, one more is permitted. And beyond that is not permitted. Are you getting my point, students? Next one, associate company. It's a company in which other company is having a significant influence. If one company can exercise significant influence in another company, then that another company becomes associate company. Sir, significant influence, how can we measure, sir? Significant influence means control of at least 20% voting power. Control of at least 20% voting power. Suppose in this example, if A Limited is holding 2000 shares, how many shares? 2000 shares in B Limited, then B Limited becomes associate. B Limited becomes associate. And one more small point, at least 20% voting power, but it shall not exceed 50%. Maximum 50% voting power only. Why? If it exceeds 50% voting power, voting power, then it becomes subsidiary. It is not an associate. Significant influence means control of at least 20% voting power and maximum 50% voting power. Joint ventures are also comes under the definition of associate company. Clear? Next one, small company. So small company means it's a private company with paid up share capital maximum 4 crores and with a turnover maximum 40 crores. As per your institute material, the monetary limits are paid up share capital 2 crores, turnover is 20 crores. But recent limits are paid up share capital maximum 4 crores, turnover maximum 40 crores. Now coming to the category of company, holding company, subsidiary company, section 8 company, statutory company. All these 4 companies are excluded from the definition of small company. Holding company, suppose a private company is a holding company of another company and it is having a paid up share capital of 1 crore, turnover of 1 crore. Now can we call that holding private limited as a small company? No. These holding companies, subsidiary companies, section 8 companies, statutory companies, even though they satisfy these limits, they are not considered as small company. Small company means it's a private company with paid up share capital up to 4 crores and turnover up to 40 crores in the preceding financial year. Understood? And once if a small company, if a private limited company lost small company status, don't think that it will be lost forever. These limits you need to check every year. For example, 2023-24. For 2023-24, you need to check paid up share capital as on 31st March 2023 and turnover for the financial year 2022-23. Suppose at this point of time the turnover is 10 crores and paid up share capital is 1 crore. Now for 2023-24, this company is a small company. Next one, as on 31st March 2024, if you observe the financial position and financial performance of the company, the turnover is 50 crores, paid up share capital is 2 crores. Now for financial year 24-25, this is not a small company. Why? In the immediately preceding financial year, the turnover exceeded the limits. Next one, suppose on 31st March 2025, the position is turnover 25 crores, paid up share capital 2 crores. Now again, the next year, immediately next year, the turnover came within the limits, turnover is fallen within the limits and paid up share capital 2 crores. Now if you observe carefully, for the next financial year, that is 2025-26, this is a small company. This is a small company. That means, whether it is a small company or not, you need to check every year. If status is lost, don't think that it will be lost forever. You need to check status each and every year. Understood, everyone? And the next one is foreign company. Foreign company, it is a company incorporated outside India and having a place of business in India. So incorporation should happen outside India. Suppose if incorporation happens within the India, that means the company gets incorporated under Companies Act 2013. If a company is incorporated under Companies Act 2013, it is a domestic company, it is an Indian company, it is a company. So here foreign company means company incorporated outside India and having a place of business in India. Now coming to mode of business, they can carry business operations either in physical mode by establishing a branch office in India or through electronic mode. For example, Alibaba is a e-website, electronic website, online website where you can order products, you can purchase products, you can sell the products. Understood? So they are not having any physical place of business in India and they are carrying business operations in electronic mode in India. Now it is a foreign company. It is a foreign company. See, foreign company, domestic company, how they are different, sir? Domestic company, incorporation in India, place of business in India. Foreign company incorporated outside India, whereas place of business in India. Understood? And our Companies Act is also applicable to foreign companies. Not complete Companies Act, but there is a separate chapter that governs foreign company. Beginning itself I told you. Here, in this law, we are not only reading the provisions related to company. Here we will also read provisions related to body corporates, foreign companies. Next one. So with this, important topics of preliminary chapter completed. Important topics. I'm not revising all the topics. All the topics are not important for examination. If you have gone through a previous examination paper, 4 questions are getting tested in the corporate law. 4 questions are coming from corporate law. Each question 7 marks. So total how many marks? 28 marks. And in multiple choice questions, you can find some 10 questions, around 8 to 10 questions. Each question carried 2 marks. So some 16 to 20 marks, multiple choice questions. So with this, weightage will be 40, including choice, 48 marks. Including choice, total corporate law is having a weightage of 48 marks. Understood? So first one, meaning of company, definition of company, I told you. Characteristics, not that much important, and you all know. Even if question is asked on characteristics of company, just write headings and explain each and every point. Next one, classes of companies. Private company, I discussed with you. Public company, yes. One person company, I'll discuss with you one person company in the incorporation chapter, don't worry. Next one, small company, I discussed with you. As per your institute material, right now, turnover limit, 20 crores, paid up share capital limit is 2 crores. But as of now, the limits has been revised. So paid up share capital 4 crores, turnover 40 crores. Yes, a company limited by shares, company limited by guarantee. This is the classification based on the liability, not that much important. Next one, associate company, subsidiary company. Yes, chances of getting multiple choice question is there. That's why I revised this small concepts. As I told you, 8 to 10 multiple choice questions comes from this corporate laws, and 4 questions, each question 7 marks. I hope you have gone through the previous examination paper. The question paper pattern as per December 2023 examination is 100 marks. Out of 100, 30 marks objective, 15 multiple choice questions, each multiple choice question carries 2 marks. Next one, 70 marks descriptive. So here you will be given 7 questions. Out of 7, you need to attempt 5 questions. Each question carries 14 marks. So total how much? 14 into 5, 70 marks. In each and every question, you will find 2 sub questions. In each and every question, you will find 2 sub questions. And each and every question may be asked from 5 to 9 marks. The combination will be like this, 5 plus 9, 6 plus 8, 7 plus 7, 10 plus 4, like that. Okay. So from company law, only 4 questions were asked in the previous examination paper. In the previous examination paper, only 4 questions were asked. Each question 7 marks. So associate company, I discussed with you. In subsidiary company, yes, we are left with one point. In subsidiary company, shares held by a company in another company in a fiduciary capacity. See, fiduciary capacity means not legal capacity, not with a beneficial interest, but just as a legal representative. I'll tell you one example. See, company A limited is there and company B limited is there. So B limited is having a 10,000 equity shares. Out of this, A limited is holding 4,900 shares. So in terms of percentage, it is 49%. With 49% voting power, B limited becomes associate company to A limited. Understood? B limited becomes associate company to A limited. Next one, in A limited, managing director, out of his personal funds, out of his savings, he purchased 200 shares of B limited. How many shares? 200 shares of B limited. Subsequently, after a few days, managing director, got deceased. Before his death, he appointed A limited as a legal representative in taking care of his son, who is a 16 years old person. 16 years old, that means he's a minor. So until son gets age of majority, A limited, please act as a legal, please act as a guardian to my son. And you will be the legal representative. You will hold all the properties of my son until he attains the age of majority. Now, what happened? As a result, A limited, in addition to 4,900 shares, is also holding 200 shares of MD. But these 200 shares, they are holding not in personal capacity or not with beneficial interest. These 200 shares, A limited is holding on behalf of son of managing director. Yes or no? So that means, A limited is holding these 200 shares in fiduciary capacity. Now don't add 4,900 with 200, so that 5,100 shares, that means 51% control. Yes, now B limited is a subsidiary to A limited. This is a wrong interpretation. This is not permitted. Why? A limited will not hold these 200 shares permanently. At one point of time, A limited will transfer the shares to the son of managing director. Yes or no? And moreover, A limited is holding as a legal representative. Clear? Without any beneficial interest. Suppose if A limited purchase these 200 shares by giving sufficient amount to the son of managing director in future. Now A limited becomes holding company, B limited becomes subsidiary company. Understood? Everyone. Next one. So foreign government company, yes, government company. So in this government company, the limit is important. Limit is important from multiple choice question point of view. So government company means any company in which not less than 51% of paid up share capital is held by central government, state government or governments, partly by central government and partly by one or more state governments, and includes a company which is a subsidiary company of a government company. So subsidiary to the government company is also a government company. Understood? Suppose Indian Oil Corporation company is there. This is a real example, real situation. In this Indian Oil Corporation, the President of India, central government, central government company means don't think that shares will be in the name of central government. So many students think that government companies means shares are registered in the name of government. See, government is not a separate body. It is not having a perpetual succession. Every 5 years or whenever government loses majority of seats in the assembly or parliament, so government gets dissolved. Every 5 years elections will be conducted, and a new party or existing party will form the government. So government will not have a perpetual succession concept. It is not an independent body. Understood? And even Prime Minister is also not a permanent person. Prime Minister is also not a permanent person. So Prime Minister keep on changes. So in case of central government companies, shares are registered in the name of President of India, not in the name of President. Right now, who is our President, you all know. Not in the name of the person holding the designation of President, but shares are registered in the name of President of India. So now whoever is the President, now he can exercise voting rights with respect to those shares. Suppose today you can see one president. Tomorrow, imagine if I become President of India, that means shares are in my name, not in my name, in my position. In my position. So President of India will hold shares on behalf of central government. Coming to state governments, governor of the state will hold shares on behalf of state governments. Understood? See ma'am, if I am holding shares in my name, suppose not a president, ordinary person, I can transfer these shares as and when I need money. But in case of government companies, they need to introduce a bill, they need to take consent from the parliament or government, then only they can sell or they can transfer those shares. It is entirely a different concept. But I'm telling you, government companies means central government company means shares are registered in the name of President of India. State government companies means shares are registered in the name of governor of the state. Clear? Those positions are permanent. As per the constitution, these positions are permanent. People may change, people may keep on changing, but the point is governor in case of state government company, president in case of a central government company will hold shares. See, in IOCL, Indian Oil Corporation, 51.5% of paid up share capital was held by central government. Now IOC is a government company. And IOC, it is having a subsidiary. C Limited is a subsidiary to IOC. Now C Limited will also be treated as government company. C Limited is also treated as government company. Understood? Foreign company I discussed with you. So foreign company I told you chapter 22 section 380, 81, 82, section 379. So section 379 to 392 provisions. These sections are applicable to foreign companies, man. All these are special points. Just give one time reading. That's it. Enough. So next chapter is incorporation of company. Incorporation of company. Section 3 to section 22. In the beginning itself, I forgot to give a disclaimer. See, these revision lectures are not meant for first time readers. The students who have already completed one revision, for them this revision lecture is useful. Suppose you didn't read corporate law before and you started listening my revision class. Trust me, you will get nothing. At least you have completed one time revision before watching this revision lecture. So this is just a revision of the facts which is already known to you. You already read these chapters and it's just a confirmation. Yes, what is there in the section, what is there in the provision. That's it. Revision lecture is simply a confirmation of facts which you already studied. So detailed lectures, yes, I made a detailed lectures of all these 9 chapters almost 60 hours. But coming to the revision, it will be around 7 to 8 hours. So just reading this, listening to these revision lectures, you won't get any conceptual clarity. It is just a confirmation of the provisions which you already read. Understood? Okay, fine. So initially, at the beginning itself, I should give this disclaimer, but I forgot it. No problem. So our next chapter is incorporation of company. Section 3 to section 22. Preliminary chapter, you will find 2 sections, section 1 and section 2. Coming to the incorporation of company, you will find total 20 sections. In that first one is formation of company, section 3. Once you get an idea about formation of company, you will be given 3 options. First, if you want to incorporate a company, you will be given 3 options. What type of company you want? OPC, private company, public company. In OPC, minimum number of members is 1, maximum number of members is also 1. Private company, minimum 2, maximum 200. And I told you, while counting 200, joint shareholders. If 2 or more persons holding a share certificate jointly, those persons are counted as 1. And the employees who became members during employment period shall be excluded while counting 200. Clear? So private company minimum 2, maximum 200. Public company minimum 7, maximum unlimited. Next, coming to the directors. In case of OPC, minimum 1 director. Private companies, minimum 2 directors. Public company, minimum 3 directors. Maximum number of directors in all these companies is 15. So once you select one option, suppose you selected private company, then you will be given another 3 options, whether you want limited by shares or limited by guarantee or unlimited company. Limited by shares, the liability is limited to the extent of unpaid value. Unpaid value. In share, you will find face value. Face value minus paid up value is nothing but unpaid value. Unpaid value multiplied by number of shares held by you. This is your liability, limited liability. No joint and several liability. Joint and several liability means what? In case of winding up or in case of liquidation, If company assets are not in a position to meet its liabilities, then liquidator will call money. Liquidators will call money from all the members. If one member fails to pay money, and if liquidator is asking me to pay that money also, then my liability is joint and several liability. Joint and several liability you will find in partnership. One partner is liable not only for his share of loss, but also for the share of other partners' loss if they are unable to contribute money. Yes or no? So there is no concept of joint and several liability in company limited by shares, in company limited by guarantee. Understood? So in limited by guarantee, the liability is limited to the extent of guarantee. Yes, at the time of incorporation, each and every subscriber to the MOE, each and every member will fix a guarantee amount in the event of liquidation. If company assets are not sufficient, if company assets are not in a position to discharge the liabilities of the company, then we will contribute this much amount. So that is company limited by guarantee. Unlimited company, the liability of members is unlimited. That means if assets are not sufficient, if company assets are not sufficient to discharge company liabilities, then members have to bring money from their personal assets, and with that money liabilities will be discharged. Clear everyone? So that is section 3. Next one, section 3A, members liability jointly and severally. Sir, just now you told there is no concept of joint and several liability. Now you are telling there is a joint and several liability. Yes, there is a joint and several liability when you make violation of company set, when you violate section 3. See what section 3 is telling: private company at any point of time it should have 2 members. Public company it must have minimum 7 members at any point of time. See this condition, 2 members, 7 members, this condition should be satisfied not only at the time of incorporation but also subsequent to incorporation. Subsequent to incorporation you need to satisfy this condition. Suppose if this condition is violated, example, A limited company is there with 7 members. At one point of time what happened, out of 7, 2 members got deceased. Now how many active members are there, or how many alive members are there? 5. So what section 3 is telling? Public company must have minimum 7 members. Now A limited is having only how many members? 5 members. So in this situation, lawmaker is giving you time of 6 months. 6 months I am giving you. Within 6 months, increase that 5 to 7. That means, make a fresh allotment of securities, or make allotment of securities in the name of 2 new persons. So once the limit is increased within 6 months, there is no problem. Then there is no problem. Your liability is limited to the extent of unpaid value, or limited to the extent of guarantee amount. Suppose company failed to increase the number to 7, statutory limit. In that case, whatever debts or whatever transactions contracted by the company after 6 months from the date of reduction, suppose yes, this is the date of reduction, this is the event. From here onwards, I am giving you time period of 6 months to increase the limit. Failed to increase the limit within 6 months, whatever transactions, whatever debts contracted by the company subsequent to 6 months, company is not liable. Members, active members, and who know the fact that company is carrying business operations with reduced number of members, only those members will get joint and several liability. Not for all the transactions entered by the company, but for the transactions debts incurred after expiry of 6 months from the date of reduction. That means to these transactions, cognizant members, that means members who know the fact that company is carrying business operations with reduced number of members. Suppose out of 5, 2 people, they are working abroad, they are working outside India, they don't know about this reduction. Only 3 persons know that company is carrying business operations with reduced numbers. Now these 3 persons will get joint and several liability with respect to debts, transactions entered into by the company after expiry of 6 months from the date of reduction. Clear? Next one, incorporation of company. Section 7, incorporation of company. Section 4, section 5 I'll discuss with you, just wait. Section 4 is MOA, 5 is AOA. I'll discuss with you, just wait. See, the first step of incorporation of company is selection of the name and reservation of the name. As you all know, natural persons like me, like you, can be identified through face marks, thumb marks, and retina scanning. So using these things, yes, a person can be identified. Yes, even identification of moles also there. Okay, through identification of moles you can identify a person. But coming to the company, do you think company will have a physical appearance? physical appearance? Can you find company with a physical appearance? No. Company is an artificial person. It comes into the existence through operation of law. A registrar of companies is empowered. Registrar of companies is empowered to issue certificate of incorporation if he receives any application for incorporation of the company. Are you all getting my point, students? Everyone. So the name of the company should be unique. So company will be identified only through its name. So that's why the name should be unique. It should not be undesirable. That means it should not be identical with, or it should not be similar with the name of existing body corporates. Understood? And it should not contain the words which are undesirable in the opinion of central government. Suppose, can I incorporate a company with King Smugglers Private Limited, King's Al Qaeda Private Limited, promotion of smuggling activities and terrorism activities? No, these names are undesirable. Okay, so first you need to select the name and you need to reserve the name. Once name is reserved, then you need to prepare these documents and you need to file all these documents with ROC. First one, signed MOA and AOA. Signed MOA and AOA, Memorandum of Association, Articles of Association. If a person is literate, he can sign it. If a person is illiterate, then he will affix a thumb mark. Along with that, a literate person must read all the contents of the document, and he must make illiterate person to understand the contents of the document. Along with that, illiterate person, along with illiterate thumb mark, you should find a literate person's signature who has read the terms and conditions, who had made this illiterate person to understand the terms and conditions. Of course, practically right now this is not happening. Right now, signature is happening only by way of digital means. So the subscribers, directors will be given a digital certificate. They should apply for a digital signature certificate. This digital signature certificate, by fixing to the CPU or laptop, you can sign these documents. Practically different, bookish it is different. You need to read book, you need to write the same answer in the examination, and then only you will get marks. Understood? Everyone. Suppose, if the subscriber is a body corporate, if the subscriber of the company is a body corporate, then authorized representative, a person authorized by the board of directors to act on behalf, authorized director, can sign MOA, AOA. Suppose company A Limited wants to incorporate B Limited, and A Limited will hold 90% of shares in B Limited. Now on behalf of A Limited, the authorized director will sign MOA of B Limited. So signed MOA, AOA. Next one, declaration of compliance. The company incorporation is as per the Companies Act 2013 and rules made thereunder. Like that, a professional and a director or manager or secretary involved in the incorporation must give a declaration. Actually, it is the duty of ROC to check whether documents are correct, whether the incorporation is happening as per the provisions of Companies Act or not. But the point is, every month or on daily basis, hundreds of companies are getting incorporated. Now it is practically not possible for ROC to verify all the documents, to verify the genuinity of the documents, to verify whether incorporation is happening according to the provisions of Companies Act or not. That's why what ROC is doing, a delegated power to the professional, a CA in practice or CMA in practice or CS in practice or advocate in practice. You go through the incorporation, whether it is happening as per the provisions of Companies Act or not. You just give the declaration. Once this declaration is received by ROC will be satisfied. Next one, declaration of no default. Directors, subscribers must give a declaration. Declaration with respect to what? No offense was committed by me in promotion or management of the company previously, or no breach of trust in any previous companies. So I was a director in another company, but I didn't commit any I didn't have any trust issues, I didn't committed any breach of trust, no guilty of fraud. And whatever I'm incorporating now, whatever company I'm incorporating now, so the documents for such incorporation are complete and correct. Along with the declaration, you need to furnish address for temporary correspondence address. If ROC want to send a notice, to which address he can send a notice. Then details of the subscribers, name, father name, surname, and then address, qualification, occupation, and then educational qualification, and then occupation. So number of shares subscribed by each and every subscriber. So those details you need to furnish. Next one, director's details. Here also same, name, father name. Next one, qualification, occupation, DIN, director identification number. And next one, written consent of the directors. Yes, I had no objection to act as a director in this company, like that, written consent of the directors. Along with that, directors have to furnish interest in other body corporates. So whether, if a director is having any interest in other companies or other body corporates, has to furnish those details also. Now all these documents, promoters have to file all these documents with ROC. ROC then grants certificate of incorporation. This certificate of incorporation will have a corporate identity number, a SIN. So natural persons, we are having Aadhaar number. Companies will have SIN. And all the documents which you prepared for incorporating company shall be preserved at registered office till the liquidation of the company. Till the liquidation of company. Next one, if any of this information, any of these documents are false, contains a false information, or if a suppression of material information happened. So whatever documents you file with ROC, those documents contain false information, or those documents, in those documents some material information was hidden, suppression of material information is there. In that case, if ROC comes to know about this fact of false information or suppression of material information, and company is not yet incorporated. If company is not yet incorporated, then the applicant, whoever furnished false information or whoever suppressed material information, will get a punishment under section 447. Section 447 I will discuss with you in prospectus chapter. Just wait. So applicant, whoever furnished false information, will get a punishment under section 447. Suppose company is incorporated, then directors, promoters and persons signed the declaration will get a punishment under section 447. With respect to company, NCLT is having a powers to pass an order for removal of the name from register, or wind up of the company, or making members liability limited to unlimited. So converting limited liability into unlimited liability, this is unlimited liability. And next one, alter memorandum of association or articles of association. Finally, such other orders as may be prescribed. For example, applicant incorporated one public company. In that, 7 subscribers are there. Out of 7, 5 members are minors. Minors had no contractual capacity to enter into contract, yes or no? Minors had no contractual capacity to become members of the company, to become subscribers of the company initially. They cannot act as a subscriber of the company. But what these two fellows did, they made a forgery. They tampered Aadhaar card of these 5 persons. They tampered, a birth certificate of these 5 persons. Imagine. And accordingly, these two persons, furnished information with ROC. So showing that, all these 5 persons are major persons. Later, these 5 persons' parents came into the picture. They filed an application with NCLT. Sir, that company was incorporated with false information, sir. Now, what NCLT can do? NCLT is having power to remove the name from register, or winding up of the company, liquidate the company, or making these 2 persons liability limited to unlimited, or change MOA AOA. Okay, eliminate these 5 people, you come on, change the subscription clause of MOA AOA, or such other orders NCLT is empowered to pass. Understood? So this is all about incorporation procedure. Section 7 is completed. Clear, everyone? And the next one is commencement of business, section 10A. So once incorporation is completed, company cannot start business immediately. Company is prohibited from commencement of business until it finish 2 things. One is, it has to file INC 22 with ROC within 30 days of incorporation. That is verification of registered office. Every company shall have registered office. Every company shall open registered office within 30 days of incorporation. And same shall be communicated with the registrar of companies within same 30 days of incorporation. And next one, a company with share capital which is incorporated on or after 2nd November 2018 has to file a declaration with respect to paid up value. in Form INC 20A within 180 days of incorporation. In memorandum of association, the subscribers to the memorandum promised that they will deposit this much amount upon incorporation. In association clause, you will see subscribers, against subscribers, you will see number of shares they are going to subscribe upon incorporation. Now, the number of shares into face value, that much amount they need to deposit immediately upon incorporation. Understood? So in the application you will find face value, paid up value also. So that paid up value, whether they paid that amount or not. So directors have to file this declaration. And what is the time limit for filing this declaration? 180 days of incorporation. So declaration regarding paid up value. So what is all about this declaration? The directors of the company have to make a declaration. Yes, the subscribers to the memorandum has deposited sufficient paid up value which was promised by them before incorporation. Non-compliance of the second point leads to penalty. Company 50,000 rupees, defaulting officer 1,000 per day, maximum 1 lakh rupee. In case of delay, company will get a penalty of 50,000. Defaulting officer, each day delay 1,000 rupees, maximum 1 lakh rupee. And still, if you are not complying with this provision, suppose company was incorporated, 2 years completed, but still company is not filing INC 20A with ROC. Now ROC is having power to remove name from register. That means company never came into existence. First ROC will verify whether company is carrying any business operations or not, whether company is having any affairs or not. That means whether company had entered into any contracts or not. So ROC will make a reasonable inquiry. In that inquiry, if ROC comes to know that company is not carrying any business operations, not carrying any operations, then ROC will remove name from the register. It's almost like closure only, or it's like that company never came into existence. So this is all about commencement of business, section 10A. Next comes one person company, single member company. See, this is a private limited company with minimum and maximum one person. Now even one person can enjoy the benefit of limited liability. In the absence of this concept, what a business person is required to do for getting the benefit of limited liability, he should bring another person into the picture. Whether he had interest or not, whether he like him or not, but he should bring another person. Only with two persons he can form a private company, then only he can enjoy the benefit of limited liability. But because of this concept, a single person can start a company, one person company. But there are some conditions on the company as well as member and nominee. So who is this nominee, sir? Who is this nominee? In the death of the member, in the event of death of the member, in the event of disqualification of member, nominee becomes member of the company. Nominee becomes member of the company. So what are the conditions a member or nominee should satisfy? 3 conditions these two persons should satisfy. One is natural person, Indian citizen. Next one, period of stay at least 120 days in the preceding financial year. If these 3 conditions are satisfied, then he can form OPC. He can become nominee of OPC. He can become member of OPC. And that OPC after incorporation is prohibited from carrying 3 activities. One is OPC is for profit oriented companies only. OPC, one person company, is meant for profit objects only. So OPC can't be formed for charitable activities. OPC can't be formed with charitable activities, Section 8 activities. OPC cannot carry NBFC, non-banking financial company activities. OPC cannot make investment in other body corporates. These 3 activities are prohibited. Next one, benefits of OPC. One member can form company and he can have a limited liability benefit. And one director is sufficient in OPC. Annual returns generally signed by company secretaries coming to OPC, signed by director is sufficient. No need to no need to go to company secretary. Just director signing annual return, that annual return is valid. Next one, AGM not required. Why? AGM means what? Meeting, general meeting. Meeting generally requires 2 persons. Without 2 persons, there will be no meeting. If one person comes, we can't call it as a meeting, yes or no? In one person company, you will find only one member, only one person. So for one person, meetings are not required. So AGM related provisions are not applicable. At the time of incorporation, in MOA, you will find a nomination clause, nominee clause. And before naming someone as nominee, it is required to get a written consent from the nominee, and that written consent of the nominee can be withdrawn at any point of time. Or member who named someone as nominee is having a power to remove the nominee. And suppose member got deceased, nominee became member. In all these three situations, there arises vacancy in nominee position, and the member, when there is a vacancy in nominee position, it is the duty of member to appoint a new person as a nominee within 15 days of vacancy, and within 30 days of the event, the same shall be communicated with ROC about appointment of new nominee. Understood? So this is all about a one person company. Next one, conversion. Private company or public company, if it wants to convert into OPC, or OPC wants to convert into private company or public company, then it has to file an application with ROC. Along with application, some attachments, some documents should be attached. One is altered MOA, resolution copies, members list, directors list, no objection certificate from creditors, debenture holders. Are you getting my point? So you should get NOC from them, and then you need to furnish audited balance sheet, audited profit and loss account. Going through these documents, ROC will grant a certificate subsequent to conversion. Clear? Next one, Section 8 company. Section 8 company is a company with charitable activities. See, our Companies Act is giving a way not only to profit oriented companies but also to the charity oriented companies. Don't think that everyone will do operation only for achieving profit, only for becoming rich. There are some people whose main intention is serving the society. So for them, trust society option is already there. Society trust concept is already there, but the point is, in case of societies, in case of trust, central government will not have direct access over them. Central government will have only direct access on the companies. So to encourage them, come on, we are also having one option, that is a company with charitable objects, Section 8 company, come and register under us. Now central government will have direct access. See, central government, how it can regulate the company, from time to time it will frame rules and regulations. From time to time, Section 8 companies are required to file annual returns with central government. Central government will go through all these annual returns and it will come to a conclusion whether company is doing well or not, whether company is following provisions or not, whether company is following conditions prescribed in the license or not. So central government can regulate Section 8 companies directly. Understood? So this is an option given to the association which wants to serve society. Now conditions of Section 8 company, in order to incorporate Section 8 company, first condition, open memorandum of association. In that first one, object clause must contain objects related to charity, a religion purpose only. So here if you see this word SERC, S stands for sports, art, education, environment protection, religion, C for culture, commerce, science, okay, everything, the main theme of these objects is simply charitable and religious, that's it. Next one, any surplus amount arised due to carrying of these operations. Suppose, we promised in a village that we will construct a school. Accordingly, we received donations from the rich people. So total donation amount we received 10 lakhs. Construction total amount is 9 lakhs. Now if you observe carefully, from that activity we had a surplus of 1 lakh. Now sir, can I pay this 1 lakh rupees in the form of dividends to the members? No. Why? You received these amounts without any efforts, without any work. You didn't carry any business operations. You received these amounts voluntarily. Yes or no? So this money you received only for welfare of the society. Now this amount should be spent only for the purpose of welfare of the society only. You should invest all these amounts in promoting other objects of the company. The declaration and payment of dividends is strictly prohibited. Are you all getting my point, students? So Section 8 company, 3 major conditions. One is object clause contains, so charitable activities or religious activities. Dividends, strict prohibition. Surplus, invest in promoting other objects of Section 8 company. Now, the next one is, once these conditions are satisfied, the next step is file an application with central government for getting a license. For that you need to attach some documents. Those documents are draft MOA, draft AOA. Declaration of compliance by a professional. Professional will give a declaration. Yes, sir, this incorporation, this Section 8 company incorporation is as per the provisions of Companies Act only. Next, 3 years estimated income and expenditures, annual income and expenditure. So how much, how you will receive donations and how you will spend these donation amounts. Estimations, not actuals, estimations. Next one, declaration by the applicant. So file all these documents with central government, you will be given a license. Now file that license with ROC. ROC shall register the same and will issue a certificate. From that date onwards, you will be a Section 8 company. You are not required to use words limited, private, limited in your name clause. So this is an advantage. You are not required to use the words limited, private, limited. Generally, private limited company names always ends with word private limited. Public company names always ends with limited. For Section 8 company, private limited not applicable. Not applicable means there is no mandate on them to use those words. They were relaxed from using those words. Now next one, benefits of Section 8 company. Even a partnership firm which is not having a separate legal entity character can even become member of Section 8 company. Section 8 company. Next one, in case of general meetings, generally notice must be given at least 21 clear days before the meeting. So the length of the notice is 21 clear days. What is the length of the notice? 21 clear days. That means 21 days before general meeting you have to give notice. For Section 8 company, 14 days is sufficient. So delay in decision making will be reduced. Next one, minimum number of directors, independent directors. Next one, various committees of directors are not applicable here. But the biggest disadvantage in Section 8 company is, when you want to alter MOA or when you want to alter AOA, central government prior approval is compulsory. Central government prior approval is compulsory. Without central government approval, you cannot alter MOA, you cannot alter AOA. Understood? Everyone. Next one. Sir, I'm a normal company, sir. I'm a company with profitable objects. Profit oriented objects. Now I want to convert myself into Section 8 company. Possible? Yes, possible. For that you should get a central government license. A normal company can be converted into Section 8 company only with central government license. For getting central government license, company has to file an application. Along with applications, they need to attach these documents, MOA, AOA. So what is the difference between this point and above point? Above point, directly incorporation of Section 8 company, directly incorporating Section 8 company. This one, converting existing company into Section 8 company. So for that you need to file an application. Along with application, following documents shall be attached: MOA, AOA. Declaration of compliance by the professional. Professional means 4 people comes under professional. CA in practice, CMA in practice, CS in practice, advocate in practice. Any of these 4 persons must file a declaration with central government. Yes, the conversion is as per the provisions only. Next, previous 2 years audited financial statements, board report. Next one, latest financial position of the company. That means statement of assets and liabilities, latest one. If you give that information as on date of application, it is well and good. Or the assets and liabilities, not latest one, sir, but this was prepared 30 days before application, sir. Suppose I'm filing application on 31st December 2024. In that case, statement of assets and liabilities, it should not be older than 1st December 2024. So latest statement, file it with central government. And then estimated annual incomes and expenditures for the next 3 years. Next one, certified copy of resolutions. Yes, only with the members' approval a company can be converted into Section 8 company. So certified copy of resolutions, along with that a declaration by the applicant. Yes, the proposed conversion is as per the provisions of Companies Act. Now attach all those documents, and once you filed an application for getting a license, immediately make an advertisement in 2 newspapers. One is vernacular newspaper and the other one is English newspaper, having a wide circulation in that area, in that country. Vernacular newspaper means newspaper in principal language where the company got incorporated. Suppose if company is incorporated in Karnataka, Kannada is the principal language. Andhra Pradesh or Telangana, Telugu is the principal language. So one is in local language, the other one is in English language, and that paper should have a wide circulation. And file a copy of advertisement with the ROC. So once company receive approvals from the authority, file all those approvals with ROC. Finally, you'll get a licensed company, Section 8 company. The other name to the Section 8 company is licensed company. And next one, change MOA, AOA to the extent of central government levied conditions. At the time of giving a license, central government may place some additional conditions. Now all those conditions, based on all those conditions, you need to change MOA and AOA and file all these documents with ROC. ROC will issue a certificate subsequent to the registration. Next one, revocation of license. The authority having power to grant license will have same power to revoke the license. Sir, why they will revoke the license? We are having three situations. One is, company is not complying Section 8 provisions. Company, whatever surplus company is getting, it is distributing those surplus in the form of dividends among the members. Contravention. Affairs are conducted fraudulently. Violation of the objects are opposite to the public policy. Suppose, company promised to provide education. Our main objective is providing education, but in reality what it is doing, it is giving training to the people how to catch the gun, how to fire, how to kidnap, how to that's what, how to kidnap, how to hijack a flight, how to hack a server, how to rob money in the banks, like that. They're carrying some objects which are opposite to public policy. Next one, affairs are conducted fraudulently. Suppose, what it is doing, it is telling that we will construct a school and it is collecting donations. Once they are getting money, they are transferring that money, they are making some hawala transactions. Whatever amount they get, it is a white money. So white money, instead of spending on the object of the company, they are distributing among various people, since it is a white money. So now, affairs are conducted fraudulently. Generally, this trust Section 8 company will be, many people will use them to convert black into white. How, sir? I'll tell you a small example. Suppose, I'm having a 1 crore black money. If I directly deposit, black money means what? A money in black color? No. Black money means, any amount left with me without paying taxes. I got 1 crore rupees. Actually, I need to pay tax on it. Some 33 lakhs I need to pay, but I didn't pay any tax. I'm holding that money, physical money I'm holding. Now I want to deposit entire money in the bank. If I deposit it, definitely I'll get a notice from IT department. So that's why what I'm doing, I'm opening a Section 8 company, and I'm creating some 100 people. I'm identifying 100 people and I'm giving them each 1 lakh rupee. Come on, take this 1 lakh. And you come to that company, you make donation to that company. 1 lakh each individual, not required to pay income tax. 1 lakh per individual, no need to pay any income tax, no need to file income tax return. Okay. So now all these 100 people, they deposited 1 crore rupee in the company. Now that company is having 1 crore. Actually, if you observe carefully, that company belongs to me. That 1 crore belongs to me. But what I did, I used this company to convert black money into white money. How? I distributed amount among various people, and I asked all those people to make a deposit in this company. So once company receive this money, company can spend that money as it is. Company can spend that money according to that will and wish. But if you observe carefully what happened so far, conversion of black money into white money. That means, affairs are conducted fraudulently. In case of these situations, the central government, first it will give an opportunity of being heard. So these are the allegations filed against you, and subsequently they will revoke the license. And after revocation of license, that Section 8 company gets liquidated or amalgamated with similar Section 8 company. In case of finding up, any amount left over will be transferred to rehabilitation and insolvency fund. So yes, this Section 8 company which I incorporated, which is having 1 crore money, will be liquidated, and that 1 crore amount shall be transferred to rehabilitation and insolvency fund. Or this Section 8 company may be merged with, amalgamated with another Section 8 company. And punishment for violation of section 8, company 10 lakh rupees is the minimum fine, 1 crore is the maximum fine. Defaulting officer 25,000 to 25 lakhs. In institute material there is a imprisonment also, but right now not there. So defaulting officer fine minimum 25,000, maximum 25 lakhs. In case of fraudulent affairs, just now I told you, in case of fraudulent affairs, the person will get a punishment under section 447. And next one, conversion of section 8 company into company. Previously I discussed with you company into section 8 company. Right now section 8 company into other company. Section 8 company means a company not for profits. Section 8 company is a company not for profits, only for charity or promotion of religious activities. Now this section 8 company wants to get converted into other company. In that case, it has to satisfy the following conditions. First, members approval, special resolution, alter MOA, that altered object, alter object clause of MOA. Before that, you need to get central government approval. So that's what, ROC and RD means regional director filings. Advertisement is compulsory. Why? Because, so far what public thought that, this is a section 8 company, so we'll make donations to it so that it will carry some charitable activities. But now onwards, this is no more a section 8 company. So public should stop making donations. So make an advertisement at least 1 week, within a week before filing an application. And then, file a notice with Chief Commissioner of Income Tax, Charity Commissioner, Chief Secretary of the state. And 60 days time period is given to these people for making any objections. If no objections were received from these people, then central government will give a approval for conversion. Next one, declaration by board of directors that no portion of incomes or assets is paid in the form of dividends or bonus. So far, we received donations, but no portion of these donations, no portion of these incomes or assets is paid in the form of dividends or bonus. Next one, NOC from authorities. So previously, being a section 8 company, I received benefits or I received some special status from the authorities. From those authorities, again you need to get NOC certificate, no objection for conversion. And finally, a professional, practicing professional has to prepare and file a declaration stating that conversion is as per the provisions of Companies Act only. Now finally, regional director, what he will do first, he will take up the special status of section 8, and the company, whatever assets it is holding, if it acquired that asset at a concessional price, suppose there is a building in the name of company, the market value of the building is 1 crore, but what government did, government granted this building at just 10 lakh rupees only. Why? This is a company with charitable objects, so for the benefit of public, for the welfare of public, government allotted this land at just 10 lakh rupees only. Now at the time of conversion, what company has to do, company is required to pay this difference amount. 1 crore is the market value, cost is 10 lakhs, so 90 lakhs it has to pay that amount, or it has to give back those assets. And whatever accumulated surplus is there as per the audited balance sheet, audited profit and loss, that accumulated surplus, first it should be adjusted against statutory dues with respect to government, any GST due or any income tax due, like that, statutory dues. Next, adjust against outstanding creditors, outstanding debts. Balance amount shall be transferred to IEPF within 30 days of conversion. IEPF means Investor Education and Protection Fund. And once company receives a regional director order, so regional director means actually central government delegated power to regional director. So within 30 days of regional director order, it is the duty of company to file documents with ROC. What are those documents? RD approval, altered MOA, altered AOA. And then ROC will issue a fresh certificate of incorporation. So finally, conversion gets completed. So this is no more a section 8 company. Accordingly, it is required to add the words private limited, a limited in its name clause. Understood? Everyone. Next one. Memorandum of Association. Section 4. Memorandum of Association, generally it will have 4 clauses: name, situation, object, capital, liability, subscription. In case of one person company, there is additional clause of nomination clause. There is one more clause called nomination clause. In name clause, you will find name of the company. You know, private company name always ends with private limited. Public company name always ends with limited. Section 8 company, those restrictions are not applicable. Those conditions are not applicable. Not applicable. Government company, even though it is a private company, the name of government company shall always ends with word limited. Next, situation clause. In situation clause, you will find the name of state in which the company was incorporated. Object clause, you will find main objects, incidental objects. You know, for what purpose company came into existence. What is the main object of incorporation? Infosys, tech business. Wipro, tech business. Reliance, oil refineries. Reliance Industries Limited. So main objects. Incidental objects that are required for carrying main objects. Suppose rest, imagine rest private limited company is there, you know, which is providing education, which is engaged in providing education. Now the main object is, you know, providing education. Incidental objects, what comes under incidental objects, you know, this purchase of infrastructure, you know, ACs, fans, tables, systems, laptops, mic, everything, you know, all these are not our main objects. But why we are making all these purchases, why we are entering into these contracts? The only reason is for promotion of main objects. For promotion of main objects. Next one, capital clause. In capital clause, you will find authorize the share capital of the company. To what extent it can issue shares. So number of shares multiplied by face value. So this is the only requirement. No need to classify share capital into equity preference. If you want, you can classify, but there is no restriction in the company side. So what is the authorized share capital? Number of shares, face value, how much. Next one, liability clause. You know, liability limited by members, limited by guarantee, unlimited. Just now I discussed with you. Next, a subscription clause. You will find the details of the subscribers and witness. Next one, to this object clause, we had one doctrine. Doctrine means principle. Doctrine of ultra virus. Ultra virus means what? You know, beyond the powers of MOA. Company will get powers from object clause of MOA. So what a company can do, what a company cannot do, everything is prescribed in the object clause of MOA. Infosys company can do only tech business. Infosys company cannot engage in real estate business, cannot engage in food business. So what a company can do, what a company cannot do, everything is stated in Memorandum of Association object clause. If company acts beyond the powers of MOA, then we call it as ultra virus as to the MOA. Sir, what is the effect of ultra virus act? Void ab initio. Void from the beginning. If something is void from the beginning, ratification is not allowed. Ratification is not allowed. And since these acts are void ab initio, company cannot sue, company can't be sued by third parties. Then who is liable to the third parties, sir? Directors. Defaulting directors are personally liable to the third parties. And this doctrine protects the stakeholders' funds. Stakeholders' funds will be utilized only for the purpose stated in the Memorandum of Association. See, company cannot go beyond the powers of MOA. If company go beyond the powers of MOA, if company loses any money, director has to compensate company. In this way, company funds, shareholder funds, stakeholders' interest is protected. Stakeholder is different, shareholder is different. Stakeholder is a person having interest in the company. He may be employee, creditor, debtor, and he may also be a shareholder. Coming to the shareholder, he is a person who holds shares of the company. Stakeholder includes shareholder. Next one, articles of association. This is for internal governance. See, company being an artificial person, it can't do its acts on its own. Definitely it requires management, it requires human agency. Now the powers of the management, powers of the directors, duties of the directors. So all these points, all these rules were notified in a separate document called Articles of Association. Memorandum explains about company to the public. Articles explains the duties and powers of directors internally. Understood? So table F contains model articles. You can copy those model articles or you can alter those articles. It's up to you. Next one, entrenchment. Entrenchment means, you know what? Placing additional conditions, placing additional restrictions. Generally, to amend AOA, to alter AOA, special resolution is required. What type of resolution? Special resolution. Special resolution means votes in favor greater than or equal to 3 times of votes against. That means 75% favor. If 25% is against, then 75% voting power should be in favor of alteration. AOA can be amended only through special resolution. Only through special resolution. Now, if you are making a point like this, a particular item of AOA can be altered only with 100% approval. 100% of members should approve for a particular alteration of AOA. Then we call it as entrenchment. Entrenchment means placing additional or more and more restrictions in order to protect minority shareholders, minority interest. This entrenchment you can have at the time of formation of the company or subsequent to formation of company. But subsequent to formation of company, if you want to entrench your articles, if you want to include entrenchment provisions, then consent of all members is required in case of private company. A special resolution is required in case of public company. Once you include entrenchment provisions in AOA, you have to give a notice to the ROC. ROC will record the same. That is all about AOA, section 5. Next to section 6, Act overrides MOA, AOA. If there is any inconsistency between Companies Act and these five things, MOA, AOA, members resolution, board resolution, agreement executed by the company, then Companies Act will have an overriding effect. Overriding effect means what? It can make the provision in MOA, it can make a clause in MOA null and void. Accordingly, Companies Act is applicable. For example, OPC is prohibited from carrying investment activities. See, investment activity is not an illegal activity. Investment in a other body corporate is not illegal activity, it is a legal activity. Coming to OPC, it is prohibited. Now, OPC, MOA of a OPC, if there is a point that company can make investment in other body corporates, now what Companies Act is telling? Prohibition. What MOA of OPC is telling? Permitted. So there is inconsistency between Companies Act and MOA. In that case, avoid that inconsistency, follow Companies Act. That inconsistency will be overridden. Companies Act is the supreme. Companies Act will have a supremacy over all these 5 documents, 5 things. So in case of inconsistency, to that extent of inconsistency, it becomes void. All other points valid, all other points are applicable. But the point is, in case of inconsistency, if it is opposing Companies Act, if it is against to the Companies Act, that such clauses, such points become void. In those areas, Companies Act provisions will apply. That's what Act overrides MOA, AOA. So this is a great symbol. Companies Act is having a supremacy over all these 5 things. Next one, alteration of MOA requires special resolution of members except capital clause. For alteration of capital clause, ordinary resolution is sufficient. That thing I'll discuss with you in share capital chapter. So alteration of MOA, in that first one is change of name. Change of name. See, change of name happens because of 2 reasons. One is voluntary change of name. The other one is rectification of name. One is voluntary. The other one is rectification. See, voluntary change of name, that means, company, voluntary change of name means, company wants to change its name voluntarily. Rectification of name means there is a mistake, some mistake happened in that situation, and to rectify that mistake, yes, rectification of name, it comes into the picture. See, voluntary change of name, this happens because of change in business objects, or change in management of the company, change in ownership of the company. Previously we had Satyam company. Right now we had no that company with that name. So later, the name has been modified to Mahindra Satyam. When Mahindra companies acquired Satyam company, the name has been modified to Mahindra Satyam. Later, they deleted the word Satyam, and later that company got merged into Tech Mahindra. And very recently you can see, Vodafone Idea company. Idea company acquired Vodafone, merger happened. So the name of the company has been changed to Vodafone Idea. So because of change in management, change in objects, the name of the company may be changed voluntarily. In that case, central government, power delegated to regional director and ROC. So central government approval is required. And if you are a private company and you want to convert into a public company, if you want to convert your private company into public company, then government approval is not required. Since the name is same, just the word private is deleted. The word private is deleted from the name. There is no change in the name just vote private is getting deleted. So for that case, central government prior approval is not required. And next one, the company should not be a defaulter. The company should not be a defaulter. Defaulter means, non-filing of annual returns, non-filing of financial statements, non-repayment of debentures, non-repayment of deposits, non-payment of interest on debentures or deposits. Like this, if any defaults were found, then that company is prohibited from changing the name voluntarily. So prohibition on defaulter. Next, procedure, first call for a board meeting, pass board resolution for making a recommendation of change of name. And fix day, time, place of general meeting. Day, time, place of general meeting. In the general meeting, members will give a special resolution, file all those documents with ROC. ROC will give you a fresh certificate of incorporation consequent to the change of name. Next one, rectification case. Rectification means simply rectifying the error, rectifying the mistake. Our company was incorporated with a name which is similar to the name of trademark or similar to the name of existing company. Overlook, ROC granted certificate of incorporation. Imagine. Now the owner of registered trademark is having a power to file an application with CG, and that application shall be filed within 3 years of incorporation of the company. Within 3 years of incorporation of company, the owner of registered trademark has to file an application with CG, and CG will pass an order to rectify the name of the company. Others means other than infringement of trademark, that means our company name is similar to the name of existing body corporate. Now central government on suo moto, on its own motion, will pass an order to rectify the name of company. Now within 3 months, a rectification should complete. In study material, the time period 6 months is given, but right now, after amendment, the time period is 3 months. Within 3 months of central government directions, rectification must be completed. And for such rectification, for change of name, because of rectification, ordinary resolution is sufficient. Special resolution is not required. Ordinary resolution is sufficient. Ordinary resolution means, votes in favor greater than votes against. Special resolution case, votes in favor greater than or equal to 3 times of votes against. So ordinary resolution is simple majority, whereas a special resolution 3 times majority, 3 times against votes, 3 times of votes in against. Next one, after passing ordinary resolution, after rectifying the name, file the documents with ROC within 15 days. That means within 15 days of change of name in MOA subsequent to ordinary resolution, file the documents with ROC. ROC shall register the name and issue a fresh certificate of incorporation. In case of default, punishment, company 1000 per day, defaulting officer, the punishment is 5000 rupees to 1 lakh rupees. Along with the new name, you have to disclose old name for a period of 2 years after change, formerly known as. The new name of the company in brackets, formerly known as, previously it is known as. Why? Companies will be identified only through its name. Through its name, one can identify the company. Yes or no? So now if name gets changed, along with new name, you have to disclose old name for 2 years. Next one, registered office. The importance of registered office is communications, investigations, jurisdiction. All these 3 depends on registered office. Someone want to communicate with company. If income tax department want to give notice to the company, then that address, then that letter is addressed to registered office address. Investigation, inspection activities are carried out at registered office. Now, if someone want to file case on the company, they can't file case in a court outside the jurisdiction of a company. If someone want to file case on the company, then they can file case only in the court, which is within the jurisdiction of company's registered office. Now this registered office can be shifted from one place to another place within same city, or from one city to another city within same state, or change in state. Within same city, Jubilee Hills to Banjara Hills in Hyderabad. Change in city, suppose Hyderabad to Nalgonda. Change in state, Andhra Pradesh to Tamil Nadu, Andhra Pradesh to Karnataka. So these are the situations we are having. And change in city, we are having two more situations. That is, one is no change in ROC. Suppose Hyderabad to Nalgonda, before shifting, after shifting, they are covered under only single ROC. Those two places are within the control of single ROC. Change in ROC, suppose in state of Tamil Nadu we are having two ROCs. In state of Maharashtra we are having two ROCs. One is Chennai ROC, Coimbatore ROC, Mumbai ROC, Pune ROC. Suppose you are shifting your registered office from Coimbatore registrar office jurisdiction to Chennai registrar office jurisdiction. In that case, that situation falls in this category. Now what is the procedure? If you want to shift registered office within the same city, then board resolution is sufficient. Simple board resolution and filing with ROC INC 22 within 30 days of change. Within 30 days of change, communicate with ROC. So simple procedure sufficient. Change in city but no change in state, no change in ROC. In this case, members approval is required. Special resolution is required. Extra documents, extra requirements, special resolution. Sir, change in ROC, sir. Along with board approval, members approval, get approval from a regional director. So here approval from regional director is required. First, yes, company has to file an application with regional director. A regional director is a person a level above ROC. The hierarchy will be like this: Ministry of Corporate Affairs on behalf of central government. Central government, in central government you will see various ministries: finance, home, railways, irrigation, agriculture, next urban development, like that. Various ministries you will find. One among such ministries is Ministry of Corporate Affairs. Under Ministry of Corporate Affairs you can see regional director. Under regional director you can see ROC. So when you are shifting your registered office from one ROC to another ROC, file an application with regional director. Regional director, within 30 days of application, he will pass an order whether approving the change or rejecting the change. Once company receives this order from regional director, communicate the same with ROC. And next one, last one, change in state. Here, company has to file an application with central government. Of course, in rules, central government delegated power to regional director. Southern region, one regional director you will find. Okay. Now along with application, you need to file these attachments. Altered MOA. In above three cases, you won't find altered MOA. The reason is, in MOA you will find only the name of state in which company was incorporated. You will find only the name of state in which company is incorporated. Understood? So in above three cases, there is no change in state. Change in state is coming only in this situation. So altered MOA comes into the picture here itself. Copy of minutes where members, next board of directors gave approval. Minutes means it's a document containing summary of proceedings happened in that meeting. So copy of minutes, board resolution copy, special resolution copy, list of creditors, debenture holders, latest list. As on today, who are the creditors? As on today, who are the debenture holders? And this list should not be older than 30 days. Latest copy you have to file. Along with that, you need to submit a declaration signed by managing director, director and company secretary, if company is having company secretary, stating that we have verified all the affairs of the company and these people are the creditors, complete list, and we owe to them. So these are the dues. Next one, advertisement in two newspapers is compulsory, and file a copy of advertisement. So you have to attach all these documents. You need to file all these documents with central government, regional director, power delegated to regional director. Now if central government didn't receive any objections from the creditors, debenture holders, then central government within 60 days of application passes an order either confirming the shifting or rejecting the shifting. It may confirm or it may reject. So whatever central government, whatever order passed by the central government, it is the duty of company to file that order with ROC. Within 30 days of CG order, file a copy with the registrar of companies. So registrar of companies shall register the same and issue a fresh certificate of incorporation in case shifting is permitted. Next concept, subsidiary company not to hold shares in holding company. General rule, a subsidiary company cannot hold shares in holding company. See, on the basis of control, one is controlling company. Holding company is a controlling company. It is a controlling company. Whereas subsidiary company is a controlled company. It's a controlled company. Now, which one is controlling? Holding company is controlling. and which was controlled, subsidiary company was controlled. Imagine A Limited is having 52% voting power in B Limited. Now B Limited is also having some 55% voting power in A Limited. Now can you tell me which one is controlling which one? Is A controlling B or B controlling A? Yes or no? So to avoid this situation, subsidiary cannot hold shares in holding company. The general rule is holding company shall not make any allotment, shall not register any transfer of shares in the name of subsidiary company. If it makes any allotment or if it makes any transfer of shares in the name of subsidiary company, then such allotment transfer is void. And to this general rule, we are having three exceptions. One is, legal representative. As a legal representative, subsidiary company can hold shares of holding company. As a trustee, subsidiary company can hold shares of holding company. Just 30-40 minutes back, I gave you one example. Company holding shares in a fiduciary capacity. So subsidiary company can hold shares of holding company in a legal representative capacity and trustee capacity, no problem. And before becoming subsidiary, suppose A Limited, B Limited. B Limited on 2nd November 2020, it acquired shares of A Limited. How much? 10% of equity share capital. Now there is no relationship between A Limited and B Limited. Actually, there is no relationship between A Limited and B Limited as on 2nd November 2020. Subsequently, after 6 months, A Limited acquired 60% of equity share capital of B Limited. This happened 2nd May 2021. At the time of becoming subsidiary, B Limited, it is already holding some shares of A Limited. Now there is no problem with respect to such holding. Subsidiary company can continue to hold those shares. Why? Subsidiary company acquired those shares before becoming subsidiary, not after becoming subsidiary, before becoming subsidiary. So any allotment or transfer after becoming subsidiary becomes null and void. Out of these three exceptions, in first two exceptions, voting is allowed. Subsidiary company can vote in holding company annual general meetings. Last case, no voting is permitted. Understood? In the first two cases, subsidiary company is holding shares not for its benefits. It is holding shares on behalf of someone as a legal representative or as a trustee. So there is no problem with respect to first two cases. That's why voting is allowed. Whenever a holding company H Limited calls for a general meeting, in that general meeting, subsidiary company can come and can exercise voting power if it is holding shares in a legal representative capacity or a trustee capacity. But subsidiary company, if it is holding shares for its own benefit purpose, not as a legal representative, not as a trustee, in that case, S Limited cannot exercise voting rights with respect to those shares. Next one, last point, signing of documents. Sir, who can sign documents on behalf of company? The answer is KMP, Key Managerial Personnel, Managing Director, Manager, CEO, CFO, Whole-Time Director, Secretary. All these people comes under KMP definition. Or any officer or employee authorized by board can sign the documents on behalf of the company. Next one, sir, who can sign bills, promissory notes, hundis, checks on behalf of company, sir? Any person who was authorized under a common seal. If no common seal, then who was authorized to sign the checks? Such authorization can be given under common seal. If there is no common seal, then two directors or one director and one company secretary. See, company C Limited is there. It is having branches in all 28 states. Now, in a particular state, Andhra Pradesh, Mr. N can sign a checks on behalf of the company. Now, how N gets authorization? How N gets authority? The answer is N gets authorization either under common seal of the company. If company is having common seal, then fix the common seal. Along with the common seal, these people have to sign. Either two directors or one director plus one secretary have to sign that letter of authorization. In case of no common seal, then two directors or one director and one company secretary has to sign the authorization letter. Then only N gets authority to sign the documents. Documents means bills, promissory notes, hundis, checks. So with this incorporation of company also completed, let's see the material ones. Section 3, minimum number of members. I discussed with you breach of minimum number of members. So what will be the consequence? Several liability, joint and several liability, I told you. Procedure for incorporation of company, I discussed with you in detail. Furnishing false or incorrect information. Yes, this concept also I revised. Order of the tribunal, changes in MOA, unlimited liability, removal of name, winding up, any other order. Yes, next one, commencement of business, over. Effect of registration not required. OPC, I discussed with you in detail. So conditions on OPC, conditions on member, conditions on nominee. And important point, minor shall become member or nominee of OPC. True or false? False. No minor shall become member or nominee of OPC. Understood? Everyone. So next one, annual returns, I told you. So annual returns, it is sufficient only if annual return is signed by the director of the company. See, actually OPC, annual return of OPC shall be signed by company secretary. If there is no company secretary, then director of the company. So company secretary provisions are not applicable simply. Next one, conversion into OPC, I discussed with you. Section 8 company, I revised. Conversion of company into Section 8 company as well as Section 8 company into normal companies. Two things I covered in the revision lecture. Memorandum, each and every point I discussed with you. Yes, these tables, just remember tables, remember. First, remember this hierarchy: limited by shares, limited by guarantee not having share capital, limited by guarantee with share capital, unlimited company without share capital, unlimited company with share capital. First you remember this structure of the table, then A, B, C, D, E are the tables for memorandum of association. With respect to articles of association, just continue it: E, F, G, H, I, J, and interchange these two things, interchange. So the correct tables for these 5 companies, the correct tables is F, H, G, J, I. My MCQ point of view, multiple choice question point of view, there is a chance of getting these tables into the multiple choice question. That's why I'm telling you. So remember that first, that hierarchy or the table. Limited by shares first. Guarantee without share capital, guarantee with share capital. Unlimited company without share capital, unlimited company with share capital. A, B, C, D, E, tables MOA. F, H, G, J, I, tables AOA. Doctrine of ultra vires, I discussed with you. Next one, articles of association, entrenchment provision. The part is very important, and I discussed with you in this revision lecture. Signing of MOA, AOA, I covered important content in this question. Literate person, illiterate person, body corporates, details of the subscribers, details of the body corporate, what things we need to furnish, everything I covered. MOA, AOA cannot override the act. Next one, effect of MOA and effect of AOA. See, effect of MOA, effect of AOA. Members are bound to the company, company is bound to the members, but company is not bound to the outsiders because of MOA, AOA. And once again I'm telling you, MOA, AOA both are contractual documents between company and members. So to these documents, company is bound to the members. Company can utilize members' money only for the objects stated in MOA, and members are bound to the company. Whenever company is making calls on shares, it is the duty of members to pay call amount. But the point is, company is not bound to the outsiders because of MOA, AOA. Why? MOA, AOA is not a contractual document between company and outsiders. So company is not bound to the outsiders because of provisions in MOA, because of contents of MOA and AOA. See, if there is a contract between me and you, I am bound to you, you are bound to me. So this contract, it creates binding capacity between me and you. It's not between me and outsiders. It's not between you and outsiders. Yes or no? Like that, MOA, AOA are contractual documents between company and members. So company bound to members, members bound to company, but company is not bound to outsiders. Alteration of MOA, everything I discussed, ma. Registered office, yes, changes in registered office, all those aspects I discussed with you. Subsidiary not to hold shares in holding company. Subsidiary company not to hold shares in holding company. 3 exceptions are there: legal representative, trustee, and then before becoming subsidiary. Serving of documents, yes, this one point is there. Serving of documents, if company want to communicate with members, or if members want to communicate with company, then a document, if members want to send to the company, or if company want to send to the members, the document can be served by way of either manual mode or electronic mode. Under manual mode, post, registered post, speed post, courier, delivering at the office, all this comes into the picture. Electronic mode, simply Gmail, email, like that. So that's it. Incorporation of companies and matters incidental thereto, revision completed. Let's continue our marathon with the next chapter, prospectus and allotment of securities. Section 23 to section 42. First one, section 23, issue of securities. Here companies are of two types: public companies, private companies. Public companies can offer its securities to the public by issuing prospectus. Public company can also offer its securities to the identified persons under private placement, and public company can issue securities to the members either under rights issue or bonus issue. The difference between rights issue and bonus issue is, under rights issue, company will receive monetary consideration, whereas bonus issue, company receive nothing. Company at free of cost issues securities to its members. Next one, private companies. Private companies can issue securities to the identified persons under private placement, and private company can issue securities to its members either under rights issue or bonus issue. Now, public offer here refers to initial public offer, further public offer, offer for sale of securities. IPO, initial public offer. After incorporation, for the first time, if company is making public offer, we call it as IPO. Any public offer subsequent to IPO, we call it as FPO, further public offer or follow-on public offer. And this IPO, FPO includes offer for sale of securities. What is offer for sale of securities? I'll discuss with you under section 28. Clear? Now, whenever company is making a public offer, it is the duty of company to prepare and issue a document called prospectus. So, whenever public offer comes into the picture, there arises prospectus. So first of all, what is prospectus? Prospectus means any document described or issued as a prospectus, and prospectus includes red herring prospectus, shelf prospectus, notice, circular, advertisement inviting offers from public for purchase or subscription of securities. First, I'll give you a small example. You qualified CMA examinations. Now you become a qualified cost accountant, and there are some job openings in ITC company. So you want to apply for that job. On the date of interview, they will ask you a document called resume, and resume will contain particulars about you, complete details, your experience in accounts field, auditing field, taxation field, your qualifications, your achievements, everything you will compile and you will prepare a document, and you call it as resume. Yes or no? Now similarly, company is going to the public. Company is inviting public to purchase or subscribe its securities. Now it is your duty to communicate about yourself to the public. And here you will prepare a document which contains prospects of the company. And the document is nothing but prospectus. So any document which contains prospects of the company, we call it as prospectus. But coming to the definition of prospectus, prospectus definition is having two parts. One is prospectus means, the other one is prospectus includes. Prospectus means any document described or issued as prospectus. Take any document. If the document is having a name prospectus, then it is a prospectus. And prospectus includes three types of prospectus. One is red herring prospectus, shelf prospectus. The third one is deemed prospectus. See, notice, circular, advertisement. Company is issuing a notice or circular or advertisement. Why? To invite offers from public. Regarding what? Purchase or subscription of securities. That means here the name of the document is irrelevant. The purpose of the document is relevant. Name is irrelevant, purpose is relevant. So here name may be notice or circular or advertisement, but the purpose is inviting offers from public for purchase or subscription of securities. Then it will also become a prospectus. Once a document becomes prospectus, then chapter 3 prospectus and allotment of securities provisions shall apply. Understood? Now this chapter 3 prospectus related provisions are applicable to red herring prospectus, shelf prospectus and deemed prospectus. Next one, section 26, matters to be stated in the prospectus. So what are the matters we need to compile and we need to furnish in the document called prospectus? The answer is information and reports on financial information as may be specified by SEBI after consulting central government. So whatever information, whatever reports on financial information specified by the SEBI, you need to furnish that information, you need to provide reports on financial information in the prospectus. Along with that information, it is the duty of company to give a declaration stating that none of the contents of the prospectus or nothing contained in the prospectus is contrary to the provisions of Companies Act, the provisions of SEBI Act 1992, the provisions of Securities Contract Regulation Act 1956. That means the contents of prospectus, the things we furnished in the prospectus is following the provisions of Companies Act, is following the provisions of SEBI Act, is following the provisions of SCRA 1956. Nothing is contrary to these three statutes. Being a company, I need to follow Companies Act. And I am offering securities to the public, I need to follow SEBI Act 1992. And securities were involved. The subject matter is securities, so I need to comply Securities Contract Regulation Act 1956 too. Next one, prospectus is not applicable in two cases. One is when an offer is made to the existing members. See, existing members already they know about company. Already they know company principal objects. Already they know company performance, company position. You know, when you are going to the public, who doesn't have any idea about the company, it's your duty to communicate about yourself to the public. Existing members, they are traveling with company, so they know everything about company. So when you are offering securities to the existing members, no need to prepare prospectus. Understood? Next one, when an offer is made for existing securities which are already dealt on recognized stock exchanges. See, previously I offered 1 crore shares to the public. Out of 1 crore shares, I received applications for 95 lakhs. And I made allotment of securities for all these 95 lakh applications. Okay. Now balance 5 lakh securities. Now I am making an offer. I am making an offer for subscribing these 5 lakh securities. See, these 5 lakh securities belonging to a class which were previously offered to the public and which were already listed on recognized stock exchange. So this is an existing product. This is not a new product. This existing product already we advertised it to the public. Already we issued prospectus in past. So now when you are making offer for existing securities which belongs to the existing class, the same class which was already dealt on stock exchange, then also prospectus is not applicable. Understood? Now every prospectus shall be dated and signed by the persons authorizing the issue of prospectus. See, prospectus is like a document which creates contracts between company and prospective investors. Based on the prospectus, many people will file application for these securities and company will make allotment of securities to those applicants. Understood? So prospectus creates various contracts, multiple contracts between company and investors. So that prospectus shall be dated and it shall be signed by all the persons authorizing the issue of prospectus. Simply board of directors, CEO, CFO, company secretary. Next one, prospectus is having a limited validity period. Prospectus contains information and reports of financial information. Yes or no? Every year, company will prepare financial statements, profit and loss account to show a financial performance of the company, balance sheet, it will show financial position of the company. Yes or no? So every year that information gets changed. And listed companies, specifically listed companies, are required to furnish periodical financial statements every quarter. For every quarter they are required to prepare financial statements. So once 90 days is completed, the information which you prepared previously becomes outdated. and it is your duty to provide updated information to the public. That's why the prospectus will have always a limited validity period, and the limited validity period is 90 days after filing with ROC. Every prospectus before issuing to the public, it is the duty of company to file a copy of prospectus with ROC. From the date of filing with ROC, the prospectus will have a validity of 90 days. It's not 90 days from date of publication or date of prospectus. It's the 90 days after filing with ROC. And any contravention of above provisions, this is the applicable punishment. The punishment is company 50,000 rupees minimum fine, maximum 3 lakh rupees fine. And officers who are in default, yes, for them also the fine is minimum 50,000, maximum 3 lakhs. The punishment which is there in the material, it was recently amended, and the latest punishment is this one. Minimum 50,000, maximum 3 lakhs. Officers in default, minimum 50,000, maximum 3 lakhs. Next one, before you offer securities to the public, it is the duty of company to convert physical form of securities into demat form of securities. So what is the difference between physical form and demat form? Physical form, you can see it, you can touch it, you can feel it. Suppose this is a material. This is a material in physical form. I call it as material form. Now the document you are seeing in the system, soft copy, for example, soft copy, it is said to be in demat form. Or another example, money, 500 rupees. Suppose you are having 500 rupee note in your pocket. That is a physical money. And if the same money is deposited in your bank account, and the amount will be credited to your account. Now you can see it, 500 rupees. That demat money will not have any physical appearance, just account will be shown, account balance 500, and you can't see that denominations. Suppose how many 100 rupee notes are there, how many 50 rupee notes are there, how many 500 rupee notes are there. You can't see when money is in a bank account. Are you getting my point, students? Everyone. And money in your hands, it is risky. Someone can steal it, someone can rob it. And if you want to pay that money to your creditor, your creditor is in Hyderabad and you are in Tamil Nadu, then how can you pay that money? Through money order, or going to Hyderabad, paying that money to the creditor, yes or no? These are the possibilities for transferring money, for transferring ownership of the money. But if the same money is in your bank account, just simply entering the details of the creditor in Google Pay or Phone Pay, or creating some IMPS transaction, NEFT RTGS transaction, you can easily transfer that money in a secured mode, yes or no? So these are the primary differences between physical mode and demat mode. In physical mode, risky, unsecured, and there will be delay in transferring that things. As you all know, shares in companies are transferable from one person to another person. Of course, in private company we had restrictions, public company no restrictions. But if shares are in physical mode, it is very much difficult to transfer those securities in a faster mode, in a secured mode. But if the same shares are held in demat form, simply just giving instruction to demat broker, stock broker, yes, I sold all those shares. Now stockbroker will debit those number of shares from your account, to your account, and credit that amount of securities to the buyer account. So now you can tell me, yes, which one is most secured one and most fastest one, demat form. Now every company, before making public offer of securities, it is the duty of company to convert physical form of securities into demat form of securities. And not only the offer of the securities which were involved in the public offer, but also the securities which were held by the promoters. So all the promoters holdings before making public offer shall be converted into demat form. So this provision is not only applicable to the companies making public offer, but also to the prescribed public companies. Central government from time to time prescribe certain class or classes of public companies to convert their physical form of securities into demat form of securities. Once that rule is applicable to unlisted public companies, then they should convert them immediately, or else transfer of shares is not allowed. Transfer of shares by one member to another person is prohibited until company converts, and until that member converts physical form of securities into demat form of securities. Understood, everyone? Next one, advertisement. there is no condition or there is no restriction on the company to make advertisement of prospectus. There is no condition on the company to advertise its prospectus, but whenever company decides to advertise its prospectus, then that advertisement should contain following contents. Let me repeat one more time. There is no condition on the company to make advertisement of prospectus, but if company decides to advertise its prospectus, then that advertisement shall contain following contents. One is object clause of MOA. Object clause of MOA, principal business of the company. Next, nature of liability of members. Is it limited? In case of limited liability, limited to the extent of unpaid value, that means limited by shares, or limited to the extent of guarantee with share capital. Next one, signatories to the memorandum of association. Who signed memorandum of association? Simply subscribers. And next, number of shares subscribed by the signatories. Or simply give association clause with respect to these 2 points. So you will find signatories to MOA, and you can also find number of shares subscribed by the signatories at the time of incorporation of the company. And last one is capital structure of the company. Total capital of the company. In that, what is the debt portion and what is the equity portion? So capital structure of the company. So these contents you should provide in the advertisement. Clear? Next one, types of prospectus. Important area. Any 2 types can be tested for 7 to 8 marks. Understood? So total we are having 5 types of prospectus. 5 types: shelf prospectus, red herring prospectus, abridged prospectus, deemed prospectus, and finally offer for sale of securities. Offer for sale of securities. Total 5 types we are having. So first one, shelf prospectus. Generally prospectus will have a limited validity period. How many days prospectus is valid? 90 days after filing with ROC, yes or no? But this shelf prospectus will have a validity period of 1 year. 1 year from the date of first offer of securities. Why? Suppose I need 1000 crores money to complete a project, but I don't want 1000 crores at a time. I need 250 crores in first quarter, 250 crores in second quarter, 250 in third quarter, and 250 in fourth quarter. So I want money, each quarter 250 crores. Suppose if I collect entire 1000 crores on day 1, I can't utilize all 1000 crores on day 1. I can utilize only 250 crores, balance 750 idle. But the opportunity cost, having funds idle is very high. Shareholders' expectations, they will expect more and more returns, yes or no? But right now I don't want 750 crores. So what I will do? So I will make public offer 4 times in a year. How many times? 4 times in a year. But the point is, whenever you are making public offer, whether it is IPO or FPO, every public offer requires prospectus. Making prospectus is not a simple task. It is of some 500-600 pages document. Every time I need to recruit expert. Every time I need to file it with ROC. Every time filing with SEBI. Lot of compliance cost, lot of burden on the company. Moreover, my company key managerial person should allot their valuable time in preparation of prospectus. Yes or no? So if a prospectus is having a validity period of 90 days and one public offer, one prospectus, in that case I can't prepare 4 times prospectus for collecting money from the public, and I don't want complete money on day 1. So in that situation, the best alternative to me is shelf prospectus. So here what I'll do, first I'll issue shelf prospectus and I'll open I'll make a public offer. From the date of opening first public offer, from the date of first public offer of securities, this prospectus will have a validity period of 1 year. That means during this 1 year, I can invite public to subscribe my company securities without issuing further prospectus. That means during the period of 1 year, without issuing another prospectus, you can make n number of public offers. There is no restriction on number of public offers. You can make n number of public offers during this period of 1 year from the date of first public offer of securities under shelf prospectus. So this saves me a lot of time, lot of compliance cost. Understood? See, this benefit is generally given to the construction companies. So construction companies doesn't need money on day 1 itself. So construction companies will utilize the benefit of shelf prospectus. So securities included in shelf prospectus are issued for subscription in one or more issues over a certain period without issue of a new prospectus or another prospectus. And the validity of shelf prospectus is first public offer of securities under shelf prospectus, add 1 year. Then you will get the validity date of shelf prospectus. For second or subsequent public offers, you need to prepare a document called information memorandum. In that information memorandum, you need to furnish any new charges created by the company during the period between date of first public offer and date of second or subsequent public offers. Any changes in the financial position, provide that information, and any other material information. Suppose managing director retired, in the place of managing director new person was appointed, existing managing director resigned or existing managing director retired from the office, new person was appointed as a managing director. This is a material information, provide that information. Provide these 3 contents in the information memorandum. So the logic of information memorandum is, prospectus shall contain updated information. You issued shelf prospectus some 6 months back. Now you are making another public offer. So the things happened during these 6 months. You have to communicate with the public. You have to provide updated information to the public. For that, preparing one more prospectus, again, lot of complaints cost you have to bear. So that's why what lawmaker is expecting from you, you just compile this material information in a single document, and the document we call it as information memorandum. So whenever you are making subsequent public offers under shelf prospectus, issue information memorandum. First file a copy of information memorandum with ROC and then issue it to the public. Now the public, the persons who want to apply, who want to subscribe securities of the company, first they will go through the shelf prospectus and information memorandum. So shelf prospectus and information memorandum together, we call it as final prospectus under section 26. Now any person who have paid money in advance, some people looking at shelf prospectus, even first public offer is closed, they will file applications and they will pay money in advance. Now to those applicants, just give one intimation, just provide information memorandum to them. If they are willing to continue with the company, then make allotment of securities in those names. If they are willing to withdraw from the company, looking at information memorandum, we had no opinion, or we are not having an intention to continue with the company. In that case, refund those application money which was received in advance within 15 days from exercising the withdrawal option. So this is all about shelf prospectus. The crux point of shelf prospectus is, validity period 1 year from the date of opening, from the date of first public offer of securities under shelf prospectus. And shelf prospectus plus information memorandum, we call it as prospectus under section 26. Next type, red herring prospectus. Red herring prospectus. General rule, prospectus must contain complete information and correct information. Sometimes company may not have complete information at the time of preparing prospectus. For example, company is not sure with respect to issue price, or company is not sure with respect to quantum of securities to be offered to the public. Suppose company needs 600 crores money. Company wants to mobilize 600 crores money from public. How much? 600 crores. If issue price is 100 rupees, then they can offer 1 crore securities to the public. But if issue price is not known, then number of securities to be offered to the public is also unknown. Yes or no? Yes or no? Sir, why company is not having information with respect to price? Sometimes company, it can't fix the price. The reason is it is unable to gather the opinion of the public. Suppose one product is there. For example, one product is there. Company fixed the price of the product as 110 rupees. Now what public is thinking, 110 rupees overpriced. Why unnecessary, purchasing that product at 110? No need to purchase that product. Now what happens? Sales to the company will be 0. So manufacturing cost, everything, advertisement cost, promotions cost, everything will be lost to the company. Yes or no? Suppose, company decided to fix the price 90. Company offered the product at 90 rupees. Now what people, public is thinking, 90 rupees, this is underpriced. Even if it is 100 rupees, I can purchase that product. Even if it is 100 rupees, we can purchase that product. But the product is readily available at 90 rupees. Come on, we'll purchase. Now, you can see 100% sales in this at this level of price. 100% of sales at this level of price. But the point is, company is losing 10 rupee money. Why? What is the intention of the public? Even if the product is available at 100 rupees, we can purchase it. But since it is available at 90 rupees, everyone started purchasing the product. But company is losing 10 rupee per product. Opportunity cost. Getting my point, students? 10 rupees is opportunity cost. Yes or no? Now, that price 100 is not known to the public. That's why, not known to the company. I'm sorry. So here the exact price 100 rupees is not known to the company. That's why what company will do. So company will launch the product and company will ask public to fix the price. First, company will fix a price band like this, 92, for example, I'm telling 90 to 108 rupees like that, company will fix a price band. So 90 to 108, anyone willing to purchase this product, anyone willing to subscribe this product, please quote your amounts. And those amounts shall be not less than 90 and not more than 108. Now what people will do? People who want that product will file an application. Simply will file an application with the price. With the price they are ready to subscribe. You may get a doubt, sir. Many people can file application at 90 rupees. No, sir. In that case, what happens? If some people file application at 90 and if some people file application at 100, company will give priority to whom? Company will give priority to the applications which were quoted with price of 100 rupees. Yes or no? Now company will make allotment to the applicants who filed an application with 100 rupees. Yes or no? That means, people whoever filed application with 90 rupees, there is a chance of rejection. Yes or no? That's why, people who want those products, damn sure they will file application with best price. This entire process is known as book building process. When company is not sure with respect to price of the securities, when company is not sure with respect to quantum of securities to be offered to the public, since issue price is unknown, then company will ask market forces, demand and supply forces to fix the price. At what price, company received maximum number of applications, at what price the frequency is very high, company will finalize that price and company will fix that price. Understood? Now, before issuing final prospectus, here company will issue a prospectus with incomplete particulars, and that prospectus is known as red herring prospectus. So company will issue red herring prospectus prior to issue a final prospectus. And that red herring prospectus, before you open public offer, before you open subscription dates, it is the duty of company to file a copy of red herring prospectus at least 3 days before it. At least 3 days before opening of the offer, it is the duty of company to file a copy of red herring prospectus with ROC. And once market forces finalizes the price, finalize the price. Suppose issue price 100 rupees has been finalized. Now it is the duty of company to prepare a final prospectus. And you will find a time gap between red herring prospectus and final prospectus. Some 10-15 days gap you can expect. Today I am issuing red herring prospectus. Maybe within a week or 10 days, I know the quantum of securities and I know the price of the securities. So after 10 days only, I will prepare a final prospectus. Now any variation between contents of red herring prospectus and contents of final prospectus shall be highlighted. Variation shall be highlighted. And once the final prospectus is ready, it is the duty of company to file a copy of final prospectus with ROC as well as SEBI. This is complete information about red herring prospectus. Understood? So whenever company is not sure with respect to issue price or quantum of securities to be offered to the public, in that case company will go with a red herring prospectus option. Next one, abridged prospectus. Abridged prospectus, this is actually not a prospectus. This is actually not a prospectus. This is a document which should be accompanied, which should be attached to the application form. every person who want to subscribe the securities or who wants to purchase securities, definitely he has to file application with company. Now that application form, whichever the application form issued by the company shall be attached to this abridged prospectus. And it is a document, but it will not contain complete information. It will contain only material information. Generally prospectus is of some 500-600 pages document in India today. Active demat account holders means the persons who is having an account to trade securities. Actually today demat account holders, the total number of demat account holders is approximately some 2 crores, and document size is 500 pages, right? Prospectus document, imagine it is a 500 pages document. Suppose company wants to make a public offer and company wants to issue each and every copy of prospectus to all these 2 crore people, 2 crore persons in India. Now 2 crores into one copy of prospectus means how many copies we need to publish? 2 crore copies. Each copy 500 pages. Imagine printing cost per document 10 rupees only. Cheapest to cost. Imagine 500 pages document 10 rupees, sir. Imagine, just imagine, 10 rupees. Now 2 crore documents into 10 rupees means 20 crore rupees we need to invest on printing of the prospectus. Again for circulation, postal charges, imagine another 20 crores. No return, actually 40 crore rupees. Definitely it's a burden on the company. Company is making a public offer. Imagine company is making a public offer of just 100 crores. Out of 100 crores, again 40 crores for expenses. I'm asking you, is it worth? Okay, forget about company. Let's speak about investor. Investor will have a time of just 7 to 10 days for making an application for subscription or purchase of securities. During this 7 to 10 days, do you think investor will read all the contents of the prospectus? Do you think all 500 pages he will read thoroughly and he will make a wise decision? It's not possible. So considering these two aspects, lawmaker came up with a separate document called abridged prospectus. This abridged prospectus will contain only material information. Prospectus will contain complete information, whereas abridged prospectus will contain material information like litigations on the company, directors of the company, achievements of the company. That's it. So only material information which can influence the decision making of the readers of the prospectus. So generally this abridged prospectus will be around some 40 to 50 pages. And company should not issue application form individually. Company shall not issue an application form in an isolated manner. This application form, first of all, it should be attached to abridged prospectus. Now we can make an assumption, every person filing application with company, we assume that he has gone through the abridged prospectus. Now his time will be saved, and printing cost, postal charges of the company can also be saved. But the point is, a person going through abridged prospectus, a person reading abridged prospectus, if he had a doubt or if he wants more clarity and if he wants to read complete prospectus, then he can request company for complete prospectus. In that case, it is the duty of company to issue complete prospectus to the person who made a request for it. Understood? And one more point, abridged prospectus is not applicable in 2 cases. One is when offer is not made to the public. When offer is made to the existing members, or when offer is made to the existing, identified persons, existing members or identified persons. In that case, there is no public offer. In case of no public offer, no need of abridged prospectus. Second one, when an offer is made to the underwriters, when an offer is made to inviting underwriters to enter into the underwriting agreement for such securities, in that case also abridged prospectus is not required. Understood? Of course, I know this concept is already outdated one. Why? Today everything is available on website, company websites, SEBI websites, stock exchange websites. You can download it. But previously, when this provision was framed, that much advanced technology is not available. So previously, prospectus physical copy used to be circulated. At the time, this concept is very helpful. Okay, fine. Next one, if company makes any default, that means, company issued application form without abridged prospectus, or company failed to issue complete prospectus to the person who requested for complete prospectus. In these two defaults, in the case of default, company will be penalized with 50,000 rupees amount. So for each and every default, company is liable to pay a penalty of 50,000 rupees. So this is all about abridged prospectus. Next one, offer for sale of securities. Offer for sale of securities. Generally, public offer contains two offers. One is a fresh issue of securities. The other one is offer for sale of securities. Under fresh issue of securities, company for the first time it will create a capital and it will issue to the applicants. So whatever money company receive from fresh issue, under fresh issue, company can use that money. Company can spend that money on the stated objects. The second one is offer for sale. Under offer for sale, what happens, company will take securities of the existing members. Suppose, promoters authorize company to sell their shares to the public. Now, company will take shares from the promoters and the same shares, company will offer to the public. Whatever money company receive from the public with respect to offer for sale, that money, company will refund to the promoters. Company will reimburse the promoters. So here a single rupee company will not utilize for its objects. Generally promoters, in order to liquidate their holdings, in order to sell their holdings, will choose this option. Sir, why? See, 20 years back, imagine 20 years back, I started one company. I invested everything in this company. So right now, the asset I'm having is investments in the company. The worth of the investments, for example, 200 crores. Now I want to start another business, another company. For that I need 50 crores money. Right now I am having only one asset, that asset is investment in this company. Now what I will do, I'll authorize the company. Come on, 50 crores worth of securities I am giving to you. Please offer those securities to the public. Collect amount from the public and give it to me. So that what I can do with that money, I can set up a new business. I can start a new company. Understood? So to liquidate promoters holdings, this is the best option. Even recently, Kalyan Jewelers company also made offer for sale of securities. So promoters sold some investments under offer for sale of securities. Once again, I am telling you, issue is of two types. One is fresh issue, where company receive funds for fulfilling the stated objects. The other one is offer for sale. Under offer for sale, whatever money company receive, it will pay back that amount to the promoters. So conditions for offer for sale, approval of board of directors of company is required. Authorization is required. Next one, whatever offer company is making to the public, offer of sale of securities to the public, it is deemed to be prospectus and it is required to comply section 26 provisions. And next one, approval of the company is required, obviously. Next one, reimbursement of expenses. Making the prospectus, filing with ROC, filing with SEBI, recruiting experts in preparation of the prospectus, everything, company has to spend money. And these expenses, company will not charge its profit and loss account. Company will get reimbursement from the members who authorized the company to sell their holdings. Understood? That means, company will get this amount from the promoters who authorized the company to sell their holdings. So reimbursement of expenses. Suppose, 50 crores offered to the public and total expenses incurred by the company for making this offer is some 75 lakhs. So out of 50 crores it collected from the public, it will deduct 75 lakhs. Balance amount will be given to the promoters. Next one, all the provisions of this chapter are applicable to this offer for sale of securities except these four things. One is minimum subscription. Why? This is not a subscription. This is a sale. This is not a sale. Sorry, this is not a subscription case. This is a sale case. Company is not offering a fresh securities. It is offering existing securities which were already held by the promoters. So there arises no concept of allotment. Allotment will not come into the picture. Just what company is doing, company will take shares of the promoters and company will give it to the public. So here allotment related conditions like minimum subscription, minimum application value are not applicable. Next one, board of directors statement in respect of utilization of money. How you are going to utilize this money. So to what extent you utilize this amount. So these statements are not required. Why? Whatever amount company collects from the public, everything will be given to the promoters. And any other prescribed provisions are also not applicable to offer for sale of securities. Next one, disclosure. So you have to disclose the person who is bearing this cost of making offer of sale. Simply, promoter name. Why? Company is offering securities of the promoter. Promoter wants to decrease his holdings. Promoter name you will find in the disclosures. Next one, variation of terms in objects of prospectus. For one purpose you collected money from public. You told that I will set up an automobile manufacturing unit and I want some 1000 crores. So showing that reason you collected 1000 crores money. 900 crores you spent on fulfillment of the object. Additional 100 crores, balance 100 crores remain idle. You thought 1000 crores is required for fulfillment of the object and you asked public subscribed all those securities. Public gave 1000 crores. Out of 1000 crores, yes, 900 crores is sufficient for fulfillment of the object. Balance 100 crores remained idle. Now, company wants to utilize this balance amount for another purpose. For using that balance money for another purpose, it is required to comply these provisions. Why? You told one object, automobile, but you want to utilize money for another object. So for that variation, it is very important to get a prior approval from the members. So call for a general meeting. Ask members to pass a special resolution. If members pass special resolution, then you can change the terms in the objects. You can change the terms or objects of the prospectus. See, prospectus creates contract between company and applicants. Yes or no? Company and investors. If you want to modify the terms of the contract, mutual consent of the parties is required. Yes or no? Novation, new contract in the place of old contract, it requires mutual consent of the parties. So company should ask investors whether I can use balance amount for another object. So it is required to take approval from the members. So special resolution is compulsory. And for calling that meeting, you have to give notice of meeting. In that notice, you have to specify the following contents. What is the original purpose? Why you raised money? How much amount you raised? How much money you utilized? And extent of achievement of the object. 100% achieved, sir. What is the unutilized amount? And what is the proposed variation? Why you want that new object? Why you want that new object only? Reasons or justifications. And what is the proposed time limit for achievement of new objects? And what are the risk factors associated with the new objects? And any other relevant information. So if you provide this information, then investors will make a sound decision, a reasonable decision. Along with the notice of general meeting, you need to advertise the same thing in two newspapers. One is vernacular newspaper and the other one is English newspaper, and publish a copy of notice on the website of the company. Now you can utilize that balance idle funds for any purpose other than speculation activities. Suppose 100 crores funds is there, no sir, stock market, it is rising, sir, it is rising. So let's invest 100 crores in the stock market. Maybe in day one, maybe in 10 days or 15 days or 1 month, the money will be doubled. The chances of doubling the money, the chances of, the money getting increased equal to chances of losing the money. In share market, if you observe, if you take 10 investors, 9 out of 10 investors are at loss only. On an average, each and every investor is losing 50,000 rupees money. I'm telling average basis. 9 out of 10 investors are at loss. Only the one investor who can make a sound decision, who can make a reasonable decision, he is entering at low levels and he is he exit at upper levels and he earn a profit. Now if company use that funds making investments in the stock markets, what happens? So chances of losing money is very, very high. So that money belongs to the public, and how can you keep that funds in risk? That's why prohibition on speculation. You can't utilize balance funds for making investments in stock markets. And last one, give exit offer to the dissenting shareholders. Suppose 95% of the investors casted vote in favor of variation. Only 5% are against to the variation. No, we don't want that variation. Now call them for a meeting. So promoters, you just give them an offer. Promoters must give an offer to the dissenting shareholders. Dissenting shareholders means shareholders who are against to the proposal. So promoters must promoters must give an exit offer according to the terms and conditions, according to the provisions of SEBI. So exit offer means what? An option to exit. So okay, dissenting shareholders, you are holding 5% of paid up share capital of the company. The value is around, for example, 5 crores. So take this 5 crore money and surrender your shares. It's like sale transaction, transfer transaction. An important point you have to remember is exit offer is not given by the company. Exit offer is given by the promoters or controlling shareholders. If exit offer is given by the company, we call it as buyback. It's not a buyback, okay? And moreover, if company makes buyback, company idle funds will come down. When idle funds come down, how can it invest in a new object? Logic only, right? It's a logic. So that's it, ma. So this is all about variation of terms in objects of the prospectus. And next one, listing of securities. So before you make public offer, you have to file an application with one or more recognized stock exchanges, National Stock Exchange, Bombay Stock Exchange, and you need to get approvals regarding listing of securities. Now listing means simply getting a permission to trade company securities on the stock exchange platforms. Disclose the name of stock exchanges in the prospectus and open a separate bank account for depositing all the monies of the applicants. And this application money shall be utilized only for two purposes. One is adjustment against allotment. If you allot securities, you can withdraw that money and you can utilize for company business objects. Unable to make allotment, then refund all those monies. Refund all those monies. Only for these two purposes, company can utilize this money. Separate bank account means, a bank account on which company will not have any control. A separate bank account for the purpose of depositing application money. So this money can be utilized only for two purposes. One is allotment against adjustment. The other one is repayment of money in case of unable to allot. And in prospectus, if you find any condition to waive compliances, that means even we didn't receive listing approvals, even we didn't receive minimum subscription, even we didn't receive minimum application money, we will make allotment of securities. Any compliance will be waived off. Compliances with respect to allotment will be waived off. If you see such conditions, those conditions becomes null and void. Those conditions will be null and void. It's similar to agreement in restraint of legal proceedings, agreement in restraint of trade, like that, agreement in restraint of marriage. Did you remember these concepts? You studied at CA Foundation. So condition to waive compliance, such conditions will become null and void. Next one, punishment for violation of these provisions. Company 5 lakhs to 50 lakhs, defaulting officer 50,000 to 3 lakhs. So this is a amended punishment. This is the recent punishment. After amendment, whatever the latest punishment is there, I gave it in the notes. Next one, payment of underwriting commission. Payment of underwriting commission. Generally for making allotment of securities, company has to satisfy one major condition, that is minimum subscription. So what is minimum subscription? How much is the minimum subscription? Minimum subscription is 90% of issue size. Suppose you are offering 1 crore securities. Out of 1 crore, 90% is the minimum subscription. That means 90 lakh. You should receive applications for 90 lakh securities. Or amount or size stated in the prospectus, whichever is higher. Suppose you stated 92 lakhs as minimum subscription. In this case, whichever is higher means 92 lakhs. So company should receive applications for at least 92 lakhs securities. Then only company can proceed with allotment of securities, or else company has to refund all the application monies it received during offer period. Are you all getting my point? Now that means, for making allotment of securities, there is one risky element, that is minimum subscription. So we don't know whether, public accept company or not, whether public will apply for 92 lakh securities or not, we don't know. To avoid that risk, to mitigate that risk, generally companies will enter into an agreement with underwriters. Underwriters are like, marketing agents. Underwriters, the nature of their business is like marketing agents. So they will go to public, they will go to their customers, clients, and they will motivate them. Sir, you invest money in this company, your money will be safe and you'll get good returns, sir. So, for doing those activities, generally they are eligible for remuneration. And that remuneration, we call it as underwriting commission. So whenever company wants to pay underwriting commission, the company has to satisfy all these conditions. First, AOA authorization. authorization from AOA. And for the payment of underwriting commission, you can utilize the profits of company or issue proceeds of that public offer, or it can utilize both. So sources for payment of underwriting commission is profits of the company, issue proceeds, or both. Next one, rate of underwriting commission. There is a ceiling limit on rate of underwriting commission. With respect to shares, maximum underwriting commission is 5% of issue price. Coming to debentures, 2.5% of issue price, or rate prescribed in AOA, whichever is lower. That means, Companies Act is placing a ceiling limit on underwriting commission. In case of shares, maximum 5% of issue price. In case of debentures, maximum 2.5% of issue price, or rates mentioned in AOA, whichever is lower. Next one, it is the duty of company to disclose the following contents in the prospectus. So name of the underwriters, rate of underwriting commission, amount of underwriting commission, and number of securities underwritten. And again, all the documents relating to underwriting agreements shall be filed with ROC. And one important condition, underwriting commission on securities not offered to public is prohibited. Suppose 20% of securities should be subscribed by the promoters. Now these are the securities not offered to the public. If securities are not offered to the public, then company is not allowed to pay underwriting commission on those securities. So these are the conditions for payment of underwriting commission. Next one, allotment of securities. Allotment means what? Appropriation out of unappropriated capital by the board of directors to the applicants of securities. So appropriation out of unappropriated capital, that means it's a fresh capital. Previously it was not appropriated, it's a fresh capital. Now against this capital, whatever the applications received by the company, what company will do, what directors will do, they will make appropriation. They will divide that capital into parts, units, and they will give it to the applicants. So this is technically called allotment. And I told you, these allotment provisions are not applicable in case of offer for sale of securities. Why? Previously it was already appropriated capital. It was offered to the existing shareholders. It was subscribed by the existing shareholders. Now existing shareholders authorized the company to liquidate their holdings, to sell their holdings. So in that case, allotment provisions will not apply. That's why minimum subscription, minimum application value provisions will not apply in case of offer for sale of securities, I told you. So for making allotment of securities, company has to satisfy two conditions. One is minimum subscription and the other one is minimum application value. Minimum subscription, just now I discussed with you. Minimum application value, per security, minimum application value is, as per Companies Act, 5% of face value. As per SEBI, 25% of issue price. Sir, now which one I should follow? Are listed companies in the process of listing should comply the provisions of SEBI. So accordingly, 25% of issue price is the minimum application value. Now it is the duty of company to comply these two conditions within 30 days of date of issue of prospectus. If these two conditions are satisfied, make allotment of securities, file return of allotment with ROC within 30 days of allotment. Sir, one condition not satisfied, sir. Two conditions not satisfied, sir. Then refund within 15 days from the issue closure date, from the offer closure date. So by the time offer gets closed, you will know, you can easily assess whether minimum subscription received or not, whether minimum application money received or not. If not received, refund within 15 days from issue closure date. Failed to refund, then defaulting directors are liable to pay interest at the rate of 15% per annum. Who are liable to pay interest? Defaulting directors. The directors who are responsible for such default liable to pay interest at the rate of 15% per annum. See, each and every point is important from multiple choice question point of view. Maybe this concept is not tested for this concept is not tested as a question for 7 marks or 8 marks, but this concept can be tested for 1 mark or 2 marks multiple choice questions. So each and every point you have to pay attention. And previously I told you, these marathons are for the students who already completed one-time preparation. So first time readers or first time listeners, if you listen to marathon, trust me, you will feel that subject is very tough, subject is very difficult, and you may quit CMA. That thing I don't want. So before listening to the marathon, please complete at least one time reading. Then you will get 100% benefits of this marathon. Trust me. Okay. So what are the two conditions for making allotment of securities? Minimum subscription, minimum application money. In case of default, default in filing with ROC or default in making refund, then company as well as defaulting officer is liable to pay penalty. How much? 1000 per day, maximum 1 lakh rupees. For each day default, 1000 rupees, maximum 1 lakh rupees. That means 10 days delay, 10 into 1000, 10,000. 50 days delay, 50 into 1000, 50,000. 90 days delay, 90 into 1000, 90,000. But it is restricted to 1 lakh rupee. Now, when company is filing return of allotment with ROC, in PAS 3 form, they need to attach some documents. First thing, list of allottees, details of allottees, name, surname, occupation, number of securities subscribed, number of securities allotted, everything you need to furnish. And in case of cash consideration, just furnishing list of allottees, details of allottees is sufficient. In case of other than cash consideration, that means you are making allotment, but you are receiving not cash, you are receiving a property, you are receiving a land and a building, or you are receiving some services from the service provider. In that case, you have to attach a duly stamped contract copy. First of all, there may be a contract between you and allottee. Based on that contract only, you might have made an allotment. So furnish that contract copy. Along with that, registered value or valuation report. Share value, how much company fixed as a share value, issue price. Is there any supporting with respect to issue price? Yes, sir. Valuation report, furnish it. Valuation report is compulsory. Next one, in case of bonus issue, resolution copy is sufficient. For making bonus issue, members' approval in general meeting is required. That resolution copy is sufficient. Along with list of allottees, details of allottees, file a resolution copy in case of bonus issue. In these two situations, company will receive consideration other than cash actually. Now you need to attach these documents. Next one. Bonus issue, company will not get cash consideration, but what company will do? Company will capitalize its profits. So certain portion of profits will be transferred to capital. It's an internal accounting adjustment. But as per the books of accounts, company is receiving something from profits and it is crediting to capital. Next one, misstatements in prospectus. Misstatements means what? False information or omission of material information. Actually, company is having a turnover of 60 crores, a profit of just 6 crores. But in prospectus, what company is telling, turnover is 600 crores, profit is 60 crores. Purely false information. Omission of information. Suppose company is paying dividends last 10 years. Company every year it is paying dividends. But those dividends are not from revenue profits. Those dividends are from capital profits. Imagine, every year it is selling some assets and it is getting some capital gains, profit only. From that profit, company is paying dividends. Understood? What company is telling? Every year company is paying a dividend of 10% for the last 10 years, but those dividends are not from revenue profits, those dividends are from capital profits. So from capital profits, the word is ignored in the prospectus. What generally public think? Oh, company is paying dividends regularly every year 10%. That means whatever we make investment, within 10 years we will get our investment, and our investment will be an additional benefit to us. So 10 years, each year 10% we are getting, right? So by the end of 10th year, whatever amount I invested, I will get it. And moreover, I am the owner of the company. Like that they will think. But the point is, at one point of time, total assets becomes zero. Now from where they get profit? How they can pay dividends? So omission of material information. Either furnishing false information or omission of material information, we call it as misstatement in the prospectus. And the effect of misstatement in the prospectus is, section 34 criminal liability, section 35 civil liability. If section 34 is attracted, then person authorizing issue of prospectus will be punished under section 447 punishment for fraud. What is section 447? Just wait a couple of minutes, I'll discuss with you, I'll revise it with you. But there are two exceptions. If you are able to prove that misstatement is immaterial, sir, I agree with that misstatement, there is a misstatement, but it is immaterial, sir. It's a small amount only, sir. Or if he has a reasonable ground to believe that misstatement is true at the time of issue of prospectus. Suppose I had all the approvals for making public offer, for making for starting a new business. It is true. I issued that prospectus, I collected money from public. Subsequently, change in government policies leads to cancellation of my approvals. Before I had approvals, right now I am not having approvals. Right now, the statement which I made that, I got all approvals for starting this business, that statement became, invalid. Why? Change in government policies. Now, if you are able to prove like this, yes, sir, at the time of issue of prospectus, there is no misstatement. It is not a misstatement at all. Subsequent to issue of prospectus, it became a misstatement, sir. It became a false information, sir. If you are able to prove any of these two grounds, if you are able to cover under these two grounds, if you are able to cover under any of these two grounds, then you will not be punished under section 447. Next one, civil liability. Company promoters, directors, proposed directors as well as expert, they should compensate the loss of investors. Because of misstatement in the prospectus, what happened, subsequently the value of the shares fallen. Issue price is 100 rupees. When markets came to know misstatement in the prospectus, because of high sales, because of huge supply of securities in the market, and the demand is very less, when supply exceeds demand, you all know price falls, elasticity concept, right? So whenever supply increases, whenever supply exceeds the demand, automatically it leads to the fall of prices. Now, I subscribed security at 100 rupees, right now it is 40 rupees. So per security 60 rupees loss to me, and I subscribed to 1 lakh securities, to me 60 lakhs rupees is the loss. And it is the duty of company, promoters, directors, proposed directors, expert to compensate my loss of 60 lakhs. Of course, 3 exceptions are there. One is, the person who authorized issue of prospectus had withdrawn the consent before issuing to the public. So I withdrawn my consent to the prospectus, sir. Or I gave notice to the public. My name is wrongly included in the prospectus. Don't believe that I am a person authorizing the prospectus. I am not a person to that prospectus. Or, sir, I gave my consent to the prospectus on the faith of expert. So expert made some calculations, and there are errors in the expert calculations, sir. I'm not having that much expertise knowledge. On the faith of expert statement, I gave my consent, and subsequently it was proved that expert gave a wrong statement. So this is not my mistake. This is not my intentional mistake. So if you are able to prove like this, then you will be exempted from this punishment. Next one, punishment for fraudulently inducing persons to invest money. Sometimes, these underwriters, marketing agents will induce you. You invest 100 rupees in this company, you will get 300 rupees return by the end of the year. Now, generally people, with having greedy intentions, what they will do, on the faith of this person's statements, they will make investment in the company. They will acquire securities of the company, or they may subscribe the securities of the company. At the end, people came to know that all the statements are wrong. These people fraudulently induced us to invest money in the company. Now the fellows, the persons whoever make such statements recklessly, with fraudulent intention, those people will get punishment under section 447. Generally, why we make false statements, so to acquire securities of the company or to sell the securities. Suppose, I'm spreading a false information, company is at huge loss, come on, sell the shares immediately and purchase at lower prices. Public thought it's a genuine statement, and public, what they did, they started selling the securities. Suddenly the price of securities fallen. When supply exceeds demand, price will fall. Now, this fellow making statement, he is acquiring those securities at cheaper prices and selling them at higher prices. Yes or no? Generally, if a false information is known to the public, they will start selling it. And when they come to know, yes, it's a false statement, it's not a correct one, they will start acquiring the shares. they will sell at lower prices, acquire at higher prices. You can see fluctuations in the value. Yes or no? There are some fluctuations in the value. These fluctuations we are creating artificially in order to secure profits. Or sometimes we may go to banks and we will furnish some false information for getting credit facilities. Now the persons whoever engaged in these cases will get punishment under section 447. What is section 447 punishment? See, if public interest is affected in that situation, then the punishment is fine, minimum amount involved in the fraud, maximum 3 times of the amount involved in the fraud. Suppose public lost money, example 1 crore rupees, 1 crore rupee public interest was affected, 1 crore rupees, public lost total 1 crore rupees. Now the person responsible for that fraud, minimum he is to pay 1 crore, maximum he is required to pay 3 crores. And minimum imprisonment 3 years, maximum imprisonment 10 years. Sir, no public interest, sir. There is no damage to the public, sir. Public assets, public interest is safe only, sir. Then compare amount of fraud involved with 1% of turnover or 10 lakhs, whichever is lower. If amount of the fraud is greater than or equal to 1% of turnover of the company or 10 lakhs, whichever is lower, then fine is minimum amount involved in the fraud, maximum 3 times of the amount involved in the fraud. Imprisonment minimum 6 months, maximum 10 years. Next one, sir, fraud amount is less than 1% of turnover or 10 lakhs, whichever is less, sir. Suppose turnover is 1 crore, fraud is 50,000. How much fraud? 50,000 is the fraud. Turnover how much? 1 crore. Now the point is 1% of 1 crore or 10 lakhs, whichever is less, means 1% of 1 crore means how much? 1 lakh, or 10 lakhs, whichever is less, here the figure is 1 lakh. Now compare amount of fraud with this amount. Sir, amount of the fraud is 50,000. 50,000 is less than 1 lakh, sir. Acha. Then it is a case fallen here. Of course, public interest should not affect. If public interest is affected, then don't compare the amounts. Straight away come to this situation, apply this punishment. If public interest is not affected, then compare the amount of fraud with turnover or 10 lakhs, whichever is less. Suppose public interest not affected and fraud is of lesser magnitude, then imprisonment may be up to 5 years, fine may be up to 50 lakhs, sometimes both 1 plus 1. Understood? Next one, personation of securities. Personation means changing identity. See ma, there is a restriction, maximum you can apply for 13 lots of securities. Like that, there is a restriction. You can file 13 applications. Or you can apply for 1,000 securities. Best example, 1,000 securities. Beyond 1,000 securities you can't apply, because it's a public offer. Everyone should be given equal opportunity. If you subscribe 100%, then what about the public? So you can file application only for up to 1,000 securities. Like that, a point is there in the prospectus. Now for getting more and more number of securities, what you are doing, you are filing applications in fictitious names. The persons, they are not in existence. Or you are filing application in different names. Suppose my name is DV Subramaniam. One application I am filing with the name DV Subramaniam, another application with Subramaniam, another application with D Subramaniam, and fourth application with V Subramaniam. Now you can see 4 applications I filed in different names. Or inducing company to allot securities in fictitious name. If I was covered in any of these 3 cases, if I am covered in any of these 3 cases, then my punishment will be section 447. And all the securities I am possessing at the time will be seized and disposed in the market. Whatever money the authority collects from me, that amounts will be credited to IEPF account. So you have to disclose this punishment. You have to disclose, personation is a crime. Like that, you have to disclose the point in prospectus as well as in application form. And the last concept is private placement. So public offer completed, now private placement. See, generally if a company is having an intention, no, I don't want to share ownership with public, I want to share ownership with the persons who will have a like-minded, who can support me. Suppose I'm the promoter of the company. I don't want to share my ownership with public, with unknown people. I don't want to share my ownership with unknown people. I want to share my ownership with the persons who are like-minded, who can support me in making a decisions, who can assist me in carrying business operations. So in that case, you can offer securities under private placement, placing securities privately. So here company will identify people to whom securities will be offered. These people, number of persons, there is a restriction. The maximum number of persons you can make private placement is 200, and this 200 limit is per security per financial year. Suppose in my company there are three types of securities: equity, preference, debentures. Now I can make private placement up to 200 for equity, up to 200 for preference, up to 200 for debenture. And this limit is per financial year. 1 year I made private placement for 200. Next year I can make private placement up to 200. And while counting the 200, two people are excluded. One is qualified institutional buyers. The second one is employees. And this limit of 200 persons is not applicable to housing finance companies, non-banking finance companies. Next one, before making private placement, you should get authorization. From whom, sir? From who should authorize, sir? It depends on security. If security is a equity or preference, convertible debentures. Convertible debentures means debentures at the time of maturity, at the time of redemption, they will be converted into equity. If securities are equity or preference or convertible debentures, then you need to take a special resolution from the members at general meeting. For that, you need to issue notice calling for meeting. In that notice, you have to furnish reasons of making private placement, justifications of making private placement, number of securities offered, issue price how much, everything, every material information company has to communicate with members before taking special resolution. In case of non-convertible debentures, just compare your debt capital, outstanding debt plus new debt. If it is greater than 100% of paid up share capital plus free reserves plus securities premium, then one time special resolution for each year is required. One special resolution for one financial year is required. Suppose if outstanding debt plus new debt is within the limit of 100%, two debts, outstanding debt plus proposed debt, put together less than or equal to 100% of paid up share capital plus free reserves plus securities premium, then board resolution is sufficient. Board approval is sufficient. Next one, the company has to circulate this private placement document within 30 days of recording the names in the document. And renunciation benefit is not. Renunciation means, if you are not willing to subscribe or not willing to purchase securities, you can transfer that right to another person. That renunciation benefit is not there. And any interested person who wants to subscribe securities, he has to make payment through banking channel. Cash mode of payment is strictly prohibited. RTGS, NEFT allowed. Separate bank account. For receiving application monies, company has to open a separate bank account in a scheduled bank, and that money shall be adjusted only for two purposes. One is either allotment or refund. Allotment should happen within 60 days of receipt of application money. If you are unable to make allotment, then refund within 15 days after expiry of 60 days. Failed to refund, then company is liable to pay interest, not directors. Company is liable to pay interest at the rate of 12% per annum from the expiry of 60th day. That means for this 15 days also, company is liable to pay interest. Along with overdue period, to this 15 days also interest is applicable. Next, ROC filing. Whenever company makes private placement, before issuing private placement document, file a copy with ROC. And whenever company makes allotment, file a return of allotment with ROC within 15 days. A default in filing with a return of allotment. Default in filing return of allotment with ROC, company, promoters, directors will be penalized. And the punishment is 1,000 per day, maximum 25 lakhs. And since it is a private placement, advertisement is strictly prohibited. No fresh offers can be made when existing private placement is pending. So previous private placement, either it should be completed or it should be cancelled. Then only you can make fresh private placement. Keeping previous private placement pending, you can't make fresh private placement. A non-compliance of section 42, that means you are making offer to more than 200 persons. You are not complying other conditions. In that case, we will assume it as deemed public offer, and we will apply prospectus related provisions here. First, you need to refund all those monies, and company, promoters, directors will be punished with amount of rupees, amount raised through private placement or 2 crores, whichever is less. Suppose amount raised through private placement is 50 lakhs. 50 lakhs or 2 crores, whichever is less, means 50 lakhs. So company has to pay 50 lakhs, promoters 50 lakhs, directors 50 lakhs for violation of section 42. And irregular allotment, with this all the questions in prospectus and allotment of security are revised. Irregular allotment means which is not a regular allotment. For making allotment of securities, company has to comply these conditions. First it is required to issue prospectus. It has to file a prospectus with ROC. That prospectus should not contain misstatements, and company should satisfy minimum subscription and minimum application money conditions. Company must list its securities. So non-compliance of any of these provisions, and if you are proceeding with allotment of securities, we call it as irregular allotment. Irregular allotment means allotment without fulfilling these conditions, without issue of prospectus, without filing prospectus with ROC, without prospectus containing misstatements, without minimum subscription, without minimum application money, or without listing of securities. If any allotment happen, then that allotment we call it as irregular allotment. Consequences of irregular allotment, that allotment is invalid, void. Company has to refund all the monies to the applicants, and company has to take back the securities issued in the name of applicants. Understood? So with this prospectus chapter revision marathon completed. See, whatever notes I prepared, I compiled, it is from the study material only. So everything I taken from the study material only. So you can verify, and you can, if you have any doubt, you can ask me. One more point I forgot is, for variation of objects in the prospectus, voting shall be passed, a resolution shall be passed through postal ballot. So what is this postal ballot? I'll discuss with you in management and administration chapter. Some points like voting resolutions through postal ballot, some points are there. I'll discuss it with you in management and administration chapter. So in the same order, I prepared revision notes and I revised all those contents. Is it clear, everyone? And let's continue marathon with the next chapter, acceptance of deposits, section 73 to section 76A. So for this, I already prepared a notes. I'll show you that notes. I'll revise this chapter using notes. Deposit means any receipt of money by way of deposit or loan. Company receiving money in the form of deposit or in the form of loan or in any other form, we call it as deposit. And a deposit excludes certain categories of amounts received by the company. Sir, what are those categories? So total you can see in the material approximately some 18 points are there, 17 points are there, and you need to remember all these points. So these are the exempted deposits. So significance of exempted deposits is the provisions of chapter 5, acceptance of deposits, and rules made thereunder are not applicable to these 17 exempted deposits. So first of all, deposit includes any receipt of money by way of deposit or loan or in any other form by the company. So it's a general definition. Any receipt of money in the form of loan, in the form of deposit, in any other form. In any other form means it is also an incidental to loan or deposit only. Advances, for example, advance. So any amount received by the company in advance or any deposit or loan, we call it as deposit. But this deposit excludes 17 amounts. What are those amounts? Amount received from the following persons. Government, state government or central government, local authorities, statutory authorities, foreign governments, foreign banks, foreign international banks, foreign public financial institutions, local banks, loan facility with local banks, State Bank of India, Axis Bank, and public financial institutions like LIC. Next one, loan from another company, intercorporate borrowings, loan from directors, loan from relatives of directors in case of private limited company. Next one, employees, getting a security deposit from employees. If that security deposit of up to 12 months salary, and if it is a non-interest bearing security deposit, then it is not a deposit. Next one, unsecured loans from promoters because of a condition imposed by the banks at the time of lending money. Some generally, banks will lend money against promoters contribution. So yes, they will impose a stipulation, or they may impose a condition. If promoter contributes 20% of required funds as an unsecured loan, then we can finance you balance 80%. Now based on bank stipulation, promoter is giving a loan to the company. Now that loan is also not a deposit. So simply remember these categories, persons, government, local authority, statutory authority, foreign government, foreign banks, public financial institutions, another corporates, another companies, directors, employees, security deposits, unsecured loans from promoters regarding persons. Next one, security application money. Just now I discussed with you private placement, right? In private placement, I told you within 60 days of receipt of application money, company has to make allotment, or else refund all those monies within 15 days from the expiry of 60 days. So up to 60 days, that security application money with company is not a deposit. Next one, amount received for subscribing, bonds, debentures, listed debentures, secured debentures, convertible debentures, not a deposit. Next one, amount received in order to hold it in a trustee capacity. So we were appointed as a trustee, and we received an amount, some loan amount or some advance amount, or holding that money in a trustee capacity. It is also not a deposit. Business advances, received advances from customers. For example, if you want to take a Reliance Jio fiber subscription, initially we will pay 6 months internet charges to the company. That 6 months internet charges is an advance money, and it will be remuneration only after completion. It is an income to the company only after completion of each and every month. 1 month completed, that portion of advance amount will be recognized as income, turnover. 2 months completed, second month income will be added, advance will be received. Now until the completion of time period, it is an advance in the books of accounts of Reliance companies. Yes or no? Now business advances are also not treated as deposits. Next one, security deposits. And last one, amount received by Nidhi company from its members. So all these amounts are not deposits. Actually, for each and every point, some 5 to 10 minutes explanation is there for CA Inter students, but in CMA that much syllabus is not there. So why to waste your precious time? That's why I'm just giving you a list. Detailed explanation of these points is not at all required. Even if you open your study material, even if you go through your study material, you will find only these points, these 17 points you will find. So simply I'm just giving you a list. I'm not giving you a brief or I'm not revising briefly about each and every point. So amounts received from these persons, amounts received by, because of issue of securities or issue of bonds, issue of debentures. Next one, amount received in the form of, a company was appointed as a trustee and company received amount. Business advances, security deposits, Nidhi company deposits are not treated as deposits. Next one, depositor. Sir, who is a depositor? Member is a depositor for all companies. Companies can accept deposit from its members. So for all companies, member is a depositor. Coming to eligible company, eligible company can accept deposits from both members as well as non-members. So in case of eligible company, depositor may be a member, depositor may be a non-member. Now what is an eligible company, sir? Eligible company is a public company with net worth 100 crores or more or turnover 500 crores or more. Public company, either net worth 100 crores or more or turnover 500 crores or more, is an eligible company. Eligible company is allowed to accept deposits from members and non-members. See, deposits is for short-term finance, actually, short-term finance. Short-term requirements, sir. So unnecessarily, issue of shares, sharing ownership, or issue of debentures, complying debenture provisions, not required, sir. For us, the requirement is very short-term, sir. 6 months or 36 months. In that case, you can go with the option called deposit. The person whoever makes deposit, we call them as depositors. For all companies, depositor is a member. For eligible companies, depositor may be a member or non-member. And this chapter 5, acceptance of deposits, the provisions with respect to acceptance of deposits are not applicable to the following companies. Banking companies, no need to follow chapter 5. NBFC companies, no need to follow chapter 5. Housing finance companies, not required. Prescribed companies, in future central government may prescribe few companies, not required to follow this chapter 5. Then also this chapter is not applicable to them. Next one, conditions for acceptance of deposits from members. If company wants to accept deposit from members, then what are the conditions to be satisfied? First, approval from members is required. Approval of members is required. And you need to issue a circular. You need to issue a document called circular. In case of public offer of securities, you will see prospectus. In case of offer of securities to the identified persons, you can see private placement. In case of deposits, the document a company uses is circular. And that circular should contain the following contents: financial position of the company, credit rating if any obtained by the company. Credit rating is like a CIBIL score to an individual. Suppose if you apply for a loan, banks first they will observe your repayment capacity and then your CIBIL score. That score reflects, that score shows that how much perfect you are in repaying the debts. If you are regular in paying the debts, your score will be very high and there is a chance of getting more and more loans. If your score is less, that means you are not paying your debts regularly. You are making some defaults. So banks will show a less priority to those kind of borrowers. Next one, number of depositors as on date of issuing circular and outstanding deposits as on date of issue of circular. So this information company has to compile and company has to prepare a document called circular. Next one, that circular shall be filed with ROC within 30 days before issue of circular. 30 days before issue of circular to the members, file a copy with ROC. So once you accept deposits, the deposits maturing the next financial year, not current financial year, next financial year, how much amount of deposits are getting matured? Out of that 20% you need to create a reserve today itself. Today means by 30th April of current year, you need to create a reserve with respect to deposits which are maturing in the next financial year. And you are required to obtain a certificate of no defaults. Last 5 years company didn't commit any default in repaying the deposits or in paying interest on the deposits. Next one, in case you are accepting secured deposits, then you need to create a security. You need to comply the provisions related to registration of charges. And once maturity date comes, on the date of maturity, you have to repay all the deposits. Understood? In case of contravention of these provisions, then company has to pay a fine minimum 1 crore or twice the amount of deposits accepted, whichever is lower. Maximum 10 crores. Suppose deposits are accepted 25 lakhs. 1 crore or 2 times of 25 lakhs, whichever is lower, means 50 lakhs. Maximum 10 crores. This is the range of fine on the company. Defaulting officer, imprisonment up to 7 years. Fine minimum 25 lakhs, maximum 2 crores. For each contravention, for contravention of this chapter, defaulting officer will get this punishment. So let me show you the material. So depositor, who is the depositor? I completed. Prohibitive provision. No company can accept or renew deposits from public unless it follows this chapter. But this chapter is not applicable to banking, NBFC, housing finance companies and other companies as central government may specify. Next one, acceptance of deposits from members. Yes, all those conditions I already discussed with you. Ordinary resolution, circular, filing of circular with ROC, DRR, deposit repayment reserve, no default in repayment declaration, provision of security, repayment of deposits. Yes, I told you. And next, eligible company I discussed with you. Eligible company, it should be a public company with a net worth of not less than 100 crores. That means greater than or equal to 100 crores. Turnover greater than or equal to 500 crores. Any one condition satisfied. Public company satisfying any one of these two conditions, it is an eligible public company. Next one, it has obtained the prior consent by means of special resolution passed in the general meeting. So eligible company, before accepting deposits, it is required to take a member's approval. What kind of approval? Special resolution. But in one situation, ordinary resolution is sufficient. Sir, what is that situation, sir? Sima, outstanding debts plus proposed deposit. Deposit is also a debt to the company. Once company accept deposits, at one point of time it has to repay those deposits. Yes or no? It is a debt. So proposed deposits put together less than or equal to 100% of paid up share capital plus free reserves plus securities premium. In this situation, ordinary resolution is sufficient within the powers of the company only. So just members ordinary approval is sufficient. But if it is exceeding this limit, then special resolution is required. 3 times majority is required. And eligible companies for accepting deposits from public, the conditions to be satisfied is every year company is required to obtain a credit rating. So this credit rating shows the company's repayment capacity, the company's regular in payment of those deposits. So how far is company making any default, the financial position of the company, is it supporting company to repay deposits on maturity date or not, everything you will get to know based on credit rating. Next one, in case of secured deposits, it is the duty of company to create charge on the assets. So whatever assets shown to the whatever assets provided as security to the depositors, it is the duty of company to register the charge and file that charge documents with the ROC. Punishment for contravention, just now I discussed with you. Punishment for company, minimum 1 crore rupees or twice the amount of deposit accepted, whichever is lower, but which may extend to 10 crore rupees. And officer in default, defaulting officer, imprisonment up to 7 years and fine 25 lakh rupees to 2 crore rupees. Next one, write about provisions for repayment of deposits accepted before commencement of this act. You all know Companies Act came in the year 2013. And provisions related to these deposits were introduced in the year 2014. So what about previous deposits, the deposits which were accepted before commencement of this section? So old deposits or existing deposits, what about those deposits? So the point is, those deposits shall be repaid within 3 years of commencement of this section or the due date you told to them. The due date you told to them. So due date of, that means maturity date of those deposits are 3 years from the commencement of this section, whichever is earlier. Yes, within the due date you have to make repayment. And immediately after commencement of this section, immediately company has to disclose the details of outstanding deposits, outstanding depositors within 3 months. Understood? So within 3 months after commencement of this act, it is a duty of company to communicate about the existing depositors, outstanding deposits with ROC. If you want any extension, just file an application with NCLT. So failure to file with ROCs, failure to repay within the prescribed period. So company is liable to pay a penalty, fine, minimum 1 crore, maximum 10 crores. Defaulting officer, imprisonment up to 7 years or fine 25 lakhs to 2 crores or sometimes both. So just look at the material. So 3 years time is given, 3 years from the commencement of this section or the expiry period for maturity, expiry period or maturity date of the deposits, whichever is earlier, you have to make repayment. And before that, first file a particulars with the registrar showing that statement of all deposits accepted by the company and sums remaining unpaid. Remaining unpaid means outstanding deposits. That's what I told you. Outstanding deposits on such amount with interest thereon with the arrangements made for such repayment. If you want extension, file an application with NCLT. And punishment for non-compliance, as I discussed with you. Next one, global depository receipts. One small concept is there. So global depository receipts. Now the crux of the concept, I'll explain you the crux of the concept. Company, if it is planning to mobilize foreign funds, so what a company can do? Generally, company for mobilizing funds, it will offer its securities to the public. It can offer its securities to the public for mobilization of funds. But this company is not known to the public in foreign countries. Or previously there is a restriction, company cannot directly offer its securities in the foreign markets. Previously there is a prohibition. Right now, ease of doing business, globalization, liberalization, because of these concepts, slowly these restrictions, these prohibitions are getting eliminated. But the point, previously when company wants to mobilize foreign funds, so what actually company used to do, company, it will enter into an agreement with a global depository, a depository situated in foreign country. So company will enter into an agreement with this depository. See, I will issue securities in your name. So based on these securities, you mobilize foreign funds. Now, depository keeping these securities as an underlying asset, depository will issue receipts to the public in the foreign countries. The interested persons, out of this public interested persons, they will file an application with the depository for these securities. All the securities will be held in the name of depository, and the depository will issue receipts to the public. And since these receipts are issued by depository, we call them as depository receipts. If these depository receipts are traded globally, we call them as global depository receipts. And all these securities will be held in the possession of domestic custodian bank. A domestic custodian bank. Securities should not cross India borders actually. So that's why what company will do, it will enter into an agreement with a domestic custodian bank. It will deposit all the securities with a domestic custodian bank. Deposit securities with a domestic custodian bank. This domestic custodian bank and overseas depository will enter into a custodian agreement. Yes, I'm holding these securities on behalf of you. I'm just acting as an agent for you with respect to these securities. So based on these agreements, what depository will do? Depository will collect money from public, and depository will issue receipts to that public. Those receipts are known as global depository receipts. If that receipts were issued in the America, then they are known as American depository receipts. Getting my point, students? So Indian company entering into an agreement with overseas depository, and that overseas depository issuing receipts in the overseas countries. So yes, global depository receipts. Now public at the time of filing application, they will pay money. Depository, after collecting that money, will credit that money to the Indian companies. So this is how global depository receipts works. Coming to our syllabus, what are the conditions to be satisfied for issue of global depository receipts? Everything is specified in section 41. So section 41 of the Act provides for issue of global depository receipts. A company may issue depository receipts in any foreign currency, dollar, euros, pounds. For this, special resolution is required to be passed in general meeting. So approving authority members, what kind of approval? Special resolution. Next one, eligibility. Rule 3 provides eligibility criteria to issue global depository receipts. A company may issue depository receipts provided it is eligible to do so in terms of scheme and relevant provisions of FEMA, Foreign Exchange Management Act, rules and regulations. The conditions are first board resolution authorizing company to do so. Next, a special resolution from the members. Why? First, it is issuing shares in the name of overseas depository. So here the ownership in the company is shared with outsider. So existing members' ownership is getting shared with an outsider. Existing members' approval is compulsory. What kind of approval? Special resolution. See, previously company is having 10,000 shares ma. Out of 10,000 shares, you are holding 2,000 shares. That means you are having 20% ownership. How much ownership you are having? 20% ownership you are having. Right now, company decided to issue 10,000 shares to an outsider. So now what happens? Total 20,000 shares. Out of 20,000, your holding will be 2,000. In terms of percentage, 10%. Previously, your ownership is 20%. Right now, it is falling to 10%. That means your interest is getting affected or not? Yes, sir. My interest is getting affected. So that's why company, before making such things, company is required to take approval from the existing members. So special resolution is sufficient. Next, depository receipts shall be issued by overseas depository bank appointed by the company. Underlying shares shall be kept in the custody of domestic custodian bank. The company shall ensure that applicable provisions of the scheme and rules, guidelines, everything has been complied with. And company shall appoint any of these following persons to oversee all the compliances relating to issue of depository receipts. And compliance report taken from the above professionals shall be placed at the meeting of board of directors or committee of the directors. And the committee of the board shall have at least one independent director if the company requires to have an independent director. Okay, constitution of that committee. Next one, issue of depository receipts. The receipts can be issued by way of public offering or private placement or in any other manner. Everything happens outside India. May be listed, traded in overseas listing or trading platforms. And the depository receipts may be issued against issue of new shares or may be sponsored against shares held by the shareholders. This is like offer for sale of securities. New shares, fresh issue. Company will get money here. Whereas offer for sale of securities, promoters or existing members will get money. The underlying shares shall be allotted in the name of overseas depository bank, and against such shares, receipts shall be issued by overseas depository bank abroad. Now coming to the voting rights, sir, who can exercise voting rights? Depository holders, global depository receipts holders, or overseas depository bank. Who can exercise voting rights? The answer is overseas depository bank. Why? Shares are allotted in the name of overseas depository bank. GDR holders are just beneficiaries. Legal owner is overseas depository bank. So overseas depositories shall be entitled to vote on behalf of depository receipts holders until the conversion of depository receipts to shares is taken place. For this purpose, there would be an agreement entered into between the overseas depository, the holders of depository receipts, and the company. That's what I told you. No, there is an agreement. Just wait. Okay. So there are agreements between company, overseas depository. Next one, company, domestic custodian bank, and overseas depository banks. Understood? Everyone. Next, proceeds of issue. Overseas depository bank, after collecting money, will deposit that amount in the account of the company. Depository receipts prior to this act. Whatever depository receipts issued prior to the commencement of these rules shall comply with the requirements within 6 months from such commencement. So within 6 months of commencement of these rules, comply all these rules. Next one, these provisions are not applicable when the provisions of the act or rules issued thereunder for public issue of shares or debentures. That means if you are directly going to the country outside India and directly if you are offering shares without offering global depository receipts, then these provisions are not applicable. When you are offering shares, when you are offering debentures directly without the support of domestic custodian bank or overseas depository, so then no need to comply these rules, and these provisions as applicable to the prospectus or an offer document. So that means whenever you are making public offer of securities, whether in India or outside India, then this section 41 is not going to get applied. Understood? Everyone. And let's continue our marathon with the next topic, registration of charges. Registration of charges, section 77 to section 87. So charges. So first of all, what is a charge? An interest or lien created on company properties or company assets or any of its undertakings as a security is called charge. So company for getting a loans from banks, so generally what companies will do, on its properties, company properties or company assets or company undertaking is a group of assets associated with respect to one business. Suppose if you take ITC company, machines, plant and machineries installed in a tobacco factory is one undertaking. Land and building particular property or particular asset. Now any interest or lien created on company properties or company assets or any of its undertakings as a security, it is called charge, and charge includes mortgage. This charge is created in favor of a charge holder. So tomorrow if company makes any default in repayment of loans or in payment of interest on loans, charge holders will get control over the properties. Charge holder can sell the property, can realize money, can adjust that money against its loans, company loans. Understood? Now the procedure for registration of charge, who will register the charge? Actually company. First company has to register the charge. If company fails to register charge, then charge holder can register the charge. And next one is buyer of the charged property. Suppose company created charge on one of its property. Now I am purchasing that property. The moment I complete purchase of the property, I will file a registration of charge. I will file a charge document with company. There is a change in owner of the property. Previously it's company. Now I am the owner of the property. So who can file charge documents? Who can register charge with ROC? Company. Charge holder. Charge holder is the person in favor of whom charge is created. And next one, buyer. When? So what is the time limit for registering the charge? Normal time limit, within 30 days of creation of charge. Within 30 days of creation of charge, it is the duty of company to register charge with ROC. And ROC, after registration, will issue certificate of registration of charge to the company. So what is the effect of non-registration of charge? Consequences of non-registration of charge is that charge becomes void. That means the charge holder, the secured creditor will not get any control over the property. Suppose in the event of liquidation, generally the settlement priority will be like this: secured creditors stands first. But if charge is not registered, if the charge is not registered, he is not treated as secured creditor, he will be treated as unsecured creditor, and he will be settled after settlement of secured creditors. Understood? So charge becomes void. Loan is valid, but he won't get any right over charged property. So it is the duty of company to register the charge. Upon creation of the charge, it is the duty of company to register the charge. That asset or property or undertaking may be located in India or situated outside India. And the applicable form is CHG 9 in case of debentures. So charge with respect to debentures, issue of secured debentures, you need to file CHG 9. Other cases, CHG 1, bank loans, CHG 1. Time limit for filing charge documents with ROC within 30 days of creation. And there are additional time limits with respect to old charges, that is before charges created before 2nd November 2018, the additional time limit is 270 days. So 30 plus 270, it is within 300 days of creation. Within 300 days of creation, yes, charge documents shall be filed with ROC subject to additional fees. Now coming to the new charges, charges created on or after 2nd November 2018. So normal time limit is 30 days. Normal limit is 30 days. Failed. Then additional limit is given. Additional limit of 30 days is given. That means, within 60 days of creation. Sir, here also failed. Then further additional limit. Further additional limit of 60 days is given. So that means, within 120 days of creation. Normal time limit, normal fees. Additional limit of 30 days, you need to pay additional fees. And if this 60 days limit is also violated, then you have to register charge within 120 days of creation. For that you have to pay proportionate fees, ad valorem fees. It will be generally percentage on loan amount like that. 1% of loan amount like that. Ad valorem fees, proportionate fees. So additional time limits for old charges is within 300 days of creation. With respect to new charges, it is within 60 days of creation, additional time limit. Within 120 days of creation, further additional time limit. Next one, registration of charge by charge holder. Company failed to register charge within 30 days of creation. Within 30 days of creation, then charge holder can register the charge. Sir, why charge holder will file application with ROC? I told you, effect of non-registration, consequences of non-registration leads to void. The charge becomes void. If charge becomes void, then charge holder will not get any control over the charged properties. So that's why charge holder, to protect his interest, he will file application with ROC. Once ROC receives application, it will give an intimation to company. Company so and so charge holder came to me. So what is your response? If company, yes sir, it's my mistake, okay, I will register the charge. Then company will file application for registration of charge. Suppose if there is no response from company within 14 days of such intimation, if there is no reply, if there is no response from company, then ROC assumes that yes, there is a charge and company failed to register the charge. Accordingly, ROC shall register the charge and issue certificate of registration of charge. And whatever amounts paid by the charge holder, normal fees or additional fees, all those amounts charge holder will get reimbursement from the company. It is the duty of company to repay, to reimburse the charge holder. So charge holder is having a right to recover the amounts paid for registration of the charge. Next one, a registration of creation of charges provisions shall also apply to the modification of charges. Modification arises because of these reasons. Suppose, company created charge on particular property in favor of State Bank of India. The loan amount is, 1 crore. The loan amount is 1 crore. After registration of charge, there may be a chance of variation like, change in property. Suppose, company added one more property, or extension, loan extension. Suppose, company asked bank to give another 1 crore, so total 2 crores. Or sometimes loan takeover may happen, ICICI bank may finance the company, ICICI may acquire all those charged properties, change in the lender. Sometimes there may be change in the borrower, one company selling the property to another company, yes, borrower name gets changed. So these are the proposed, variations. In case of variation, it is the duty of company to register that variation with ROC. Variation is nothing but modification. So with respect to modification, you have to comply all the provisions that are applicable to registration of creation of charges. And next one, buyer or acquirer of charged property is presumed to have notice of the charge from the date of such registration. Once you file a piece of document, once you file a piece of paper with ROC, it becomes public document, it becomes public information. Now, any person dealing with charged property of the company, it is assumed that he is having knowledge of the charge. He is having about the knowledge of the charge. So subsequently, he can't deny that, I thought that the property is free from charges. No, he can't make such statements. So accordingly, he is liable to the lenders. And next one, a register of charges. Here, company will maintain one register. ROC will also maintain a register. The difference between company and ROC is, company will maintain register with respect to charges created by company, whereas ROC will maintain a register covering charges made by all the companies falling in that ROC jurisdiction. Companies incorporated in that ROC jurisdiction, every company will file charge documents with ROC whenever charge was created. Now ROC will maintain register with respect to all companies, all charges, whereas company register, you will find only charges created by the company, modified by the company. So in this register, you will find the particulars of all charges created by the company, and you will also, company is also required to maintain charge documents, charge instruments. These registers and these instruments shall be maintained for a period of 8 years from the date of satisfaction. Once you repay the amount, once you satisfy the debt, once you satisfy the charge. So from that date onwards, up to 8 years, you need to preserve these charge instruments at registered office. Where? At registered office. And these charge documents, charge registers are available for inspection. If members or creditors want to inspect, they can inspect without paying any fees, without any cost, they can inspect. Outsiders, other than members, other than creditors, they can inspect charge registers, they can inspect charge instruments upon payment of prescribed fees. Next one, ROC registers can be inspected by any person on payment of fees. Right now the fees is 100 rupees with respect to inspection of ROC register of charges. Next one, satisfaction of charge. Satisfaction means, for what purpose the charge was created. If that purpose is satisfied, that means you repaid a bank loan or you redeemed debentures, then there arises satisfaction. So in case of satisfaction of charge, it is the duty of company to register satisfaction of charge with ROC. The normal time limit is 30 days. If you fail to register satisfaction of charge within 30 days, then additional time limit of 270 days is given. That means, up to 300 days of satisfaction. On payment of additional fees, yes, you can register satisfaction of charge with ROC. ROC, after receiving that information, immediately he will send a notice to charge holder. Charge holder, is it true? Did company repaid complete amount? Is it true? Yes, sir. Then, if in case of no reply or in case of no objection, then, ROC will proceed with registration of satisfaction of charge. If there is any objection raised by the charge holder, then ROC will not register satisfaction of charge. If registration of satisfaction of charge is done, then ROC shall issue certificate of registration of satisfaction of charge. But this doesn't affect the ROC in registering satisfaction even without intimation by the company. If there is intimation from company, if there is an intimation by the company regarding satisfaction, ROC register the satisfaction. Sometimes, company fails to file an application with a registrar for registering the satisfaction of charge. In that case, ROC can register satisfaction of charge. There is no restrictions on ROC. ROC is having a suo motu power on its own motion, can register satisfaction of charge even if there is no intimation from company. How, when charge was created in the document, they clearly told loan is for 7 years. Loan is for 7 years. 17 years completed. There is no response from the company whether charge is satisfied or not. Now ROC will make a reasonable inquiry. If ROC received any evidence that debt is satisfied, debt is repaid, or property which was charged is released from charge, or company sold that property to another person paid that debt amount, or another person took the responsibility of the debt amount. In these cases, ROC will record the entries in the register regarding satisfaction of charge, and he will intimate the affected persons, company as well as charge holder, within 30 days of making that entry. And finally, ROC shall issue certificate of registration of satisfaction of charge. Certificate of registration of satisfaction of charge. And next one, intimation of appointment of receiver. Company provided one property as security to State Bank of India, and company is not paying any amounts, company is not paying installments to State Bank of India. State Bank of India, through this charge instrument, charge document, it got a power to appoint a receiver who can manage the charged property. Suppose from this charged property, monthly 1 lakh rent can be recovered. Now this receiver will come forward and he will collect 1 lakh rupee. Out of this 1 lakh rupee, first he will make adjustment against loan accounts. After adjustment balance left over, that amount, receiver will give it to the company. So whenever such person was appointed as a receiver, so that person has to communicate with company as well as ROC regarding his appointment. So within 30 days of appointment, he has to communicate ROC in form CHG6. Not only appointment, once cessation happens, suppose that receiver responsibility is completed, that receiver is no more a receiver, that person is no more acting as a receiver, then he has to give notice to the same ROC as well as company. Entire chapter, any contravention, the punishment is, company 5 lakh rupees, defaulting officer 50,000 rupees is the punishment. This is our latest punishment, amended punishment. And finally, the last topic is, rectification of register of charges. Sometimes, company may commit mistakes in recording entries in the register or in filings with ROC. They are not intentional mistakes, they are accidental mistakes. They are accidental mistakes, unintentional mistakes. These mistakes, these omissions or misstatements will not have any impact on the creditors. So in those cases, the company can file an application with central government for rectification of such misstatements. And the form is CHG8, time limit, reasonable time limit. Then central government can pass an order allowing company to rectify the registers, allowing the company, to file a satisfaction of charge even after completion of 300 days of satisfaction of charge. 300 days completed, no problem. Yes, central government can allow you to file satisfaction of charge with ROC. Central government can extend the time limit. So this section is all about powers of central government in rectifying the register of charges and the companies which failed to register satisfaction of charge within the time limit of 300 days. So this section is all about powers of central government. Once again, I am telling you powers of central government in rectifying the register of charges and in extending the time limit to register the satisfaction of charge. So if you go through the material, every point I revised. Just go through the material once. So condonation of delay, extension of time limit. Let me check whether any point is pending. Yes, I'll revise here itself. everything I revised. Is it clear? Are you able to follow me? Everyone? Okay, fine. Let's continue marathon with the next chapter, share capital and debentures, section 43 to 72. This chapter is the lengthiest chapter in the entire CMA Inter corporate laws. So I'll revise only important points in each and every concept. I'll revise all the concepts in this chapter, but only important points. Is it clear? Definition of a share. Share is a share in the share capital of a company and includes a stock. Generally, companies carry business operations with the capital, and this capital is divided into units. Each unit will have a face value. Company will allot all these units in the name of investors against their investments. Suppose company C Limited is having a capital of 1 lakh rupees. This 1 lakh rupees is divided into 10,000 units, and each unit is having a face value of 10 rupees. Now these units are known as shares. A share is the unit in the capital. Share is a unit of the capital, and share includes a stock. Stock refers to bunch of shares. Company will fix the limit 1000 shares equal to 1 stock. Interested member, on surrendering 1000 shares with company, he will be given 1 stock. The difference between share and stock. Shares are available in numbers: 5 shares, 10 shares, 50 shares, 100 shares. If you want to transfer shares, you can transfer only in numbers, 1 share, 2 shares, like that. Coming to stock, stock is available in amounts: 5,000 stock, 6,000 stock, 10,000 stock, 1 lakh stock. If you want to transfer stock, it will not be transferred in number, it will be transferred in amounts. How much stock you want to transfer? 5,000 rupees stock. How much stock you want to purchase? 10,000 rupees stock. Ultimately, the holder of a share, the holder of a stock, is the owner of the company only. And the significance of the definition, the provisions of share capital that are applicable to shares are equally applicable to stock. I'll give you one example, just wait. Next one, nature of share. Share is a movable property, and transferability of shares is affected by the provisions of Articles of Association. Articles of Association decides the transferability of shares. If your company is a public company, shares are freely transferable. If your company is a private company, yes, company can impose restrictions on transfer. Understood? So shares are transferable in the manner prescribed by AOA. Now, stock is also a movable property. Stock can be transferred in the manner prescribed by AOA. So this is the example. The provisions that are applicable to share are equally applicable to stock. Next one, types of capital. We are having authorized share capital, issued share capital, subscribed share capital, paid up share capital, and called up share capital. Authorized share capital you will find in Memorandum of Association capital clause. Now this is also known as registered capital. A company in its lifetime can issue shares to the extent of number mentioned in the capital clause of MOA. So this is the maximum capital a company can issue. If company want to increase this capital, yes, it can increase the capital by passing an ordinary resolution. Next one, issued share capital. The portion of authorized capital which is offered to the investors, we call it as issued capital. And the portion of issued capital which was subscribed by the investors, it is nothing but subscribed share capital. The portion of subscribed capital which was called by the company, it is a called up capital. And the portion of called up capital which was paid by the investors, paid by the members, paid by the owners, we call it as paid up share capital. Authorized share capital you will find in Memorandum of Association. Just now I told you. Paid up share capital you can find in balance sheet of the company. The balance sheet of a company, you can find paid up share capital. In the capital clause of Memorandum of Association, you can find authorized capital. Next one, kinds of share capital. Types of capital different, kinds of capital different. We are having two kinds of capital. One is equity share capital and the second one is preference share capital. Equity share is a share which is not a preference share. Any share, if it is not a preference share, we call it as equity share. Then what is a preference share, sir? No, any share which is carrying two priorities. One is with respect to dividend and the other one is with respect to capital. Then such shares are known as preference shares. The holders of preference shares will get a priority. Now, whenever company declares dividend, first the dividend will be paid to preference shareholders. Next priority, equity shareholders. Now compared to equity shareholders, preference shareholders will get a priority rights, preferential rights. One is dividend preference, and the second one is redemption of capital. In the event of liquidation of a company, the money left over after settlement of all outstanding debts, all outside loans, all the creditors, balance left over, first we will redeem preference shareholders capital. Balance left over, we will return that money to the equity shareholders. So any share which carry two preferential rights, it is a preference share. Not only preferential rights, if a share is having a participatory rights, then also it is a preference share. Participatory right means what, sir? After payment of dividend to the equity shareholders, whatever profit left over in the company, in that surplus, in that leftover profits, along with equity shareholders, if any other person, if any other shareholder is getting a participation right, then that person is known as preference shareholder. That share is a preference share. Understood? So after payment of all the dividends to the shareholders, whatever surplus is left over, in that surplus, if a shareholder is given a participation right along with equity shareholder, then that shareholder is a preference shareholder. Share is a preference share. So preference share, it will have either preferential rights or it will have a participatory rights. Clear? Next one, equity shares are classified into two types. One is equity shares with normal rights, and second one equity shares with differential rights. Normal rights, here you can see equal dividend, equal voting rights. As a holder of equity share, he will be paid dividends whenever company declare dividend, and he will be called for a meeting. In that meeting, he can exercise his voting power. Normally, one share equal to one vote. Imagine, all the shares are fully paid up. All the shares are fully paid up. Each share carry one voting right. If you are holding 10 shares, you will get 10 votes. If you are holding 100 shares, you will get 100 votes. So equal voting. Next one, company declared 5 rupees dividend per share. If you are holding 10 shares, you'll get 50 rupees dividend. If you are holding 100 shares, you'll get 500 rupees dividend. So equal, everything is equal. Coming to differential rights, here the shares may carry high voting rights with low dividend rights, or low voting rights with high dividend rights. Best example, Tata Motors. It is having two types of shares: equity shares with normal rights, equity shares with ordinary rights, equity shares with differential rights. The speciality of equity shares with the differential rights, here one share, if you hold 10 shares, you'll get one vote, and dividend, you'll get 5% extra dividend. Along with normal dividend, you'll be paid 5% extra dividend. So this is the highlight of equity shares with the differential rights of Tata Motors. Now, for issuing equity shares with the differential rights, company should satisfy the following conditions. First one, AOA authorization. If AOA is silent, then pass special resolution, alter AOA, file altered articles with ROC. Then you can proceed with issue of equity shares with the differential rights. Next one, ordinary resolution. Members' approval is compulsory. If your company is a listed company, then voting shall be passed through postal ballot. See, we are having 4 types of voting: show of hands, poll, postal ballot, e-voting. I'll revise all these types of voting in the management and administration chapter. But the point is, a listed company which wants to issue equity shares with the differential rights, it has to take ordinary resolution from the members, and that ordinary resolution shall be passed through postal ballot. Next one, limit. Voting power of differential rights shall not exceed 74% of total voting power of the company. This is as per the latest amendment. Whereas as per study material, as per institute material, the maximum limit is the shares with the differential rights shall not exceed 26% of total post-issue paid up share capital. So simply, equity shares with normal rights plus equity shares with differential rights equal to total share capital. Yes or no? So what this person is telling, what the lawmaker is telling, equity shares with the differential rights shall not exceed 26% of total post issue. That means if you convert it into numbers, so equity shares with the differential rights maximum 26. Imagine total capital is 100. Total number of shares in a company is 100. In that 100, no, 100 including, I'm telling you, 100 including differential rights. In that 100, The portion of equity shares with the differential rights shall not exceed 26. That means normal rights 74. Normal rights, how much a company can have? 74. Maximum equity shares with the differential rights shall not exceed 26%. So if a company is issuing equity shares with the differential rights and it utilizes the maximum limit of 26%, then normal rights 74%. You all getting my point, students? Next one, as per the latest amendment, voting power of differential rights shall not exceed 74% of total voting power of the company. If you ask me to put it into the equation, voting power from differential rights less than or equal to 74% of total voting power of the company. Total voting power means voting power from normal rights plus voting power from differential rights. So this is the equation format. Post issue of equity shares with the differential rights, the voting power from differential rights shall not exceed 74% total voting power of the company. So that means, let me put it into the simple equation. Voting power from differential rights maximum 74%. That means voting power from normal rights minimum 26%. That's it. Next one, conversion is strictly prohibited. Conversion of equity shares with the normal rights into equity shares with the differential rights, equity shares with the differential rights into equity shares with, of normal rights is prohibited. A company can issue equity shares with the differential rights. It can't convert existing shares into equity shares with the differential rights. Next one, disclosures in the register of members. So equity shareholders with the differential rights should be disclosed separately in the register of members. Next one, equity shareholders. All equity shareholders are equal. Whether you are holding differential rights or whether I am holding normal rights, you and me both are equal with respect to bonus shares, with respect to right shares. So only differentiation will take place only with respect to voting and dividends. Only with respect to voting and dividends, yes, there arises differentiation, but all other rights, attending general meeting, getting bonus shares, subscribing additional shares, that is right shares, everything is same. Next one, important point, company shall not possess following defaults, and I categorize these defaults into two categories. One is subsisting default and the other one is time default. Subsisting default, at the time of issue of equity shares with the differential rights, company shall not possess these defaults. Company should not commit any default in redemption of preference shares, redemption of debentures, interest on debentures, repayment of deposits, payment of interest on deposits, and payment of declared dividend. If company is having these defaults, immediately rectify these defaults. The very next second, company can issue equity shares with the differential rights. Next, time default. In that first classification, first category, no default in last 3 financial years. So last 3 financial years, company should not commit following defaults. So what are those defaults? ROC filings. Company should not commit any default in filing annual return and financial statements in the last 3 years. And company should not be penalized by SEBI, Securities Contract Regulation Act, FEMA, RBI. Suppose in any one of the last 3 financial years, if company commits any of these following defaults, then in current financial year, company cannot issue equity shares with the differential rights. You're getting my point? Suppose 2022-23 company committed a default or company was penalized by SEBI. In that case, 23-24 ban, 24-25 ban, 25-26 also ban. 26-27, yes, it can. Why? Last 3 years, no default. Last 3 financial years, there is no default. Understood? Next one, up to 5 years after making default good. That means, if company is having these defaults, first company should rectify those defaults and it should wait for 5 years. 5 years ban period after rectification. So what are those defaults? Failure to pay dividend on preference share capital, failure to pay interest on loans, failure to repay term loans, with respect to public financial institutions, state financial institutions, banks, and failure to transfer funds to IEPF account, Investor Education Protection Fund, and failure to discharge statutory dues. Company is having these defaults. First, rectify these defaults. That means make these defaults good. Suppose you rectified these defaults in this year. So next 5 years, you cannot issue equity shares with the differential rights. After completion of 5 years from the year of rectification, you can issue equity shares with the differential rights. The three types of defaults we are having. Subsisting default, that means at present you should not have these defaults. Last 3 years defaults, that means last 3 years you should not have these defaults. Next 5 years defaults, last 5 years you should not commit these defaults, and even if you commit these defaults, immediately rectify them. After rectification, wait for 5 years. Understood? Completion of 5 years from the year of rectification, you can proceed with issue of equity shares with the differential rights. And additional disclosures in the board report, how many shares you allotted with the differential rights, and details of shares, high voting or high dividend, percentage of differential rights shares with the total shares in terms of voting, in terms of number. Next, issue price per share, and justification why you fixed that much issue price. Suppose 100 rupees price you fixed, why 100 rupees, justification. And next one, changes in control. Due to issue of equity shares with the differential rights, is there any change in control? Promoters voting power increased or promoters voting power reduced, you have to mention that point. Next one, diluted EPS. EPS is nothing but earning per share. Earning per share, all the earnings available to equity shareholders divided by number of shares, divided by number of equity shares, you will get EPS. Suppose company is having a capital of company is having a profit of 1 lakh rupees, and total 10,000 shares are there. So per share EPS is 10. Now company issued equity shares with the differential rights. Imagine there is no change in profit constant. For example, profit remains constant, and company issued 10,000 shares, 10,000 differential rights shares company issued. So now total, if you observe, 1 lakh divided by 20,000 shares, 5 rupees. So there is some dilution happened. Previously, member is getting 10 rupees EPS. Now member is getting 5 rupees EPS. So how much EPS got diluted because of issue of equity shares with the differential rights? 5 rupees. Next one, pre and post issue shareholding pattern. Pre means before issue, post means after issue. So you have to disclose the shareholding pattern before issue and after issue. Next one, in case of private placement of in case of issue of equity shares with differential rights under private placement, then you have to mention the details of the members, to whom these shares were issued, so to the promoters or to the outsider. Next one, share certificate. Share certificate is the proof of evidence. You are a member of the company, you are a owner of the company. For that, if someone asks you, show me the evidence, show me the documentary proof, then you have to disclose share certificate. You have to show the share certificate. Each and every share certificate shall be distinctively numbered. Suppose you take two 500 rupee notes. Each 500 rupee note will have a distinct number, unique number. So no two 500 rupee notes will have a same serial number. If two notes are having same serial number, that means one is duplicate one. One is original, the other one is duplicate one. Understood? So each and every share certificate shall be distinctively numbered, and this share certificate contains the details of the members, details of the shareholders, and number of shares held by that person on that day. Understood? So it's a prima facie evidence that you are a member of the company and you are holding those many shares which was mentioned in the share certificate. Share certificate, the document showing title. Understood? So whose names were mentioned in the share certificate, only those people are the owners of that share certificate. And that share certificate is valid if it is issued under common sale. In case company is not having common sale, then that share certificate should be signed by 2 directors. If company is having company secretary, then 1 director and 1 company secretary should sign that share certificate. Then only the share certificate is valid. As per rule 5, share certificate can be issued only after satisfying these 2 conditions. One is board resolution, and share certificate will be issued against a letter of allotment. Now in private placement, public offer, so interested candidates will file application for subscribing securities, and company will release the list of allottee details. Company will issue letter of allotment. Only against that letter of allotment, share certificate will be given. And share certificate, the form is SH1. Form of share certificate is SH1. If any member of the company loses original share certificate, or if the original share certificate is destroyed, then he can file an application with company for duplicate share certificate. And since share certificate is lost, here you need to provide indemnity bond. Why? Suppose, if you're a genuine person and if you lost share certificate, really you lost share certificate, then there is no problem. But you're a fraudulent person. What you did, you transferred your shares to an innocent person, and you approach a company for the want of duplicate share certificate. How company knows about your transfer that happened previously? So what company think? Okay, no problem. Company, if it issue duplicate share certificate, tomorrow original member comes to the company. Original owner will come to the company and he will ask, sir, register shares in my name. The company already issued those shares to previous person, but this person is the real owner. So now company should compensate this person. So it's a loss to the company. So who should compensate the company? This person, whoever filed the application for duplicate share certificate. Are you all getting my point, students? Everyone. So if a original share certificate is lost or destroyed, along with application, you have to furnish indemnity bond. Suppose, sir, original share certificate is not lost, sir. We didn't lost original share certificate. We are having original share certificate, but it is turned into two pieces, or it is defaced, sir. Water fallen on the share certificate, so share certificate is damaged. In that case, file an application and submit original share certificate. So here indemnity bond is not required. Why? You are having original share certificate in your hands. Now no need to furnish indemnity bond. Understood? Along with application, pay a prescribed fees. How much? Maximum 50 per certificate. What company will do? It will issue duplicate share certificate in the name of applicant. If company is a listed company, within 45 days it is required to issue duplicate share certificate within 45 days of application. If it is an unlisted company, if a company is an unlisted company, then within 3 months from the date of application, company has to issue duplicate share certificate in the name of applicant. Punishment for defraud. Company intentionally duplicated shares, intentionally, without any application from the member. Company intentionally duplicated shares and it started selling duplicate shares to the public. In that case, the intention of the company is not genuine, the fraudulent intention. So the punishment is company minimum 5 times of face value of shares, maximum 10 times of face value of shares, or 10 crores, whichever is high. Suppose 10 lakh rupees face value of shares have been duplicated without any application. 10 lakh rupees face value of securities have been duplicated. In that case, the minimum punishment is 5 times of 10 lakhs, that is 50 lakhs. Maximum 10 times of 10 lakhs equal to 1 crore, or 10 crores, whichever is higher. So 10 crores. So the punishment range will be between 50 lakhs and 10 crores. 50 lakhs to 10 crores. The defaulting officer, he will get punishment under section 447. And company has to maintain a register of duplicate certificates. So every time when company issues duplicate certificates, it's the duty of company to update this register. Next concept, voting rights. Voting rights. Holder of equity shares will have a right to vote on every resolution placed in general meeting. Whereas holder of preference shares can exercise voting rights only with respect to matters affecting their rights. Winding up of the company, reduction of capital. Suppose company issued 10% preference share capital, redemption after 10 years. Redemption after 10 years. Now, the holder of preference share is having a right to get a return every year 10%. Every year 10% return he is entitled to. Yes or no? So what are the rights available to the preference shareholders? Every year he will get a return of 10%. At the end of 10th year, he will get 100% capital back. So these are the rights available to the preference shareholder. Now, company decided to reduce this 10% dividend to 8%. Now, this is a matter affecting the rights of preference shareholders. So this can be, the reduction of rate is permissible only with the approval of preference shareholders. Understood? So preference shareholders will get voting rights on the matters affecting their rights, on the matters related to winding up of the company, reduction of capital. So this is a general rule. And we had one exceptional rule, that is, if a preference shareholder is not paid a dividend for a period 2 years or more. No, preference share capital, on preference share capital, if company fails to pay dividend for a period 2 years or more, then all the preference shareholders whose dividend remains unpaid will get a right to vote on all resolutions placed in the general meeting. Understood? And once company, once company pay dividend to these preference shareholders, then those people voting rights will become zero. You getting my point? So this is exceptional circumstance. Company fails to pay dividend to the preference shareholders for a period 2 years or more, then preference shareholders will also get voting rights along with equity shareholders. Next one, variation of shareholders' rights. Just now I discussed with you. So 10% preference share capital, redemption after 10 years. Now the preference shareholder is having how many rights? Two rights. One is every year dividend 10%. At the end of 10th year, yes, he will get back his capital. Now, if you want to change any right of the shareholder, then you need to comply the provisions of this section. The first thing, verify your MOA, AOA, whether MOA or AOA is authorizing the variation of shareholder rights or not. If MOA, AOA is silent, then go with issue terms. If it is a public offer, go with prospectus. If it is a private placement, go with private placement offer come application letter terms. In issue terms, they should not have, the issue terms should not have a clause regarding prohibition on variation. Issue terms, if issue terms is silent with respect to prohibition on variation, then company can proceed with variation. Second thing, company is required to get a special resolution from the members if meeting is called for. Or company decided to get a consent through writing. If company decided to get consent through writing, not through meeting. Suppose, company is having two options: call for a meeting, obtain special resolution. Or if you decide to get consent through writing, then 3/4 of issued shares, 3/4 of issued share capital holders must give written consent. Suppose that issued class is of 10 crores. Total capital in that class is 10 crores into 3/4. That means 7.5 crores rupees capital holders. Now, one person may hold that 7.5 crores, or 100 persons may hold that 7.5 crores. But the point is, the holders holding not less than 3/4 of the capital must give consent in writing. Then only variation is allowed. Next one, rights of dissenting shareholders. The dissenting shareholder is a shareholder who is against to the variation. He is not in favor of variation. He is against to variation. No, sir. We want our original dividends. We are not allowing you to reduce the rate of dividend. So these dissenting shareholders can file a petition with NCLT. But this dissenting shareholders shall possess at least 10% of class capital. That means 10% of 10 crores. These dissenting shareholders, one in number or two in numbers or more than one person, but this group must hold 10% of issued class capital. That means here the capital is 10 crores. Out of 10 crores, 10% means 1 crore. So dissenting shareholders shall hold at least 1 crore capital, and they should file application within 21 days after variation. Within 21 days they can file a petition with NCLT. Now finally NCLT will pass the order either confirming the variation or rejecting the variation. Whatever order passed by the NCLT, it is the duty of company to file a copy of NCLT order with the ROC. Is it clear, everyone? Just 1 second. Yeah. So this is the point I discussed with you so far. And one extra point is there. The extra point is, the company is having two classes of capital. For example, normal rights, differential rights. So first of all, this section, the provisions of section 48 are applicable only if company is having two or more than two types of capital. So different class of shares. Suppose company is having only one class of capital, then it can proceed with annual general meeting. In that general meeting, it will take consent of the members. But here, company should have two or more classes of shares. Another example, company is having equity share capital and company is having a preference share capital. Okay. Now, variation of one class, if it is affecting the rights of another class, then you need to take consent from another class members also. Variation of one class rights, if it is affecting the other class, then similar consent you have to take from another class too. That is the extra point. Next one, application of securities premium. Securities premium, it is a difference between issue price and face value. So when company issues shares at a price which is higher than face value, the difference between issue price and face value is the securities premium. In the entire Companies Act or in the Articles of Association of Company, there is no restriction on issue of shares at premium. Newly incorporated company, yes, it should issue shares at face value. 10 years old company, it should issue shares with a 10% premium only, or 50% premium only, or 100% premium only. There is no such restriction in the Companies Act. Now company is having a freedom to fix securities premium, but Companies Act imposed restrictions on utilization of securities premium. You can utilize securities premium only for the stated purposes. So what are those purposes? If you are a company, if your company is preparing financial statements in accordance with accounting standards, then securities premium can be utilized for buyback of securities, bonus issue related expense. All other companies, banking companies, insurance companies, they are not required to prepare financial statements according to the accounting. So they can utilize securities premium for buyback, bonus issue related expenses, premium on redemption of preference shares, preliminary expenses. So for 5 purposes, they can utilize securities premium. Whereas a company which is preparing financial statements in accordance with accounting standards, they can utilize securities premium only for 3 purposes: buyback, bonus issue expense. Next one, issue of shares at a discount. The general rule, no company can issue shares at a discount. If a company issues shares at a discount, it is a void. It is void, illegal, simply. So company should take back its shares and company should return money to the investor. But to this general rule, we are having two exceptions. One is sweat equity shares and the second one is issuing shares to the creditors under a settlement process. That may be statutory resolution plan or debt restructuring scheme. A company is not in a position to return money to the creditors, to repay money to the creditors. In that case, they will go with a settlement mechanism. So please waive off interest and we'll pay you 40% right now. Balance 60%, we will issue equity shares at a discount. So that is the concept. So in these two circumstances, a company is permitted to issue shares at a discount. Next concept, sweat equity shares. See, we are having two concepts: sweat equity shares, employee stock option. Both look similar, but both are not similar. Both look similar from point of employee. So these two types of shares, sweat equity, employee stock option. Under these two options, we will offer shares to the employees. But there is a difference between sweat equity and employee stock option. Sweat equity shares are given to the employees who provides their knowledge to the company, who provides their know-how to the company. See, I'm a talented employee in the company. Because of my services, the company is getting some competitive advantage in the market. Suppose, I developed one formula, I developed one medicine. This medicine can cure cancer, or this medicine can cure diabetes. And the cost of making this medicine is very less. Because of this formula, my company, my employer can get a competitive advantage in the market. So he can compete with all other pharmaceutical companies. So he can gain a top position. Now my company is getting this much advantage because of my services, because of my talent, because of my skills. So in order to hold me, company will issue shares to me. For my services, company will issue shares to me at a discount or for a consideration other than cash. So whatever formula I developed, we call it as intellectual property rights. Now I'm giving these intellectual property rights to my company. In return, company is giving shares to me at free of cost. Understood. So company point of view, it's a non-cash consideration. So these shares are given to the employees, no, only skilled employees for providing their knowledge, for providing their know-how services. Whereas employee stock option, here shares are given to all the employees of a class, particular class, all the managers, all the, assistant managers, like that, they will pick up a particular class of employees, and in that particular class of employees, whoever covered, they will get an option to subscribe share of the company. That is employee stock option. Both are different. And one more difference, sweat equity shares are issued at a discount with respect to face value. Suppose a company share face value is 10 rupee, market value is 100 rupees. Now, sweat equity shares are given at discount. That means, at a price less than 10. Whereas employee stock options, these shares are given at a discount to the market value, that is less than 100. So here, the price will be greater than 10, but the price is less than 100. So maybe, at 80 rupees or 90 rupees, employees will be given an option to subscribe shares of the company, that is ESOP. That's sweat equity share. It is given for a discount or for a consideration other than cash. So based on skills, sweat equity shares will be given, and not on the basis of the skills, but on the basis of some appraisal process. A particular class of employees will get shares under employee stock option plan. Ultimately, these both are just they are triggering factors to hold employees of the company, talented employees of the company. Okay, fine. This is the small concept about sweat equity and employee stock option. Now, what are the conditions a company should satisfy for issuing equity shares, sweat equity shares? First one, special resolution from members, and this special resolution is valid for 12 months only. That means within 12 months of special resolution, company must complete issuing shares to the employees at a discount, that is sweat equity share. And this special resolution should cover these aspects: how many shares a company is giving to the employees, what is the current market price, and what consideration company is getting, and who are the employees, details of the employees, directors to whom company is allotting sweat equity shares. Next one, in case of listed companies, they are required to comply SEBI regulations. Next, sweat equity shareholders rights, limitations, restrictions are similar to other equity shareholders rights, limitations, restrictions. Next important point from MCQ point of view, limit. In a year, company can issue sweat equity shares maximum 15% of paid up equity share capital or 5 crores, whichever is higher. During the lifetime of the company, a company can issue sweat equity shares maximum 25% of existing paid up equity share capital. Suppose existing paid up equity share capital is 100 crores. First year it can issue, first year of sweat equity, first year of issue of sweat equity, a company can go with 15 crores. Next year it can go up to 10 crores only. Why? Both put together 25%. What is the statutory limit? 25% of existing paid up equity share capital. For startup companies, the limit is 50% up to 10 years. They can go up to 50% of existing paid up equity share capital up to 10 years. And you have to make disclosures in the board reports. So details of the employees, details of the directors, to whom sweat equity shares were allotted. And you have to disclose the details of the members in register of members. Details of the members means, here the details of sweat equity shareholders in the register of members. All the entries in register of members shall be authenticated by company secretary or authorized person authorized by board for this purpose. And the definition of employee, the definition of employee is similar in both employee stock option plan and sweat equity share. So here employee must be a permanent employee. And this employee, the permanent employee, he may work in our company or in our holding company or in our subsidiary company, either in India or outside India. Next one, employee stock option, conditions for offering shares under employee stock option plan. First one, special resolution. And company can get special resolution only in the meeting. Yes or no? Come on, tell me. So for that, company should call for a meeting. So calling meeting, it is the duty of company to issue notice. Along with the notice, company should issue explanatory statement. And in that explanatory statement, company should disclose the following details. number of stock option, and details of the employees to whom the option will be given, and what is the appraisal process, on what basis you are offering these shares to the employees. Vesting period, this is the period, this is the time period within which employees should satisfy prescribed conditions. Exercise price, now market value is 100 rupee, exercise price is 80 rupees. That means at 80 rupees only he can subscribe the share of the company, he can become member of the company. Lock-in period, once shares are allotted in the name of employees, how long he cannot transfer those shares. And accounting treatment in the accounting books. So yes, company complied accounting standards while accounting these things in the books of accounts. For that, just furnish the statement in the explanatory statement. And important points of this concept now, important points, not everything, important points. The time gap between grant of option and vesting of option, simply exercise of option, should be minimum 1 year. And employees will not have any right to vote, will not have any right to the dividend till shares are issued in the name of employees. So first, once vesting period is completed, employees will be given an option to exercise the option. Now employee, if he exercise the option, that means, if he deposit that much money, if he satisfy all the conditions during vesting period, so he will be given shares. Shares will be allotted in the name of employee. Then he will get a right to vote, right to dividend. Until that point, he will not have any right to vote, he will not have any right to dividend. Next, all these options are not transferable. You cannot pledge, you cannot hypothecate. Once shares are allotted in your name and once lock-in period is completed, then you can transfer them, you can pledge them. Death of employee during employment, all the options vested in the hands of employee, all the options given to the employee shall be vested in the hands of deceased person nominee, deceased employee legal heirs. In case of permanent incapacity, during employment, employee fallen from height and his body got injured, permanent disability, then options will be vested on that day of permanent incapacity. In case of resignation or termination, whatever options granted to him gets expired. Next one, you have to disclose the details in the board report. Actually, some 10 disclosures are there. Out of 10 disclosures, this is the important disclosure. That's why I'll revise this point. The point is, you need to mention the details of employee wise. Employee wise, if that employee is a KMP. See, we offered stock options to 10 employees. Out of 10 employees, 1 employee is KMP. Now CEO is there. So mention the details of that KMP. Next one, any employee receiving options, 5% of the total options is receiving options, but the total options received by him is 5% of the total options or more than 5%. Then mention the details of that employee. Next one, employee received the shares under ESOP and total number of shares received by that employee under ESOP is 1% of the issued capital. Then mention the details of that employee also. 3% details you have to mention in board report. One is KMP getting shares under ESOP. Next, employee receiving 5% of total options. Next one, employee receiving 1% of issued capital under ESOPs. You have to mention these 3% details. Next, separate registers company has to maintain. In case of listed companies, they should comply SEBI regulations. In addition to Companies Act, they should comply SEBI regulations. Here. Next one, issue and redemption of preference shares. Just now I told you, preference share. It is a share which carry 2 preferential rights. One is preference with respect to dividend. Next one, preference with respect to redemption of capital. Now, for issuing these shares, what are the conditions a company should satisfy? First one, AOA authorization, Articles of Association authorization. Next, approval from members, special resolution. Why? You being a student of law, preference shareholders carry 2 priorities, 2 preferential rights. But how can you expect a normal layman to have this much knowledge? Understood. So tomorrow, when company declares dividend, first it will not pay dividend to the equity shareholders. First it will pay dividend to the preference shareholders. In the event of liquidation, company will redeem capital first to the preference shareholders, not to the equity shareholders. So this matter you have to communicate with equity shareholders, then only you should expect an approval from members. So that's why you have to mention the details of preference share capital. You have to disclose the details of preference share capital and priority of dividends and priority of the capital with the equity shareholders. Then only equity shareholders can make a sound decision. And this preference share capital can be classified into various categories on the basis of cumulative, on the basis of cumulative, on the basis of dividends, cumulative preferentials, non-cumulative preferentials. Cumulative preferentials means in any year, if dividend remains unpaid, if dividend is not paid, then that amount of dividend shall be carried to next year also. So cumulative accumulation will happen. 1 year, if company fails to pay dividend, that amount of dividend will be carried to the next year. That means company is required to pay 2 years dividends. If share is having that right, then that share is a cumulative preference share. No, sir. Whenever company declares dividend, preference shareholders will get a dividend, sir. In case of failure to pay dividend in any year, it will not be carried to next year. Then such shares are non-cumulative preference share. Next one, convertible preference shares. On the date of maturity, company will not pay money to the preference shareholders. Company will give equity shares. Company will give equity shares. Company will take preference shares and company will give equity shares. So here, sharing of ownership will happen. Sharing of ownership will take place in case of convertible preference shares. Non-convertible preference shares, company simply take back shares and company will return money to the preference shareholders. Now, so what type of preference shares you are offering? So what are the details? So disclose the details with equity shareholders. Equity shareholders will pass resolution covering all these aspects. Next one, voting rights, redemption. So furnish the details of preference shares with equity shareholders. Next, a company is prohibited from issuing irredeemable preference shares. A company can issue only redeemable preference shares with a maximum tenure of 20 years. Of course, if your company is engaged in infrastructure projects, the maximum tenure is 30 years. However, from 21st year onwards, every year 10% redemption should happen, at least 10%. So by the end of 30th year, everything gets redeemed. Every capital, every preference shareholder will be redeemed. So these are the conditions for issue of preference shares. Redemption of preference shares. Conditions for redemption of preference shares. Only fully paid up preference shares can be redeemed. And for redemption, yes, definitely company require money, yes or no? So from where they get money? For redeeming face value, company can utilize accumulated profits or company can utilize issue proceeds of fresh issue. So here, redemption value, suppose, it is 12 rupees. Face value is 10 rupees. Redemption value is 12 rupees. That means, premium on redemption is how much? How much is the premium on redemption? 2 rupees is the premium on redemption. 2 rupees is the premium on redemption. Now, for redeeming face value of 10 rupees, company can utilize accumulated profits or company can utilize issue proceeds of fresh issue. Suppose company decides this option. In that case, nominal value of shares so redeemed shall be transferred to CRR account. So like this, general reserves account debit to CRR account, 10 rupees. And this CRR can be utilized only for one purpose, that is issuing fully paid up bonus shares. Understood. And for redeeming premium on preference shares, you can utilize company profits, you can utilize company securities premium. Of course, if you are a company preparing financial statements in accordance with accounting standards, then you can't utilize securities premium for redemption of premium on preference shares. You can utilize only company profits. Next one, deemed redemption. So this is not actual redemption, this is deemed redemption. The company is not in a position to redeem preference shares and tenure also completed, 20 years tenure completed, and it is not in a position to redeem. Then it can go with deemed redemption. So under deemed redemption, what company will do? First, it will call for a meeting of preference shareholders. So it will communicate its financial position, why it is unable to redeem at present. And finally, it should get a consent of 3/4 of issued share capital. So after getting consent, company is required to file an application with NCLT. NCLT approval is compulsory. NCLT will give you approval provided the dissenting shareholders shall be redeemed in cash. Dissenting shareholders who are against to the deemed redemption, So they should be repaid in cash first. So once dissenting shareholders were repaid, then NCLT will give you approval to convert old capital into new capital. So here what happens, company will take old shares and company will issue new shares. And we assume that redemption take place. That's why I call it as deemed redemption. And ultimately, company has to communicate the same with ROC. Form SH7, the time limit is 30 days. Here, next one, transfer and transmission of securities. Beginning of this chapter, I told you share is a mobile property and shares can be transferred according to the uh, provisions of articles of association. I told you, yes or no. Now for transferring these shares, yes, there are some conditions. Transferor and transferee should satisfy these conditions, then only transfer will take place. First, they need to execute proper instrument of transfer, SH4. That instrument of transfer, that instrument deed shall be dated, stamped, and it should contain details of the transferee, complete details, name, surname, father name, address, occupation, everything. And this document should be executed by both the parties. Once the document is executed, within 60 days from the date of execution, it is the duty of transferor or transferee to deliver these documents with company. And if instrument is lost, then furnish indemnity bond. Instrument is lost, then furnish indemnity bond. Now, after receiving these documents, what company will do? Company will proceed with registration of transfer and company will issue share certificate in the name of transfer. Suppose shares involved in the transfer are partly paid up and this application is filed by transferor alone. This application is executed by transferor alone. Then company shall not register the transfer without giving intimation to transferee, without giving notice to transferee. So your company will give notice to the transferee. Yes, the shares involved in this transfer are partly paid up. If you have any objection, raise your objection within 2 weeks of the notice. If there is no objection from transferee, then company will proceed with registration of transfer. Understood. Now the above requirements like execution of transfer deed, stamping of transfer deed, submission of documents to the company within 60 days. Next one, intimation in case of partly paid up shares. All these requirements are not applicable in case of transmission of securities. So what is transmission? Transfer is a voluntary act. Transmission is by operation of law. In case of death of the member, insolvency of the member, lunacy of the member, the properties of this person gets transmitted to the next person. In case of death, legal heirs will become owner of the property. In case of insolvency, official assignee will become owner of the properties of insolvent person. Understood? So transmission, it happens through operation of law. So in case of transmission, execution of transfer deed, stamping of transfer deed, submission of documents to the company within 60 days of the event is not required. Just a letter intimating transmission is sufficient. Next one. So this is the duty of company to issue security certificates and these are the time limits. Subscribers to the memorandum of association should get a share certificate within 2 months from incorporation date. Allottee of share should get a certificate within 2 months from allotment date. Transferee of security should get share certificate within 1 month from the receipt of transfer instrument by the company or intimation of transmission by the company. Allottee of debenture should get a certificate, debenture certificate within 6 months from allotment date. And in case of transmission, the legal representative of deceased member will get 2 options, either register shares in his own name, transmission, or register shares in the name of other person, direct transfer. That means without becoming a member, he can sell those shares to the outsider, direct transfer. So any option he can exercise. In case of default, company failed to deliver certificates within the time limits mentioned. Just now I discussed with you, 2 months, 1 month, 6 months. If company failed to issue certificate within the prescribed time, then company is punished. Company will be punished with a fine minimum 25,000, maximum 5 lakhs. Default officer minimum 10,000 rupees fine, maximum 1 lakh rupees is the fine. Next one, punishment for personation of shareholder. Punishment for personation of shareholder. Mr. Shiva is a member of a company, is the owner of company. He is holding a share certificate with 100 shares. So he is the owner of 100 shares. I'm asking you, do you think only a one person in India will have a name Shiva? No. Many people will have name Shiva. Yes or no? So another person with same name Shiva, he went to company and he is making a statement like this: sir, I'm the member of a company. You can check the details in the register of members. I lost my share certificate. Please give me duplicate share certificate. Or I didn't receive any dividend. I'm the member. I'm the owner of the company. So please pay me the dividend. I'm asking you, is this fellow a real member? No. He is representing himself as a member of the company. Actually, he's not a member. He's a dummy. He's a dummy. But he is representing himself as a owner of a company in order to obtain a security or in order to obtain money. That thing we call it as personation. Whatever he is doing, we call it as personation, changing the identity in order to get illegal advantages. And what is the punishment to that person? Punishment, imprisonment and fine, 1 year to 3 years, and fine 1 lakh to 5 lakhs. Clear? Next one, refusal of registration and appeal against refusal. See, whenever company receive documents for registration of transfer, it is the duty of company to register the transfer. Of course, company had an option to reject the registration. Suppose, shares involved in the transfer are partly paid up. They are not fully paid up, they are partly paid up. And the transferee is minor, or transferee is financially incapable person. Tomorrow, if company make calls on shares, that fellow can't make call, that fellow can't pay call amount. In that case, company is free to reject the transfer. So these are the valid grounds for refusal of registration of transfer. So in those cases, there will be no problem. Yes, company is having a freedom to reject the transfer registration. But some cases, the company on some basis it is refusing to register transfer, and that basis is not genuine. That is not a correct basis. Intentionally, company don't want the transferee to become member of the company. That's why intentionally it is refusing. Actually, it is a wrong thing. In that case, the transferee, the aggrieved party, simply transferee, can file a petition with NCLT. First of all, whenever company receives documents for registration of transfer, it should deliver share certificate within 1 month from the receipt of documents, or else it is having a duty to give notice of refusal within 30 days of delivery of documents. Either of these two things should happen. Either give share certificate in the name of transferee, or notice of refusal to the transferor or transferee or person intimating transmission. Now the transferee of a company, transferee of shares can file a petition with NCLT. In case of private company, the transferee has to file an appeal with NCLT within 30 days from receipt of notice. Within 30 days from notice, transferee has to file a petition with NCLT. Suppose transferee didn't receive any notice. Transferee didn't receive any notice of refusal. Then within 60 days from delivery of documents for registration, this transferee should file a petition with NCLT. NCLT will accept those cases. Even after expiry of time limits also, if transferee is able to show proper grounds that because of this reason I didn't file appeal within the prescribed time or within the reasonable time, then NCLT is having a freedom to accept that appeal. And if your company is a public company and you refuse to register transfer of shares, then transferee within 60 days from notice shall file an appeal with NCLT. In case of no notice, then within 90 days from delivery of documents for registration, transferee shall file appeal with NCLT. Now finally, NCLT will pass the order either confirming the registration or confirming the refusal of registration. So NCLT will pass an order, and it is the duty of company to comply the NCLT order. Contravention, the default officer will get a punishment, imprisonment 1 year to 3 years, and fine 1 lakh to 5 lakhs. Next one, rectification of registers. I'm not the member of company, but my name is recorded in the register of members. Actually, I'm not the member, but my name is recorded as a member. Or I'm a member of a company, but my name is omitted from the register. Or I'm a transferee of shares. Transfer was registered, but my name is not getting entered into the register. Now, company is making unnecessary delay in entering my details in the register. So, in these three cases, the aggrieved person can file a appeal with NCLT. Can appeal to NCLT. And if you are a person outside India, if you are a foreigner, if you are a person resident outside India, then no need to come to India, no need to file appeal with NCLT. You can file appeal with competent courts outside India. And NCLT or competent courts outside India shall pass an order for rectification, and it will order company to compensate the damages of the aggrieved party. Failure to comply NCLT orders, company 1 lakh to 5 lakh rupees punishment, default officer imprisonment up to 3 years, fine 1 lakh to 5 lakhs, sometimes both, either imprisonment or fine or both. So with this, transfer and transmission of securities related provisions completed. Next one, alteration of share capital. Alteration of share capital. Sir, in how many ways we can alter capital clause of MOA? You can alter capital clause of MOA in 5 ways. How many ways? 5 ways. One is increase of capital, increase of authorized share capital. Second one, decrease of authorized share capital. Consolidation and divide, split, conversion into this stock. Suppose present my authorized share capital is 1 lakh. 10,000 shares. Each share 10 rupees face value. I decided to increase this capital from 1 lakh to 2 lakhs. So this is one alteration. I decided to reduce the share capital. Suppose out of 10,000 shares, only 8,000 shares were issued so far. And I had no intention to issue 2,000 shares in future. In future also, I won't issue 2,000 shares. Then what I'll do? I'll cancel unsubscribed shares. I'll cancel unsubscribed shares of 2,000. So now my capital gets reduced to 80,000 rupees. So this is also alteration of capital. Consolidate and divide. So here what I'll do, 10 shares of 10 rupees each, I'll consolidate and I'll divide it into 2 shares of 50 each. Getting my point? So 10 shares of 10 each means 100 rupees. Now getting divided into 2 shares of 50 rupees each. So there is no financial effect actually, but the number of shares getting reduced and face value of share is getting increased. Next, split. So here what I'll do, share face value, how much it is? 10 rupees. I'll split each share into 5 rupees. So here what will happen? 20,000 shares into 5 rupees. So there is no change in capital, but there is a change in number of shares and face value. Next one, conversion of shares into stock, reconversion of stock into shares. Suppose 1 lakh rupees is the capital. Now what I'll do, 80,000 rupees capital and 20,000 rupees stock. Like this, I can convert. So these are the 5 ways for altering capital clause of MOA. And the conditions a company should satisfy for alteration of share capital, first AOA authorization. Next, members approval, ordinary resolution is sufficient. Next, ROC filing, intimation with ROC filing. So form SH7, the time limit is 30 days of the alteration. 30 days of the event. Next concept, further issue of shares. Initial issue of shares will take place at the time of incorporation. Just now I discussed with you section 56. Upon incorporation, within 2 months, company will issue shares in the name of forgot. Within 2 months of incorporation, company shall issue share certificate in the name of subscribers of MOA. That is initial issue. Any issue subsequent to initial issue, we call it as further issue. And this further issue, company is having 3 options. First, it will give priority to the existing members. Why? They are owners of the company. First, company has to communicate with existing members. If existing members are ready to subscribe additional shares, then company can proceed with the rights issue. No, existing members are not in a position to subscribe new shares. Then with the special resolution, you can go with employees. This is also a better option. Employees, internal part of the organization only. The existing members know about the company, employees know about the company, so no much pressure, no much tension. Suppose employees are also not in a position to subscribe the shares under ESOP, then no other option, go with outsiders, go with others. If you are going to public at a large, then prepare and issue prospectus. If you are going with identified persons, then go with a private placement. But for that, special resolution is compulsory. Registered valuer valuation report is also compulsory. However, if you are going with outsiders, some situations, special resolution, registered valuer valuation report is not required. So what are those cases? In cases of conversion of capital, conversion of debentures, conversion of loans into equity shares. 10 years back, company issued convertible debentures. Now, it is the duty of company to convert debentures into equity. At the time of conversion, member special resolution is not at all required. Why? At the time of issue of convertible debentures itself, company should obtain special resolution. So at the time of issue of convertible debentures, company already obtained special resolution. Now, no need of fresh special resolution for conversion. Understood? So conversion of debentures or loans into equity, either voluntarily or mandatorily, no need of special resolution. Next one, rights issue. So if company decides to offer shares under rights issue, then company should give a notice to the existing shareholders at least 3 days before opening. At least 3 days before opening of offer period, company shall intimate existing shareholders about rights issue. And this offer period, subscription period should be minimum 15 days, maximum 30 days. And existing shareholders are also had a benefit of renouncement. If they want, they can subscribe additional shares, or they can transfer additional shares to the outsiders without subscribing those shares. Without subscribing those shares, they can transfer those rights to another person. Next one, on expiry, whatever shares which were not subscribed by the existing members, board of directors had an option to dispose them. They can sell them or they can issue them in a manner which is not disadvantageous to the company. The board of directors had an option to dispose unsubscribed shares in a manner which is not disadvantageous to the company. Next, bonus shares. Bonus shares. Issue of bonus shares. Now, what are the conditions a company should satisfy for issuing shares at free of cost? Bonus shares, these shares are given at a free of cost. Member is not required to pay a single rupee for getting this share. Understood? So the other name for bonus issue is capitalization of profits. So here what company will do? Company will convert its profits into capital. How? I'll just show you one journal entry. CRR account debit, free reserves account debit, securities premium account debit to equity share capital. Suppose 10 rupees, 10 rupees, 10 rupees, equity share capital 30 rupees. So here the company capital is getting increased, but company is not getting money. Company issued these shares for money. The entry would be like this: bank account debit to application security application account. Security application account debit to equity share capital. The entry will be like that. But here company is getting nothing. It's just an internal adjustment. So whatever reserves, whatever premium, whatever CRR company is having, so they are just capitalizing these profits. Reserves includes general reserves, free reserves, but reserves excludes revaluation reserves. The reserve that was raised because of revaluing the assets. So yes, previously land is 100 lakhs. Right now, the market value of land increased to 200 lakhs. Now there is a revaluation of, if company decides to revalue its property, so instead of showing 100 lakhs, if it starts showing it at 200 lakhs, that means they revalued the asset, and the profit from such revaluation is 100 lakhs. But this is not a profit which is available in cash. Profit was not realized in cash. So these profits, these reserves, you cannot utilize for payment of dividends and for issue of bonus shares. The other conditions: AOA authorization compulsory, board recommendation, and subsequent to board recommendation, members approval is also compulsory. And company should not have these defaults, interest on deposits, debentures, bonds, as well as principal amounts, redemption of debentures, repayment of deposits, redemption of bonds. Company should not have default with respect to these payments. If company had these defaults, then company cannot issue bonus shares. Next, only fully paid up shares can be issued as bonus shares. Partly paid up bonus shares concept is not there. And the person holding partly paid up shares, he will not get bonus shares. First, his partly paid up shares should be converted into fully paid up. So he should pay the balance amount. So fully paid up shareholders are entitled to fully paid up bonus shares. And these bonus shares shall not be issued in lieu of dividend. In the place of dividend, every year company is paying dividends. Now, company declared dividend. The declared dividend shall always be paid in cash. The declared dividend you cannot discharge in the form of bonus shares. So bonus shares can't be issued in lieu of dividend, in the place of dividend. Next one, reduction of capital. Reduction of capital. Conditions for reduction of capital is very simple, but the concept of reduction of capital is somewhat difficult. So next 2 minutes, listen carefully. Reduction of capital is different, decrease of capital is different. In case of decrease of capital, we will cancel unsubscribed shares. Here we are going to cancel issued shares. Here we are going to cancel subscribed shares. Capital. Understood? See, first one, reduce or extinguish liability. The liability of members is determined by face value and paid up value. Suppose face value 10 rupees, paid up value 8 rupees. Now what is the liability of members? Tomorrow if company make calls on shares, or tomorrow if company, imagine company is getting into the liquidation and company assets are not in a situation, not in a position to discharge outside liabilities, then liquidator will make calls on shares, right? So liquidator will collect contribution amount from contributories. That means the maximum liability of members is unpaid value, and the unpaid value is 2 rupees. A company is planning to reduce this face value to 8. Now 8 minus 8, 0. Extinguishment of members liability. Our company decided to reduce face value to 9. 9 minus 8, 1 rupee. No, the liability of member is getting reduced from 2 to 1. So extinguishment of members liability or reduction of members liability. This is case 1. Next one, cancellation of unrepresented capital. So let's have a look on one company balance sheet. Equity share capital 10 crores, outside liabilities 20 crores, realizable value of assets 26 crores, profit and loss account debit balance 4 crores. Yes, balance sheet tallied, I agree. But the point is, certain portion of capital is not available in the form of real asset. If you observe P&L debit balance 4 crores, tell me who will purchase this asset? Can you purchase this asset for 4 rupees? At least 1 rupee? No, this is not a real asset. So certain portion of capital is not available in the form of assets. So unrepresented capital, lost capital. Now I'm going to write off that capital. So after reduction, it looks like this. Equity share capital 6 crores, outside liabilities 20 crores, assets 26 crores. The total 26 crores. Now what I did, I cancelled unrepresented capital. So face value 10 rupee, actually paid up value is also 10 rupee. Now what I'm doing, I'm reducing 4 per share. 4 per share. So 10 minus 6. So this is member liability, maximum liability 4 rupees. So without extinguishment, without reduction of members liability, in case of cancelled unrepresented capital, cancellation of unrepresented capital. Or suppose, I'm also reducing this face value to 6 rupees. Now 6 minus 6, 0. That means extinguishment of members liability. Next one, pay off unwanted capital. See, we are having surplus funds and company wants to return some portion of funds to the members. Some company wants to reduce its liability with respect to equity shareholders. So company decided to return 2 rupees per share, which is not wanted, unwanted capital. Company decided to return 2 rupees to its members, 2 rupees per share. So pay off unwanted capital. So originally face value 10 rupee, paid up value 10 rupee. Now I'm returning 2 rupees to the members. So face value 10, paid up value 8. Member liability is 2 rupees. Suppose if I reduce face value along with paid up value, 8 minus 8, 0, extinguishment of members liability. So this is the concept of reduction of capital. But for reduction of capital, the conditions a company should satisfy Now what are those conditions? First one, special resolution. Second, no default with respect to deposits. Company should be regular in payment of interest on deposits. Company should be regular in repayment of deposits. If any default company commits with respect to deposits, it cannot proceed with reduction of capital. Next, the company has to file application with NCLT. Along with application, company has to attach the details of the creditors and auditor certificate regarding accounting of reduction of capital in the books of account. Now, NCLT shall forward this application to CG, ROC, and if a company is a listed company, then to SEBI and then creditors of the company. And NCLT will wait for 3 months for objections from these parties. If there is no objection from these parties, then NCLT will proceed with the order for reduction of capital. Immediately, the company should publish this order in 2 newspapers, or else the punishment is 5 lakhs to 25 lakhs. And it is the duty of company to file a copy with ROC within 30 days of NCLT order. Once after filing with ROC, the capital reduction is said to be completed, is said to be effective. And tomorrow, if it is proved that there is some misstatements, there are some misstatements in the creditor details, like I'm unsecured creditor, but my name is disclosed as secured creditor. Next one, company is liable to me 20 lakhs, but in records it is showing just 2 lakhs. Or I'm the creditor of company, but my name is not recorded. My name is not mentioned in the details of the creditors. So these are the examples of misstatements. In these cases, the members punishment on the company. The defaulting officer will get punishment under section 447, and members will also get a punishment. Actually, this is not a punishment, but the point is, members on the date of reduction, the persons who are members as on date of reduction, those people will get original liability. Suppose in first case I told you 10 rupees is the face value, a paid up value is 8 rupees. So unpaid value how much? 2 rupees, right? So now what company is doing? It is planning to reduce face value to 8. 8 minus 8, 0. So now the member liability became 0. But this happened with misstatements in the creditors list. In that situation, NCLT is having power to lift this NCLT's order. Previously, it issued order for reduction of capital, right? So it will cancel that order. Now the persons who are members as on date of reduction, so what is their original liability? Sir, their original liability is 2 rupees, sir. After reduction, their liability became 0, sir. Okay, in the place of 0 liability, they will get original liability of 2 rupees per share. So this is all about reduction of capitals. Simple concept only, but concept is difficult to understand. Conditions for reduction of capital you can easily remember. Next concept, restrictions on purchase of its own shares. A company can never purchase its own shares. Suppose you are having a mobile, it's your mobile. Can you purchase your mobile? Can you purchase it? Can one purchase their own assets? No, not at all. No company had power to buy its own shares, exception buyback and redemption of preference shares. See, the general rule, what the general rule is telling, suppose if you look at the balance sheet of a company, equity share capital 10 crores, outside liabilities 5 crores, fixed assets some 10 crores, cash and bank balance 5 crores. Now, according to the general rule, company shall not purchase its own shares. Means, after purchase, they want to show like this: equity share capital 10 crores, outside liabilities 5 crores, fixed assets 10 crores, cash and bank balance 3 crores, investments in my company, investment in company 2 crores. This is prohibited. This is prohibited. You can't purchase your own shares. However, in buyback and redemption of preference shares, company is going to cancel those shares. Company is going to cancel those shares. So that's why a company can purchase its own shares under buyback. It is not going to show it as an investment in its balance sheet. Next one. To this general rule, we had 2 exceptions. One is Nidhi company and the other one is private company or specified IFSC public companies in which no other body corporate is a member and its total borrowings are less than 2 times of the paid up share capital or 50 crores, whichever is less, and company has not committed any default in repayment of aforesaid borrowings. So this private company, specified IFSC public company satisfying these 3 conditions, for them this general rule is not applicable. Next, prohibition on indirect purchase. So direct to purchase prohibited. Indirect to purchase is also prohibited. Sir, indirect purchase means what? Company will not purchase its own shares, but company will advance its money to employees. Company will advance money to someone in order to acquire shares of the company. So this is also prohibited. However, this rule is having three exceptions. One is lending business. Take a State Bank of India, for example. It is in the business of lending. I applied for a loan of 4 lakhs. With that 4 lakhs, I acquired SBI shares. Do you think SBI will monitor me, the borrower? So what he is doing with the funds? Their business is, their ordinary business is lending. So for them, this rule is not applicable. That means, the borrower of the company can acquire shares of that company if that company is in lending business. Next one, employee loans. Sometimes, employee is having a goal to become member of the company, but he is not having sufficient resource, sufficient money. In that case, company can advance loan to the employee in order to acquire shares of the company. But this should be genuine. For that, some three conditions were specified. One is employee should not be KMP, employee should not be director. So KMP, director, they can't get this privilege. Maximum you can finance an employee up to 6 months salary. Maximum loan amount can be 6 months salary. And with that money, employee can acquire only fully paid up shares. So partly paid up shares. Suppose if he acquire partly paid up shares, then that situation will not be covered in exceptions. So company will get punishment. If these three conditions are satisfied, then advance by company to the employee is not at all an offense. Next one, scheme. So here, company decided to form a scheme, to prepare a scheme for the benefit of employees. Accordingly, company wants to advance the person of the scheme, person in charge of the scheme, in order to acquire shares of the company. So this is also not treated as an offense, provided three conditions are satisfied. First one, special resolution for forming this scheme, and this scheme should be for the benefit of employees. And the in charge of the scheme, the person, whoever is appointed as an in charge to the scheme, must acquire fully paid up shares with the money advanced by the company. Non-compliance of this section, punishment, company 1 lakh to 25 lakhs, default officer up to 3 years imprisonment, fine 1 lakh to 25 lakhs. Next one, buyback of securities. So buyback of securities, here company is returning money to the investors and company is taking back the securities. So conditions for buyback of securities, AOA authorization. Next one, approval of the authority. See here some two to three limits are there. Just observe these three limits carefully. And one more limit is also there. So total 4 limits are there. See, this first limit is all about amount to be invested in buyback. Rupees buyback amount. So amount company should mobilize for making buyback. And this limit is all about number of shares, quantity of shares a company can make buyback. And this is with respect to debt equity ratio. Okay, so company is having 10,000 shares actually. So in a year, at a time, company can make buyback up to 25% of paid up equity share capital. That means 2,500 shares it can make buyback at a time. The second one, for making buyback of these shares, the amount company, if it want to spend amount on buyback, then if that amount is up to 10% of paid up equity share capital plus free reserves plus securities premium, then board resolution is sufficient. Sir, exceeding 10%, sir, special resolution. But even with special resolution, you can spend maximum 25% of paid up share capital plus free reserves plus securities premium on buyback. Suppose my capital is 10 lakhs. My capital is 1 lakh. My free reserves 1 lakh. My securities premium 1 lakh. So total 3 lakhs. 3 lakhs into 25%. I can spend maximum 75,000 rupees on buyback. And I can buy back maximum 2,500 shares. Post to buyback, the debt equity ratio shall not exceed 2:1, maximum 2:1. For every 1 rupee own funds, yes, maximum debt can be 2 rupees. And sources for making buyback, money sources. You can utilize free reserves, you can utilize securities premium, you can utilize issue proceeds of different class of securities, not same class of securities. But if you select reserves, then the nominal value of shares you bought back shall be transferred to CRR account, capital redemption reserve account, and only fully paid up shares can be bought back. If your company is a listed company, then follow SEBI regulations. Maximum time gap between minimum time gap between two buybacks shall be 1 year. Minimum 1 year gap should be there between one buyback and another buyback. Closure of one buyback and opening of subsequent buyback. Minimum time gap 1 year. And for buyback, from where we can buy our securities, from open market, or on proportionate basis from existing members, or from the employees to whom you issued shares under ESOP or sweat equity. So you can avail any of these three options. From that option only buyback should be completed. And the buyback should be completed within 1 year, within 12 months from the date of resolution. The 12 months completed, sir, buyback not completed, then once again take approval from the authority. Next one, it is the duty of company to prepare a declaration of solvency stating that company is a solvent company and company will not commit any defaults in repayment of loans or payment of interest on loans for the next 1 year. So in the next 1 year, even if company goes into liquidation, the company assets are sufficient to discharge company liabilities, and that declaration shall be signed by 2 directors. One should be managing director. Next one, extinguishment of securities. Once buyback is completed within 7 days, yes, destroy all the securities. Destroy all the securities. Next one, cooling period on further shares. Cooling period on further shares. So cooling period means what? Once buyback is completed, for the next 6 months, you are prohibited from issuing similar class of securities. The securities involved in the buyback, you can't issue for next 6 months. Of course, we had some exceptions. Under exceptional circumstances, like conversion of preference shares into equity, debentures into equity. Next one, stock options, sweat equity shares, bonus issue. In these cases, you can issue the securities involved in buyback. My authorized capital is 1 crore. My paid up share capital is 50 lakhs. And I made a buyback of some 10 lakhs here. I made a buyback of 10 lakhs in this class capital. Now authorized share capital is 1 crore. Paid up share capital is 40 lakhs. So you can see here, I'm having a power to issue 60 lakhs worth of capital. But this 60 lakhs worth of capital, you can't issue within the next 6 months after completion of buyback. Next, once buyback is completed, file return of buyback with ROC, and if you are a listed company, along with ROC, file a copy with SEBI. Punishment for contravention, company and defaulting officer will get a punishment 1 lakh to 3 lakhs. This point already discussed with you. And if company is having following defaults, up to 3 years after rectification, company is prohibited from making buyback. What are those defaults? Deposits, interest on deposits, debentures, preference shares, dividends on preference share capital, term loans, principal amount, and interest on term loans. If company is with these defaults, then company is prohibited from making buyback of securities. So what is the ban period? 3 years after rectification. The rectification year, next 3 years, completely banned. Then next you can proceed with the buyback. Last concept of this chapter, debentures. Debentures, the definition of debenture, debenture includes debenture stock, bonds, and any instrument of a company evidencing a debt. Company issued an instrument, and if that instrument is evidencing a debt to the company, then it is a debenture. So for issuing debentures, what are the conditions company should satisfy? First one, if company decides to issue convertible debentures, then special resolution is compulsory. So special resolution is required at the time of issue, not at the time of conversion. At the time of conversion, special resolution is not required, but at the time of issue of convertible debentures, special resolution is required. And issuing debentures with voting rights is prohibited. Debenture holder is a creditor, is not an owner. So he is not an owner, so he will not get any voting rights. Next one, company can issue secured debentures with a tenure maximum 10 years Of course, if company is from infrastructure background, infrastructure debt fund companies, finance companies, infrastructure project companies, they can go with a tenure of 30 years. And if company decides to issue secured debentures, then they need to create charge on the properties covering the value of debentures and interest on debentures. And company should appoint a trustee, debenture trustee, within 60 days after allotment of debentures. And whenever company is making a public offer for issue of debentures, or when an offer is made to the members exceeding 500, these cases appointment of debenture trustee is compulsory. The following persons are disqualified to act as a debenture trustee. Sir, who are they? A beneficial member, person holding shares with a beneficial interest, disqualified. Promoter, KMB, director, officer of cash companies, or company, associate company, subsidiary company, holding company. So four persons of these four persons of four companies are disqualified. Creditor of the company disqualified. Debtor of our company, associate, subsidiary, holding, subsidiary of holding company also disqualified. Guarantor with respect to debentures disqualified. A person having pecuniary relationship with company also disqualified. Pecuniary relationship means the transactions between the person and company amounting together 2% of the turnover or total income, or 50 lakhs, whichever is less. The last two preceding financial years, or current financial year. So the reason of these disqualifications is to protect independence. If you appoint these persons as debenture trustee, they may not take a decision in favor of debenture holders. They will try to protect their interests, and they may end up with taking a decisions which are opposite to debenture holders. Next one, removal of trustee. For removing trustee, you have to get consent of 3/4 of debenture capital holders. So debentures total worth 10 crores. 3/4 of debentures means 7.4 crore. Sorry, 7.5 crore. Now holders holding at least 7.5 crore of the debentures can remove trustee. Next one, company should pay interest on periodical basis, and company should redeem debentures at the end of the tenure. Next, if company makes a default in payment of interest, or if company makes a default in repayment of redemption of debentures, then debenture holder can file an application, can file an application with NCLT, can file a petition with NCLT. Sometimes even trustee can file a petition with NCLT stating that, sir, company is making company is entering into more and more obligations, company is acquiring more and more loans. So definitely tomorrow it may not redeem all the debentures, so please stop the company from entering into new loan contracts. Like that, trustee can file an application with NCLT. Next one, debenture redemption reserve. This is a reserve created from free reserves, and this reserve is having an obligation. That obligation, you can utilize this reserve only for redemption of debentures. You can't utilize this reserve for writing of preliminary expenses or for payment of dividends, for declaration and payment of dividends. This is not allowed. And this debenture redemption reserve is not applicable to all companies. It is applicable only to few companies. See, this is applicable only to the unlisted companies. And the amount of debenture redemption reserve should be minimum 10% of outstanding debenture. This DRR is not applicable to all India financial institutions, banking financial institutions, listed companies. Even unlisted companies, even NBFC, housing finance companies, even they are unlisted, no problem. For them also DRR is not applicable. But all the companies, by the end of 30th April of the year, they should invest at least 15% of debentures maturing current year plus year and a specified securities. The highlight of the specified securities is they are highly liquid. They are highly liquid in nature. It's like a reserve money only. So we are putting some 15% of debentures maturing in the current year and the next year in a locker like that. Liquid assets means, so whenever you face liquid crunch, you can readily sell them, you can easily sell them, you can convert them into cash, and you can adjust against redemption of debentures. And immediately within reasonable time, you need to increase that specified securities. For example, current year plus next year, next year, we are having obligation to redeem 100 crores debentures. So into 15%, right now 15 crores maintained in the form of specified securities. One day you are facing a financial crunch, and debenture holders came to company for redemption, the value is 5 crores. You're not having money. So what you do, just sell 5 crore as 5 crore of specified securities and redeem them. So now balance and specified securities fall into 10 crores, whereas outstanding debentures is 100 minus 5, 95 crores. 95 into 15% means how much? 95 into 15, 14.25. But the balance in specified securities is 10 crores, right? So make an immediate adjustment, readily make an adjustment so that this 10 crores investment of 10 crores in specified securities should increase to 14.25 crores. But at that point of time, when debenture holder is in front of you, so making some adjustments will take a time and it creates some panic situation among debenture holders. That's why first sell the specified securities. Later, just increase that investment in the specified security. With this, share capital and debentures revision is complete. The next chapter for marathon is management and administration. In this chapter, I will revise all the provisions of Companies Act with respect to general meetings. As you all know, one of the most important characteristics of the company is separate legal entity. Company is separated from its owners. Owners will contribute funds whenever company need funds, and company will carry business operations with the funds contributed by owners. Yes or no? Company being an artificial person, it cannot carry business activities on its own. That's why company appoints directors. Company will have management, and management will manage all the affairs of the company. Now, the owners who contributed funds to the company, they are very much interested to know the financial position of the company, financial performance of the company. Understood? So, for discussing these matters regarding financial position of the company, performance of the company, a declaration of dividends, appointment of the auditors, and appointment of the directors, so general meetings will take place. The general meeting is a place where members of the company will come together and will meet each other. And these general meetings are of two types: annual general meetings, extraordinary general meetings. Annual general meetings, every company except 1% company is required to conduct one annual general meeting in a year. Extraordinary general meeting is a general meeting other than annual general meeting. And this annual general meeting is of two types: first AGM, subsequent AGM. First AGM, upon incorporation, for the first time, if company is conducting annual general meeting, we call it as first annual general meeting. Applicability, it is applicable to all companies except 1% company. As you all know, meeting requires minimum 2 members, minimum 2 persons. In case of 1% company, you will find only one person, only one member. So meeting is not possible in OPC. Next one, time limit. So what is the time limit for first AGM? The time limit is 9 months from the closure of first financial year. So when first financial year gets closed, it depends on date of incorporation of a company. So if date of incorporation of a company falls on or after 1st January, suppose 1st January 2024, then first financial year closure date shall be 31st March of following year, that is 31st March of 2025. Other cases, others, 31st March 2024. 31st March 2024. Others means, company incorporated before 1st January. 1st January 2024. Now, this is the last date of first financial year. To this last date, add 9 months. Now, you will get due date of first AGM. So, 31st December 2025. In case company is incorporated on or after 1st January 2024. For other companies, which is incorporated before 1st January 2024, 31st December 2024 is the due date for first AGM. Next one, subsequent AGM. Any annual general meeting subsequent to first AGM, we call it as subsequent annual general meeting. Applicability, it is applicable to all companies except 1% companies. And what is the time limit for subsequent AGM? Here we are having 3 time limits. Out of 3 time limits, whichever is earliest, you have to consider it as due date for subsequent AGM. The first limit is within 6 months from closure of financial year. Closure of financial year, imagine the last date of financial year is 31st March 2025. To this, add 6 months. So 30th September 2025 as per first limit. Time gap between two annual general meetings shall not exceed 15 months. Imagine in the previous financial year, in the previous year, AGM was conducted on 31st August 2024. Now to this add 15 months. Add 15 months. 30th November 2025 is the due date as per second limit, and every year one annual general meeting compulsory. So with respect to calendar year 2025, the last date is 31st December 2025. So out of these three limits, whichever is earliest we have to consider, whichever is earliest, that is 30th September 2025. Out of three time limits, whichever is earliest, you have to consider it as due date of subsequent AGM. Is it clear, everyone? Are you able to follow me? Next, extension. ROC can extend due date of subsequent AGM up to 3 months for any special reasons shown to ROC. See, this extension benefit is not applicable to first AGM. First AGM already extra time is given, 9 months, total 9 months time is given for conducting first AGM. For subsequent annual general meetings, yes, time extension is possible. Who is having authority to extend due date of subsequent AGM? ROC. And what is the maximum extension period? 3 months. Clear? So for that, company is required to file an application. Sir, because of these reasons, we are unable to conduct an annual general meeting within due date. So please grant us some extension. So ROC is having power to extend the due date of AGM up to 3 months. Conditions. Day of annual general meeting. So you can conduct general meeting on any day except national holiday. So for the time being, we are having 3 days as national holidays. January 26th, August 15th, and October 2nd. So any day which was declared as a national holiday by the central government, we call it as national holiday. You can conduct AGM on any day except national holiday. Time of AGM during business hours. The commencement time of AGM shall be between 9 a.m. and 6 p.m. It should not start before 9 a.m. It should not start after 6 p.m. The commencement time should be between 9 and 6. Place of AGM. First option, registered office. And if you feel that registered office place is not sufficient for general meeting, then you can conduct general meeting at any place in the city, town, village where registered office is situated. Any place in the city where registered office is situated. In case of unlisted companies, with the consent of all members in advance, company can hold AGM at any place in India. So benefit to unlisted companies. Next one, extraordinary general meetings. Conditions with respect to extraordinary general meetings. See, first of all, this AGM is called because of 3 reasons. One is board of directors on suo motu basis, they can call for AGM to discuss some emergency matters. Board of directors on suo motu, that means on their own motion, can call for extraordinary general meetings. Sometimes board of directors call for extraordinary general meeting because of requisition, because of demand of certain members. Requisition means demand for AGM. And next, AGM by requisitionist. If board fails to call for AGM, if board fails to conduct AGM based on requisition, then requisitionists themselves call for extraordinary general meetings. And last one, AGM held by NCLT, National Company Law Tribunal. So now conditions with respect to AGM. See, AGM is a meeting where we discuss some emergency matters, urgent matters. Because of that reason, when an AGM is called by board of directors, it can be conducted at any place in India. Any place in India, need not be at registered office or need not be at any place in the city, town, village where registered office is situated. And AGM can be conducted on any day, including national holiday, any time, including non-business hours, need not be a business hours. Understood? Now coming to AGM by requisitionist, that meeting shall be conducted at registered office or at any place in the city, town or village where registered office is situated. And the day of meeting, any day except national holiday, and the time of meeting, any time only during business hours. The commencement time shall be between 9 a.m. and 6 p.m. AGM of a wholly owned subsidiary to a company incorporated outside India can be conducted at any place, including outside India. Understand this statement, ma? So there is a company C Limited in India. Imagine C Limited, a company in India. 100% of capital is held by a company which is incorporated outside India. So it is having a member located outside India. So no member is from India. C Limited is having a member, but that member is located outside India. See, C Limited is a wholly owned subsidiary. That means 100% of capital is held by a single company and it was incorporated outside India. Now, C Limited extraordinary general meeting can be conducted in India or at any place, including outside India. Clear? Next, requisition. As I told you, requisition is a demand by certain members. So demanding for general meeting. So members in case of company with the share capital holding not less than 1/10 of paid up share capital entitled to vote, or a company if it is without share capital, member belonging to a company without share capital, then single member or group of members holding or having at least 1/10 of total voting power entitled to vote can file a requisition with the company. So demanding a company to call for general meeting. So once company receives this requisition, within 21 days, it should call for a meeting, and within 45 days of receipt of requisition, it should conduct a meeting. Failure on the part of company, if company fails to call for a meeting or if company fails to conduct meeting, then requisitionists will get a power to conduct meeting themselves. And requisitionist should conduct meeting within 3 months of requisition. Is it clear? So whatever expenses incurred by requisitionist in conducting meeting, they will get reimbursement from company, and company will deduct that amount from directors from their remunerations. Is it clear, everyone? Next, so general meeting held by NCLT. See, NCLT, National Company Law Tribunal. So whenever a company fails to call for AGM, then a single member, a member with a single share, can file an application with NCLT. Sir, so and so company is not calling for AGM. Now NCLT will order a meeting to be called and conducted in such manner as NCLT thinks fit. So yes, here meetings can be conducted at any place in India, can be conducted at any time, need not be business hours, can be conducted on any day. Whatever NCLT thinks fit, it will be done. Next, coming to AGM, NCLT will order for a meeting when an application is filed by a member of the company or director of the company. Sometimes NCLT will call for AGM on suo motu basis. On its own motion, it can call for a general meeting. So now powers of NCLT, it can order for a meeting to be called, held and conducted in such manner as NCLT thinks fit. So the point is, when company fails to call for AGM, or if a single member or for any member wants for AGM, or director wants to call for AGM, or sometimes NCLT on suo motu basis can call for AGM. So these are the difference between AGM and EGM. Difference between AGM and EGM. What is the difference? In case of AGM, who can file application with NCLT? Member. In case of EGM, who can file application with NCLT? Not only member but also director. But here NCLT will also get a suo motu power. On its own motion, they can call for a meeting. Sorry, it can call for a meeting. Yes, okay. Non-compliance of section 96, 97, 98 leads to punishment. Here, company and defaulting officer will get a punishment. So up to 1 lakh rupees. In case of continuing failure, 5,000 per day during such default period. So this is the maximum punishment for non-compliance of section 96, 97, 98. Is it clear, everyone? Next, notice, section 101. Notice calling for meeting. The board of directors decided to call for a meeting. So when the meeting is conducted, at what time meeting will start, where the meeting is getting conducted, next, what are the matters to be discussed at that meeting. So all these 4 things, it is the duty of directors to fix all these 4 details and issue a notice calling for a meeting. So if you look at the contents of the notice, you will find the date of the meeting, day of the meeting, time, place, agenda. Agenda means matters to be transacted at the meeting. And this notice, who can fix the notice? Board of directors. Board of directors, both AGM and EGM. Members in case of EGM, I told you, right? Requisitionist. Next one, NCLT. Just now I discussed with you. NCLT, in case company fails to call AGM or company is not calling an EGM based on a requisition, and it is impracticable for requisitionist to conduct a meeting. It is impracticable for a director to call for an EGM. So those cases, they can file application with NCLT. So NCLT can call for an AGM or EGM. AGM based on application by member, EGM based on application by member or director or on suo motu basis. So these three people are having authority to issue notice calling for meeting. And to whom that notice shall be issued? Notice shall be issued to every member of the company. In case of deceased member, legal representative. In case of insolvent, official assignee. Now the point is every member and legal representative and official assignee. It's not or. In one attempt, I have seen a multiple choice question like this. Notice shall be given to every member or legal representative of a deceased member or official assignee of insolvent member. It's not or, it's and. Next, every auditor of the company, cost auditor, secretarial auditor, company auditor. Next, every director of the company. Length of the notice. Length of the notice means, the time gap between issue of notice and date of meeting. Date of issue of notice, date of meeting. So the minimum time gap between these two events shall be 21 clear days. So how much time we need for conducting meeting once we issue notice? 21 clear days. Clear means you need to exclude date of issue of notice and date of meeting. Excluding these two dates, the gap should be 21 days. In case of section 8 company, it is just 14 clear days. Sir, can I call meeting with short notice, sir? Short notice means less than 21 clear days or less than 14 clear days. So possible, but only with the consent of members. If you are calling AGM with a shorter notice, then you need to get a consent from 95% of members entitled to vote at the meeting. Suppose company is having 1000 members. Out of 1000, 950 members should give consent. 950 members should give a written consent either at the meeting or before the meeting for conducting AGM with shorter notice. Here, holding capital, paid up share capital, holding voting power is immaterial. Each member will get a equal right. So 950 members should give consent for calling AGM with shorter notice. In case of AGM, companies are classified into two types. Company with share capital, company without share capital. Company with share capital, majority of members, out of 1000, majority means more than half, that is 501 members. And holding not less than 95% of paid up share capital. So what is the capital of the company? Suppose capital of the company is 10 crores. So 10 crores into 95%, that means 9.5 crores. So 501 members holding 9.5 crores paid up share capital should give written consent or should give consent for conducting AGM with shorter notice. Understood? See, such consent should be such consent should be obtained either at the meeting or before the meeting. Are you all getting my point, students? So majority of members, and this majority of members who are in favor to the shorter notice must possess 95% of paid up share capital. In case of company without share capital, here we are not going to talk about members. Here we are going to talk about only voting power. So not less than 95% voting power holders should give consent for shorter notice, or else that notice is invalid and the proceedings at the meeting shall be invalid. In case of omission of notice, you need to check whether it is accidental omission or intentional omission. Sir, that omission is accidental, sir. So none of the directors planned to omit notice to a particular person, sir. So accidental omission. Then there will be no impact on the proceedings of general meeting. Sir, it is an intentional omission, sir. So directors, they planned it accordingly. They omitted to send notice to a particular member, sir. Then that meeting is invalid. That means all the decisions, all the resolutions passed at that meeting stands invalid. Clear? So with this, notice completed. Next one, explanatory statement, section 102. So here, the proposals, types of business, you can see the proposals are classified into two proposals. Business means here proposal. So ordinary business, special business. 4 items comes under ordinary business. Adoption of financial statements, board report, audit report, including consolidated financial statements. Declaration of dividends. Appointment of directors in the place of those retiring one. appointment of auditors, and fixation of remuneration. So these 4 items are ordinary items. And in every annual general meeting, a discussion should be conducted on all these 4 matters. So without discussing any of these 4 matters, you cannot conclude annual general meeting. Next one, special business. Special business is a business which is not ordinary business, and special business requires explanatory statement. In buyback also I discussed with you the same point. Sweat equity shares, I told about your explanatory statement. Private placement, I told you about explanatory statement. So explanatory statement is compulsory for all special business items. In this explanatory statement, you have to give justification about the proposal. In addition to the justification, you need to disclose the interest of promoters, directors, officers, KMP, manager, and their relatives in the proposal. And you also required to disclose the nature of interest, financial interest or non-financial interest. Understood? So any special business item, if a promoter is having interest in that item, in that transaction, promoter has to make a disclosure. Yes, I'm having interest in this transaction. My relative is involved in this transaction, like that. Non-disclosure, any benefit received by these people or accrued by these people, any benefit received or accrued, that benefit shall be transferred to the company immediately. That benefit shall be returned to the company. That means they should compensate the company. And second one, punishment for non-disclosure. The punishment is defaulting person will get a punishment. That fine is 50,000 rupees or 5 times of the benefit, whichever is higher. This is the maximum fine amount. Maximum fine amount for non-disclosure of their interest in the explanatory statement. You all getting my point, students? The company wants to appoint someone as a managing director. I'm the promoter of company. I'm having interest in that proposal. See, that managing director is my relative. Now I need to disclose those details. So everything should be transparent. Everything should happen in a transparent manner. Members are the owners of the company. They are ultimate risk seekers. So today they contributed funds. So they think that yes, company will carry business operations in a more profitable manner. So definitely we will get more dividends. So their thinking is like that. And whenever you are getting approval from them, so it is your duty to communicate complete information with them. So for that, notice explanatory statement you can use. Next concept, quorum. Minimum number of members to constitute a valid meeting. And this quorum is different for a private company and different for public company. So limit is, in case of private company, the general meeting shall have a minimum 2 members personally present. Personally present excludes representatives. One member personally present, another member he present through his representative. Now that person is not counted for the purpose of quorum. Only members who personally attends the meeting will be counted for the purpose of quorum. In case of private company, 2 members personally present shall constitute quorum. In case of public company, we are having 3 slabs. A public company with 1,000 members, the applicable quorum is 5. 1,001 to 5,000, the applicable quorum is 15. 5,001 and above, the applicable quorum is 30. Suppose take a company C Limited, it is having 16,000 members as per register of members. Now the applicable quorum is 30. And who can check whether quorum is present or not? The answer is chairman. And is there any time limit for checking quorum? Yes, 30 minutes. Within 30 minutes from the scheduled time, it is the duty of chairman to check whether quorum is present or not. I forgot to tell you, see this 2, 5, 15, 30, these are the limits mentioned in Companies Act. Of course, company can have their own limits. They can mention their own limits in AOA. But the point is, statutory limit or the limit mentioned in AOA, whichever is higher is applicable. Suppose in C Limited AOA, the applicable quorum, they wrote that 300 members shall personally present. As per AOA of C Limited, 3 members personally present shall constitute quorum. Now the applicable quorum to C Limited is not 30, it is 300. Why? 30 or 300, whichever is higher, 300. And what is the time limit for checking quorum? Within 30 minutes from the scheduled time. If there is no quorum within 30 minutes of scheduled time, then if it is a EGM called because of requisitionist, EGM by requisitionist or EGM called because of requisitionist, the meeting stands cancelled. Lack of quorum, the meeting stands cancelled. Other general meetings, AGM or EGM by board of directors, the general meeting stands adjourned. If nothing is specified, the general meeting is adjourned to same day, same time, same place, next week. If something is specified, then to the specified date, specified place, and specified day. Understood? Adjourned means what? A temporary suspension. Temporary, it is stopped temporarily and it will be resumed after some time. Understood? So simply adjournment is nothing but whatever meeting is going on, it gets suspended due to some reasons and it will be resumed after a certain period of time. Cancel means no need of no fresh meetings. Here no fresh meetings or no need to conduct a meeting next week, next time, next week, same day, same time, same place. Next one, sir, is notice for adjourn meeting required? Yes. 3 days, at least 3 days before adjourn meeting, it is a duty of company to circulate notice. Sir, circulation of notice is not possible, then advertise in 2 newspapers about the date of adjournment meeting. So details of adjournment meeting. Next one, chairman. So who can be the chairman of the meeting, sir? For that, refer to the articles of association. If articles of association provides that chairman of the board shall be the chairman of the general meeting, then follow it. If AOA is silent, then members personally present shall elect one among themselves to be the chairman of the meeting. So if AOA is silent, who can act as a chairman of the meeting? Only a member, and who is personally present to that meeting will act as a chairman of the meeting. Suppose 28 members present at that meeting in personal capacity. So out of 28, one will take the position of chairman of the meeting, and such election can be conducted either under show of hands or through poll. So these are the 2 types of voting: show of hands, poll. Next one, proxy. See, generally companies conduct general meeting during working days only. So I'm a member of a company. At the same time, I'm engaged in a practice. So I'm having a regular meetings with my clients. One day suddenly company called for a general meeting. At the same time, the date of general meeting, I'm having an appointment with another client. Now it is not possible for me to attend the general meeting. But I was very much interested in the general meeting. So what is going in the general meeting? I want to know. So for that, what I can do as a member of a company, I can appoint a representative. I can send my representative to attend the meeting. And that representative is a proxy. That representative is none other than proxy. So here proxy, the word proxy is having 2 meanings. One is instrument and the other one is a person. So proxy, the word proxy is given to an instrument, and the person whose name is mentioned in that instrument, he is also known as proxy. So proxy benefit is applicable to all companies except 2 companies. That is, a company without share capital. If AOA is silent, proxy benefit is not there. If AOA provides for the benefit of proxy, then company without share capital can also have a benefit of proxy. Next one, section 8 company. There is a restriction on proxy. Generally, representative of a member may be a member, may not be a member. Coming to section 8 company, the proxy should be a member. That means a member can appoint another member as his proxy. So outsider is not allowed. Non-member is not allowed in case of section 8 company. Instrument, applicable form is MGT 11. It should be signed by the member. If he is an individual, he can sign it. If a member is a body corporate, then it should be signed by the officer duly authorized by the company. If company is having common seal, then fix the common seal. Limit. A proxy can represent maximum 50 members in a general meeting. Maximum how many members? Maximum 50. Or members whose holding is 10% of total share capital. Maximum number of members 50. In terms of number 50. In terms of capital, representing, paid up share capital, he can represent n number of members up to 10% of total share capital. Suppose each member is holding 1% of the capital. So company is having 100 members. Company is having 100 members. Each member is holding a 1% like that. Now a single proxy, a single person a single proxy can represent maximum 10 members only. Why? Each member is holding 1%, right? We are having a restriction of 10% of total share capital. So here proxy can represent 10 members only. Suppose each and every member is holding 0.1% of share capital of the company. In that case, 10 divided by 0.1, here you will get 100 members. But there is a restriction on number of members. The number of members restriction is 50. So maximum either 50 members, or in terms of capital, a proxy can represent maximum 10% of total share capital members. Getting my point, students? Next one, a doubt. The doubt is, sir, if a single member is holding 15% paid up share capital of the company, imagine if a single member is holding 15% of total share capital of the company. Now, can't he appoint a single person as a proxy? The answer is yes, he can appoint a proxy. He can appoint proxy. But the point is, the appointed proxy can represent only this member. He cannot represent any other member. And the benefit of proxy, yes, you know the benefit of proxy because you are studying corporate laws. I know the benefit of proxy because I'm teaching corporate laws. What about a normal layman? How he knows about the benefit of proxy? So for knowing him, for communicating the knowledge, for communicating the benefit of proxy, the disclosure about proxy in the notice is compulsory. So you have to disclose. Company is required to disclose about the benefit of proxy in the notice calling for meeting. Non-compliance leads to punishment, fine 5,000 rupees. The defaulting officer who is responsible to include the point about proxy, he will get a punishment 5,000 rupees. Time period for submission. Every member appointing proxy shall deposit proxy instrument with the company at least 48 hours before commencement of the meeting. At least 48 hours before commencement of meeting. That is the duty of a member to deposit proxy instrument, whoever appoints proxy. Next one, invitations to appoint proxy is punishable offense. Invitations to appoint proxy is punishable offense. See, appointment of proxy is an independent benefit of the member. The member can choose any person to act as his representative. Now here company is making a list. So list contains details of some persons. So now company is asking members, if you are unable to attend meeting, if you want to appoint proxy, you can select any person whose name is mentioned in the list. That means you cannot select a person outsider. So you can select a person whose name is mentioned in the list. So take this list like that. If a company circulates any invitations to appoint the proxy, then the defaulting officer will get a punishment of up to 1 lakh rupees. Understood? But member, if you request company, sir, I don't know anyone, sir, I don't know about my neighbors, I don't know, I'm not having any agents, please give me that invitation. So please give me the list of persons willing to act as a proxy. I will select any person to act as my proxy. Now company giving that list to a requested person, it is not punishable offense. Next one, inspection of proxy instruments possible. For that, a member is required to deposit a notice at least 3 days before meeting. I want to inspect proxy instruments, so please permit me for inspecting proxy forms. Like that, he should give notice to the company at least 3 days before the meeting. And coming to the inspection time period, inspection commencement time is 24 hours before commencement of meeting, and inspection can be allowed up to the conclusion of meeting. Once meeting is concluded, so next minute onwards, you are not allowed to inspect proxy instruments, and that too during business hours only. Inspection can be carried out during business hours only. A representative of a governor, representative of a president, representative of a body corporate is deemed to be member of the company. The governor, president, body corporates, representatives are deemed to be members of the company, and they are counted for the purpose of quorum. As I already told you, proxy is not counted for the purpose of quorum. The reason is not a personal, he's not a member personally present at the meeting. He's a representative person. Understood? He's a representative person. Only members who are attending that meeting in personal capacity are considered for the purpose of quorum. Other persons are not considered for the purpose of quorum. Even employees of the company, Directors who are not members of the company, even if they attend the meeting, they are not counted for the purpose of quorum. For the purpose of quorum, only the member who is personally attending that meeting, is counted, is considered. Next one, voting. Restriction on voting rights of the members. See, a company can place a restriction on voting rights of a member only in one situation. That is, a member failed to pay calls in arrears, or member failed to return sums due to the company. And for that, AOA authorization is also compulsory. Suppose if AOA is silent, then company cannot restrict voting rights of the members. AOA authorizes company to restrict voting rights of a members who is holding shares with calls in arrears or who is due to the company. In that case only, company can restrict those people from exercising voting rights. Coming to the types of voting, we are having 4 types of voting: show of hands, e-voting, poll, postal ballot. Show of hands. Show of hands is applicable only when e-voting is not applicable or when there is no demand for poll. You know the beauty of show of hands: one member, one vote. One member is given only one vote. Here the holding is immaterial. Suppose you are holding 1000 shares, I am holding 1 share. 1000 shares, 1 share, but still under show of hands, you will get 1 vote, I will get 1 vote. Only one time you can raise hand, either for favor, either in favor or against to the proposal. Understood? So the beauty of show of hands, it is very fast and low cost. Yes, definitely low cost. Fast, why? So the moment proposal is introduced, the chairman will ask you, so show me your hands who are in favor of resolution. So he will count the number and he will record that number in the minutes, and he will ask again, so how many of you are against to the proposal? Again you will raise hands, not previous persons. Either you should cast vote in favor or against only once. So how many of you are against? He will count and he will record that matter in minutes. Now declaration by the chairman in the minutes regarding a resolution is a conclusive evidence whether resolution is passed or not. Next one, e-voting, electronic voting. I don't know how many of you are watching IPL or how many of you are watching that Big Boss. So in IPL, in Big Boss, some contest, some game shows they will conduct. So they will ask you a questions and they will ask you to comment or to reply to that question. In case of Big Boss, yes, you can log in. I mean, you can log into your account and then you can proceed with voting in favor of your contestant who was nominated. Yes or no? So in case of Big Boss, if you observe carefully, so you are electing your contestant, nominated contestant, not going to the Big Boss house, but sitting in your house, you are casting a vote. Sitting in your house, you are casting a vote. Yes or no? That is what remote e-voting. Voting takes place electronically. So here you will be given login credentials. So using that login credentials, you can enter into the website of voting. In that you can select the proposals and you can select the votes in favor, votes against. Finally, after submission, the voting is set to be completed. And this e-voting is mandatory to 2 companies. One is a listed company and next one unlisted company with a members not less than 1000. Next one, poll. See the difference between show of hands and poll. Show of hands, one member is given 1 vote. It is immaterial whether you are holding 100 shares or 1000 shares or 1 million shares or 1 lakh shares. It is immaterial. Immaterial. Coming to the poll, each member will get a voting is proportionate to his holding in the entire share capital. Suppose I am holding 1000 shares. I'll be given 1000 votes. You are holding 1 million shares. You'll be given 1 million votes. So what is the total share capital of the company? In the total share capital, how much portion you are holding? Sir, I'm holding 10% of paid up share capital, sir. Then your voting power is 10%. Proportionate voting power. So this poll, who can conduct poll? Chairman. Chairman is having a power to call for poll, either on suo motu basis or based on the demand by the members. Sir, who can demand for poll, sir? In case of company with share capital, member or proxy holding at least 5 lakh rupees paid up share capital or having 1/10 of the voting power, any condition if satisfied, they can demand for poll. And in case of company without share capital, members or proxy if allowed, together having a voting power of at least 1/10 of total voting power, yes, they can demand for poll. Once demand for poll is done, so it is the duty of chairman to conduct voting under poll only. And what is the time limit for conducting polls, sir? Matters related to adjournment of meeting or appointment of the chairman, the poll shall be conducted immediately. So don't discuss next matter or don't discuss a new proposal. First, you conduct voting with respect to these meetings, adjournment of meeting or appointment of chairman of the meeting. In case of other matters like appointment of auditor, appointment of director, declaration of dividend, you can conduct voting through poll within 48 hours from the time they made a demand for poll. So matters related to adjournment of the meeting, chairman of the meeting, appointment of chairman of the meeting, the poll shall be conducted immediately. Other cases should be conducted within 48 hours from the demand from the time they demanded for poll. Next one. So poll once demanded by these members, they can withdraw poll at any point of time. Next one, postal ballot. Postal ballot. Let's look into the material. Postal ballot is compulsory for 10 items. 10 items. What are those 10 items? I'll discuss with you. If you look into the material, each and every point I revised. Each and every point I revised. See, I prepared that summary notes based on the study material only. Based on the stress test study material only. So each and every point I considered and I prepared that summary notes. Now coming to the procedure for conducting voting under poll, procedure for conducting e-voting, everything just give one time reading. Just give one time reading. Why? Because this is a simple procedure. Even you read it, you can easily understand. You can easily revise it. So procedures, just give one time reading. But I'll give you overview regarding procedure. Just wait. So postal ballot, here voting is conducted by post or through any electronic mode. In case of postal ballot, here voting is conducted by post or through electronic mode. So I'll tell you the difference between poll and postal ballot. In case of poll, the members attended to the meeting, they will be given a ballot paper. They will be given a ballot paper. For example, it's like I'm telling you. So they will be given a ballot paper. In this ballot paper, they will find the list of items for which members approval is required. So member, he will enter all his details, everything they will enter, and they will record the things. They will cast the votes. So they will cast votes in this manner. So votes in favor, votes against, proposal 1, proposal 2. So yes, like this, they will select. So poll is conducted at meeting. And if the same ballot paper is sent to your registered address and company is asking you to cast voting through that ballot paper which was sent by post, and company will ask you to resubmit that ballot paper within 30 days of mentioned date, specified date. Generally, date of dispatch of postal ballot notice. So within 30 days, member should exercise voting power. Member should record everything on the postal ballot paper and he need to return that ballot paper to the company. So poll is conducted at meeting, postal ballot not at meeting. It happens through post or through any electronic mode, electronic remote e-voting, just like your big boss nominations election. Next one, see, this postal ballot is compulsory for 10 items. One is alteration of object clause of MOA. Next one, alteration of AOA, alteration of articles of association. Next, shifting of registered office, alteration of objects for which a company has raised money from public through prospectus. That means, here change of objects in the prospectus. First one, alteration of objects in memorandum of association. And this one, alteration of objects which was mentioned in prospectus. Issue of shares with the differential rights, variation of rights, buyback of shares, election of a director under section 151, there is small shareholder director, sale of whole or substantially whole of undertaking of a company, giving loans or extending guarantee or providing security in excess of limits specified under section 186. For these 10 proposals, voting shall be conducted by post or through electronic mode. And one more point, this is not applicable in case company is having a number of members. Just wait. So the point is, this postal ballot is not applicable in case the number of members are up to 200. The one-person companies and the companies which are having number of members up to 200, postal ballot is not compulsory. And with respect to these 10 proposals, all other companies shall conduct voting by post or through electronic mode. Is it clear, everyone? So that is the note point. Important point. OBC and other companies having members up to 200 are not required to transact any business through postal ballot. Sir, apart from these 10 matters, can I discuss any other matter through postal ballot? Yes, of course. But that matter should not be ordinary business item. That matter should not cover under ordinary business item, and that matter should not be a matter where auditor or director is having a right to be heard at that meeting. Suppose, removal of auditor, removal of director. So they are having a they are having a right to express their opinion in the meetings. So matters relating to ordinary business, matters relating to the auditor and director who are having a right to be heard in that meeting, who are having a right to express their view in the meeting. So these matters you cannot conduct voting by postal ballot. All other matters you can, but for these 10 matters compulsory voting by postal ballot. For these 10 matters compulsory voting by postal ballot. All other matters you can, except two things I told you. Next one, for all these 10 items, postal ballot is not compulsory if you are a one-person company or if your company is having number of members up to 200. Is it clear? See, procedure. In case of poll, in case of postal ballot, in case of e-voting, the procedure is common, except some points, some 2 or 3 points are different, but the rest of the procedure is common. Like, in these 3 modes of voting, appointment of scrutinizer is compulsory. Scrutinizer is an independent professional person, so who will count the votes? So he will count the votes in favor, he will count the votes against. Based on the report of the scrutinizer, chairman of the meeting will declare whether resolution is passed or not. Understood? So appointment of scrutinizer will take place. So he will verify, he will scrutinize the entire voting process. So he will check the ballot papers and he will verify the ballot papers received from the members, and he will cross verify these ballot papers details with the register of members details, and he will consider whether a vote is valid or invalid. So based on that, he will prepare a report, and that report contains the number of votes in favor of a proposal, number of votes against to the proposal. Based on this report, chairman will declare the result. So this is a normal procedure in all these 3 modes. And the different points is, e-voting, postal ballot, extra disclosures are required. Like, company this time is conducting voting through e-voting, or company is conducting voting by postal ballot. So for that, you have to do these things like that. Extra disclosures you will find in the procedure questions. Just to give one time reading, you will understand. Next one, resolutions. We are having 2 types of resolutions: ordinary resolution, special resolution. Ordinary resolution, when we call a resolution as ordinary resolution, how can we check ordinary resolution? Simple. Votes in favor exceeds votes against. Even 1 vote extra, that's it. Ordinary resolution is said to be passed. But that ordinary resolution is valid only if a notice is given according to the provisions of section 101. Next, special resolution, 3 conditions to be satisfied. One is votes in favor greater than or equal to 3 times of votes against. How many votes are in against? Multiply it with 3 times. If you receive that many number of votes in favor, then you can declare special resolution. And section 101 notice is also compulsory. Notice shall be given according to the provisions of section 101. A disclosure. If company wants a special resolution, that thing shall be disclosed in the notice. Against the proposal. Against the proposal, company should mention a special resolution. Here we need special resolution. Like that, a disclosure is compulsory. Without this disclosure, if company issue notice, and even if company gets special resolution, that special resolution is not valid. You all getting my point? For ordinary resolution, disclosure is not required. For special resolution, disclosure of special resolution is compulsory, or else that special resolution, even if you get special resolution at the meeting, that special resolution is not valid. Here, next, special notice. General rule, company will prepare notice and company will give notice to the members. Coming to special notice, members will give notice to the company. Not all members, a member or members group having either 1% of total voting power or holding at least 5 lakh rupees paid up share capital can give special notice to the company at least 14 days before commencement of the meeting, but not later than 3 months. Sorry, but not earlier than 3 months. At least 14 days before meeting, not earlier than 3 months before meeting. So members can give special notice to the company regarding appointment of another person in the position of auditor, appointment of another person in the place of retiring director, removal of existing director, removal of existing auditor. So for these proposals, members can send a special notice to the company. Next, small point, resolutions passed at adjourned general meeting. What is the effective date for resolutions, for such resolutions? If a resolution is passed at an adjourned general meeting, what is the effective date of that resolution? Effective date is date of adjourned meeting. See, company issued a notice for 10 proposals. Out of 10, 9 proposals were discussed in general meeting. Only one proposal was discussed in adjourned meeting, not original meeting, adjourned general meeting. Now, with respect to these 9 proposals, date of resolution equal to date of meeting. With respect to one proposal which was approved in adjourned meeting, date of resolution equal to date of adjourned general meeting. Effective date is date of adjourned meeting. So, when it was actually passed, it is the effective date. Next is section 117. So, resolutions, agreements to be filed with ROC. It is the duty of company to file all these resolutions and agreement copies with ROC. Special resolution, proposals which was approved by all the members of a company. Next, board resolution regarding appointment of direct managing director, renewal of managing director agreement, reappointment of managing director, variation of terms of appointment of the managing director. Next one, a resolution of class of shareholders, resolution related to winding up of the company, resolutions with respect to section 179 subsection 3. So all these things, whenever takes place, it is the duty of company to file a copy with ROC in form MGT 14, and the applicable time limit is within 30 days of the event. Non-compliance punishment, company 10,000 rupees fixed. In case of continuing failure, 100 per day, maximum 2 lakhs. Defaulting officer 10,000 rupees. In case of continuing failure, 100 per day, maximum 50,000 rupees. Clear? Next, last concept of management and administration chapter, minutes. Last but one. Okay. Now one more concept is the report of AGM. I'll tell you, just wait. Minutes. Minutes is nothing but it's a book containing summary of proceedings that were happened in that meeting. It's just a book, or it's a paper. So in that paper or in that book, you will find the summary of proceedings that took place in that general meeting, and this minutes is applicable to the following meetings: general meeting, class meeting, postal ballot resolutions, board meetings, committee meetings. For all these meetings, you have to maintain a distinct minutes book. That means a separate minutes book for members meetings, separate minutes book for board meetings, committee meetings, like that. So don't merge them, separately. For directors, one book; for members, one book. In members minutes, you can include the matters relating to postal ballot resolution, no problem. The time limit, within 30 days of meeting or within 30 days of postal ballot resolution declaration, you have to complete the minutes. Coming to the signing, so general meeting, postal ballot resolution minutes, these 2 minutes, general meeting and resolution passed through postal ballot, these minutes shall be signed within 30 days of the event. 30 days of the event. Board meetings, it can be signed even in the next board meeting, no problem. For board meeting minutes signing, there is no time limit. Contents of the minutes, it should contain fair and correct summary of proceedings. All the appointments that were taking place in the meeting, you have to name them. So who got appointed in that meeting. With respect to board meetings, you have to enter the details of the directors present at the meeting, name of the director present to the meeting, and the director who casted vote against or who is not concurring to the proposal. You have to name the directors. So directors, a few directors casted votes in favor, some directors casted vote against, and one or two directors, they are not at all giving consent to the proposal. They are not in favor, not against. So the point is, who casted votes in favor, ignore them, ignore the details, and you have to include the details of the directors who are casting votes against to the proposal or who are not concurring to the proposal. Next one, exclusions of content from the minutes. So only the matters relating to the defamatory of a person, a matter which is irrelevant, or a matter which is detrimental in the interest of the company, only these matters can be excluded subject to the option of chairman. If chairman decides to exclude them, then they will be excluded. If chairman decides to include them, they will be included. Only these matters can be excluded, not all other matters. Non-compliance of this section, company 25,000 rupees punishment, defaulting officer 5,000 rupees. If someone tampers the minutes, alters the content of minutes, a guilty person will get a punishment, imprisonment up to 2 years, and fine minimum 25,000, maximum 1 lakh rupee. Let's look into the material ones. Any ignored content, any content which got ignored, I'll discuss with you. The report of AGM, if I'm not wrong, report of AGM I need to discuss with you. All these points I covered. The moment you complete watching marathon, open material once, go through that material. Understood? So report of AGM section 121. So this is applicable to all listed companies, and this report shall be prepared in addition to the minutes of general meeting, and the report shall be signed and dated by chairman of the meeting. In case of his inability, the report of AGM shall be signed by 2 directors of the company. If chairman is not available, or chairman available but he is not in a position to sign it, then 2 directors of the company, one should be managing director. And this report shall contain, if there is a company secretary, then company secretary shall also sign this report. Understood? First option, chairman is not available, then 2 directors, one should be managing director. Suppose if company is having company secretary, then 1 director, 1 company secretary should sign the report of AGM. The details of the details to be mentioned in the report: day of meeting, date of meeting, time of meeting, venue of meeting, confirmation with respect to appointment of chairman, number of members attending the meeting, that means whether quorum is present or not, confirmation of quorum, confirmation with respect to compliance of act and rules, that is secretarial standards made, business transacted at the meeting and results thereof. The point is, the meeting was conducted according to the applicable rules and standards only. For that, you have to confirm, you have to confirm the fact. Next, particulars with respect to any adjournment. If meeting got adjourned or postponed, you need to mention those details. The report shall contain fair and correct summary of the proceedings of the meetings, and the copy of report of AGM shall be filed with the registrar in form MGT 15 within 30 days of conclusion of AGM along with the fees. Simply, beginning of this lecture I told you, day of meeting, time of meeting, place of meeting, agenda of the meeting, I told you, right? So day, any day other than national holiday, time, anytime during business hours, place at register office or city, town, village where register office is situated. Now quorum should be present. So all this, whether all these were complied or not, for that these companies have to prepare a list. In this list we will mention all these details and we'll file a copy with ROC. Understood? So with this, management and administration chapter marathon is completed. The next topic is directors. Important, very, very important. You can expect 2 questions from this particular chapter. Each question carries 7 marks. 7 plus 7, 14 marks. 14 marks. From entire company law weightage is 40 marks. From directors chapter alone, you can expect 14 marks. So don't ignore this chapter. See, who is a director? Director is an individual appointed to the board. Any individual appointed to the board, we call him as director. And what is the role of director? See, if you look into the material, the role of director, total some 10 points are there. And all these 10 points, I summarized into just 3 points. Just 3 points. First, listen to these 3 points and then read the 10 points. You'll get a clarity. The role of director. See, directors are the agents of company. Directors are trustees of the company. Directors are officers of the company. So depending on the situation, depending on the facts of the case, sometimes director is an agent, sometimes director is a trustee, sometimes director is an officer. So with respect to company activities, as I told you just now, company being an artificial person, it cannot carry business activities on its own. It requires some human agency support. And in that human agency support, you can see director. Now, act of director is equal to act of company. Act of an agent, agent is not liable, principal is liable. So act of director, director is not liable, company is responsible, company is liable. So director is an agent with respect to company activities. Next, company is receiving funds from the members. With these funds, company acquired some assets. So company is having properties, assets. Understood. Now, who is going to take care of all these properties and assets? Obviously, directors. That means directors are trustees with respect to company properties and company assets. Next one, decision making, like allotment of securities, investment in other body corporates, transfer registration, registration of transfer of securities, buyback of securities, recommendation of dividends. With respect to these proposals, directors had power to decide. That means for these matters, director is like an officer of the company. Understood? So role of director, he can be an agent, trustee, officer, depending on the situation. Next one, duties and responsibilities of director. So the duties and responsibilities of the director comes from articles of association. So articles of association can prescribe the duties of the director. And it is not possible to include all the duties. It is not possible to include all the duties of the director in AOA. If anything is missing, then director should act in good faith in promoting the objects of the company. Understood? So everything, communication through AOA is not possible. Sometimes we need to think out of the box. We should come out of the box. So if he's not getting, if he's not getting a power, or if he's not getting a right from AOA, then he should act in a good faith. Understood? He should not be negligent. Acting in good faith means not negligent and honest. Are you all getting my point, students? So he should act in a good faith in promoting all the objects of the company, and he should act in a due and reasonable care. See, best example, he's a trustee of company properties, company assets. He's not owner of company properties. He's just a trustee. So properties belonging to the company, properties are not belonging to the director. Now, director should take a reasonable care. That means if property belongs to him, what level of care he will exercise over that property, the same level of care he should exercise on company properties, company assets. If business belongs to him, what kind of decisions he will take, the same decisions he should take being a director in the company. He should not be negligent. Oh, this money belongs to shareholders. If something happens, loss to the shareholders only, no loss to me. Like that, he should not think. And he should not involve in the activities where he is having either direct or indirect interest, which is conflicting with company interest. So, he should ultimately think about the company benefit only. So whatever act he is doing, he should think company should get a benefit from it. For example, company needs some raw materials. I'm the director of the company. I'm also supplier of these raw materials. See, I'm a director in that company, as well as I'm having my own business. I'm supplying the raw materials. So one day company approached me for the want of raw materials. Now I should supply these materials cost only, not, I should not make extra profits. I should not make extra margins. Understood? So if you have any interest, don't play with your interest that is against to the company interest. Getting my point, students? See, whenever company need materials, and if that materials belongs to you, you should supply it cost only. You should not make extra margins. You should not earn extra profits from those transactions. And no undue gain or advantage either directly to himself or to the associates. Suppose, company wants to appoint a subcontractor for completion of work. Okay, the reasonable price for that subcontract means what? Company received one contract, one part of work was allotted to another person, subcontract. So the reasonable quotation for that subcontract is 10 crores. But the director, with the help of his relative, what he did, he quoted for 15 crores. Right? The cost is actually 10 crores, but what director is doing with the influence the power he is having, he allotted that contract to his associate, to his relative for 15 crores. Thereby he is making a profit of 5 crores. This is undue gain, undue advantage. He should not commit like those activities. Next, no assignment of office. The director is an agent of the company. He was appointed by the company, so he should not delegate his power to someone else. Why? See, company is having trust. Company is having trust on me, so only I can exercise the duties. I can exercise powers of the company, being a director. So I cannot delegate my powers to someone else. Assignment of office is strictly prohibited. So these are the duties and responsibilities of director. Next one, every individual who wants to be appointed as a director of company shall possess the DIN. An individual without DIN is ineligible to act as a director. So for getting this DIN, he has to file an application with central government. Central government is having authority to allot DIN, director identification number. Next, qualifications and disqualifications of director. Important question. Qualifications. See, in the entire Companies Act, there is no provision regarding the qualification of a director, either academic qualification or professional qualification. Any person can be appointed as a director. Even an illiterate person can also be appointed as a director. The point is, it's members of the company decide whom shall be appointed as a director. So trust is the most important thing. Trust comes from the experience of a person, qualification of a person. So members will choose a director accordingly. So as per the provisions of Companies Act, there is no provision with respect to academic or professional qualifications to act as a director. So DIN is compulsory. Disqualification. Unsound mind person is disqualified to be appointed as a director. Undischarged insolvent, adjudicated insolvent. See, undischarged insolvent, adjudicated insolvent. Suppose a person, if you look at the person balance sheet, liabilities 20 crores, assets 15 crores. So assets are not in a position to discharge liabilities. Now this fellow filed an application with authority to declare him as an insolvent. And this application is still pending. Application is still pending. That person is called adjudicated insolvent. Suppose application processed, authority declared this fellow as insolvent person and imposed a period of 3 years. So next 3 years you cannot enter into the contracts. So he was declared as an insolvent, but not yet discharged to enter into the contracts. Undischarged insolvent, adjudicated insolvent, both are disqualified. Convicted by offense involving moral turpitude, breach of trust, fraudulent activities, and he was sent to jail for a period of 6 months or more. Then for the next 5 years after release, next 5 years he is disqualified. Suppose he was sentenced to jail for a period 7 years or more, then permanent disqualification. That means he cannot be appointed as a director in his lifetime. Understood? So for a period 6 months or more, but up to 7 years after release from the jail. So 5 years disqualification is there. Whereas the sentencement period is 7 years or more, then disqualification is permanent disqualification. Next, any person disqualified by court or NCLT order and that order is in force is also disqualified. Director who has not paid calls on shares and 6 months time period lapsed after making those calls on shares. That means, default has been made. Default has been, the default period is more than 6 months, disqualified. No DIN, disqualified. Person with no DIN, no director identification number, disqualified to act as a director. Next one, company in which he or she is a director and that company fails to file annual returns, financial statements for a period of 3 years continuously, then the director is disqualified for the next 5 years. And a company which failed to repay deposits, debentures, or failed to pay interest on deposits, interest on debentures, declared a dividend, in that case, and if that failure continues for 1 year, more than 1 year, then the said director is disqualified. The directors of that company will be disqualified. And the disqualification period is 5 years. Next 5 years, they are ineligible to act as director in all other companies. In fact, appointment of such persons during 5 years of disqualification period is null and void. Understood? Last disqualification, this is all about his this disqualification, this depends on the directorship Means, this person is already director in other companies. If any of these company fails to file financial statements or annual returns with ROC for a period of 3 years continuously, then this person is disqualified, not only in that company but also all companies. So last point depends upon his directorship in other companies. Minimum maximum number of directors. Minimum in case of OBC 1, private company 2, public company 3. Maximum number of directors in these 3 companies 15, 15, 15. Appointment of director, first director, subsequent directors. First directors are the directors named in the articles of association. Upon incorporation, the directors who are named, the persons who are named as first directors in the AOA become directors of the company. Subsequent directors are appointed at annual general meetings or extraordinary general meetings. Sometimes some directors can be appointed in board meetings also. So they are additional directors, alternate director, nominee director, or director to fill up a casual vacancy arising due to or death of a director or resignation of the director. So these 4 cases, board members can can appoint. Other than these 4 cases, members had power to appoint directors in the general meeting. Next one, of course, nominee director appointed by the board shall be ratified at general meeting. So members will further members will pass a resolution for appointing that nominee director who was appointed by the board. Next one, retirement of directors, rotation of directors, retirement. See, all directors are liable to retire if AOA prescribes that matter. So if articles of association provides that all directors are liable to retire by rotation, then all directors are liable to retire by rotation. Or else, if AOA is silent, then 2/3 of the directors shall be rotational directors and 1/3 of rotational directors shall retire at every annual general meeting. So the director with longest tenure will retire first. Suppose all the directors were appointed on a single day, sir, single point of time, sir. Then through mutual understanding or lot system, whose name comes in the slip, will retire. And all these retiring directors can be reappointed at an annual general meeting. Suppose company is having 15 directors. 15 into 2 by 3, that means 10 directors. 10 directors are rotational directors. Out of 10, 1 by 3 shall be the retiring directors. Understood? Suppose I'll give you a number like this. 9 directors are there. 9 into 2 by 3. 6 are known as rotational directors. 6 into 1 by 3. 2 directors. 2 directors compulsorily they shall retire at the AGM. And these retiring directors can be reappointed at AGM. 3.33. In that case, how many, sir? 4. You cannot reduce it. You cannot reduce the limit. You cannot reduce the number. 3.33. So the nearest one is 3. No. So minimum 3.33 means that means minimum 4 directors. That is the point. So the material retirement and rotation of the directors, as I told you, AOA provides for retirement of all directors in AGM. Then all directors are liable to retire. 2/3 of the total number of directors are liable to retire by rotation, and those directors are called retiring directors. Out of retiring directors, 1/3 of the directors liable to vacate the office. So 1/3 of the directors will retire. So this concept is retirement by rotation. The directors who are in the office for a longer period is liable to retire first. However, if 2 or more directors have been appointed on the same day, then directors will retire based on mutual understanding between them. And when mutual understanding is not available, then they retire based on draw by lots. So they will write the names of the directors in the slips randomly. Whose name comes first, they will retire by rotation. And these people are eligible for reappointment in the general meeting, as I told you. Next one, resignation. So resignation, you can see here. So director who wants to resign from the office, he can resign from the office only by notice. First, he need to give notice to the company, and company shall file the same notice with ROC. And the director shall file a notice with ROC within 30 days of resignation. Failure to send a notice to the company to the ROC, it leads to no effect of resignation. That means whatever acts done by the company, even after resignation, the director is still responsible. The director is still liable for the acts. That's it. Understood? So Resignation is effective only when you communicate with the company and when you communicate with ROC. Failure to do so, you'll be continued as an agent of the company only. So act of the agent, the principal is liable accordingly. So your acts, company will be binding to the third party. Next one, effective date. Date on which, effective date of resignation. So what is the effective date of resignation? Date on which notice is received by the company, or date specified in the notice of resignation, whichever is later. The company received notice on 30th June 2024, and the date mentioned in the notice about resignation is 31st May 2024. Whichever is later means 30th June 2024 is the effective date of resignation. And there will be no effect on the acts done during his director tenure. See, suppose, till 30th June 2024, he is the director. On 1st April 2024, he committed one mistake. He committed one offense. But this offense was found after his resignation. That is 1st October 2024. Now, will he get punishment or not? Suppose, a court asked him, go to the jail. Now, he is telling, sir, now I am not the director, sir. On 30th June 2024, I came out from my directorship. So, I am not the director. So, no punishment to me. Is it valid? No. Acts done when he was a director. So for all those acts, he is liable even after resignation. Next one, removal of the director. The procedure for removal of the director. See, first of all, who is having power to remove the director? First one, member. Next, NCLT. The members are having power to appoint the director. Power to appoint includes power to remove. So members are having inherent right to remove director appointed by them. Suppose a director was appointed by NCLT. Now, can a member or can members remove the director who was appointed by NCLT? The answer is no. Director appointed by NCLT, members cannot remove him. Director appointed by the members, appointed by the board of directors, yes, members can remove them. So it is not necessary to remove them not only on the basis of proof of mismanagement, breach of trust, or other misconduct. Even normal cases also. Suppose, he is taking some decisions which shareholders are not liking. He is perfect person, he is correct person only. But the decisions made by the policies framed by the director, members are not having that much interest in those policies. Now, members can remove from the directorship. Member can remove the director. So, in these cases, proof of mismanagement, breach of trust, a proof of misconduct is not required. And for removal, ordinary resolution is sufficient. And because of removal, if there is any vacancy in the director office, yes, members can appoint a new director. The new director can be appointed. Now, the removed director is eligible for damages and compensation because of premature removal. See, he was appointed for 1 year. Example, after 6 months, members called for EGM and members removed him. And he was not, guilty of misconduct. He is not guilty of breach of trust. He is a genuine person only, perfect person only. He didn't commit any mistake, but still members removed him from the office of directorship. In that case, he is eligible for damages and compensation. But in the following two cases, in the following case, he is not eligible for damages, he is not eligible for compensation. So what is that case, sir? See, he carried some policies, it is oppressing the minorities, it is against to the company affairs, oppression and mismanagement of company affairs. So he is utilizing company funds for his personal purposes. Next one, an application was filed with NCLT. So in this case, the removed director is ineligible for claiming damages, claiming compensation for the loss of office before completion period. Completion date. Okay. Next one, directors remuneration. See, directors are doing things on behalf of the company. Definitely, they are entitled to remuneration. Is there any limit on remuneration, sir? Yes. And that limit is applicable only to the public companies. Only to the public companies. So, articles of association, resolution of members at general meeting decides the remuneration, determines the remuneration of the directors. Coming to the public company, the limit on directors remuneration is remuneration to all the directors of the company. Companies having all types of directors, managing director, whole-time director, non-executive directors, independent directors, like that, all directors are present in the company. In that case, the maximum remuneration a company can pay to all these directors shall not exceed 11% of net profit. Maximum 11%. So company is having only a managing director and other directors. Then remuneration to managing director shall not exceed 5% of net profit. The company is having only whole-time director, sir, whole-time director and other directors. Then whole-time director is entitled to remuneration of maximum 5%. Suppose company is having one managing director, whole-time director, MD plus whole-time director, or whole-time director plus manager. That means, company is having both managing director and whole-time director. Then maximum remuneration to these two directors shall not exceed 10% of net profit of the company. Managing director, whole-time director, non-executive directors, everyone present, then maximum 11% of net profits. Understood, everyone? In case of inadequate profits or no profits, central government prior approval is required for payment of minimum remuneration. Next one, remuneration. While calculating the remuneration, whatever payments you made to the director, everything comes under remuneration only. But remuneration specifically excludes one point, that is any fees paid to the director for rendering professional services. And in the opinion of nomination and remuneration committee, yes, the director is possessing requisite qualifications. Suppose I'm a director of a company, and you all know I'm a chartered accountant. Now one day company received a notice, income tax notice. Being a chartered accountant, I know how to handle the notice, and I rendered services in answering the notice. Now I received some remuneration. So this remuneration I received along with my monthly remuneration being a director. Now whether this remuneration is included in this remuneration for the purpose of checking 5%, 10%, 11% of net profits, the answer is no. So professional fees, if you receive, it is not considered within this 5%, 10%, 11%, provided you rendered that services in professional capacity, and in the opinion of nomination and remuneration committee, the director should possess requisite qualifications. Clear? Next one, powers of directors. See, directors can exercise powers which was prescribed in Companies Act. Next, prescribed in MOA, AOA, and the regulations made by company in general meeting. So members will authorize directors to do certain activities. So now directors can do those activities. Suppose appointment of auditor, member can do it. Members can appoint auditor. Fixation of remuneration, members can authorize directors to fix the remuneration of the auditor. Now it is the power of a director to fix the remuneration of the auditor. So how he is getting that power? From members by resolution. Understood? So these three things decides the powers of the directors: Companies Act, MOA, and regulations made by company in general meetings. Next one, subject to board approvals, directors can do the following things. One is making calls on shares, buyback of securities, up to 10% of paid up equity share capital plus free reserves plus securities premium. I told you. Next one, issue of securities, borrowing monies, investments in other companies, grant loans, guarantees, and provide securities for obtaining loans. Approve financial statements, approving board report, diversify the business, approve amalgamation, merger, reconstruction, take over another company, and such other prescribed matters. But the point is, these areas, in these cases, a director, board of directors can delegate power to a particular committee, allotment committee for allotment of securities, or managing director, or a manager, or principal officer of the company. Suppose company is having branches, each and every branch is having principal officer. Then board of directors, by passing a resolution, can delegate power to the principal officer of the branch to take care of these activities. So delegation is possible. So this is all about powers and powers of the directors. So with this, directors marathon also completed. Just give one time reading. It's just 9 pages chapter just 9 pages chapter. Don't ignore this chapter. Here 14 marks, 2 questions you can expect. Next one, operational and financial controls. The last chapter of corporate laws, 9th chapter. So here we will revise the provisions related to accounts and audit. Clear? So this chapter is also important. You can expect 7 marks from this chapter, 14 marks from director chapter, and 7 marks, minimum 7 marks from 9th chapter. So in 9th chapter we are having total 4 subtopics. Ninth chapter, we are having 4 subtopics: operational and financial control, KMP, just these 2 topics, single page topics. And next, remaining 2, regarding audit and then rights of shareholders. So let's revise them quickly. Operational and financial control. So here you will find 2 persons. One is operational controller and the second one is financial controller. Financial controller, operational controller. Financial controller is responsible for the financial function of an overall organization. Operational controller is responsible for a particular part of a company. So those duties vary from business to business depending on its operations. So here let me give you one small example. So when I was doing articleship, I went to one company for conducting internal audit. So now I'll tell about that company. So in this company, procurement department is there. Procurement department. Next, human resources department is there. Finance department is there. Sales and marketing department is there. And next one, department for statutory compliances. Statutory compliances. So like this, that company is having a total 5 departments. So out of these 5 departments, I'll take 2 departments for my example purpose. One is, procurement and the other one is HR. So these 2 comes under operational. Not only these 2, sales, marketing, statutory compliance, these 4 comes under operational controls. Operational. And finance comes under finance control. Finance control. So now listen to me carefully. So procurement department manager, he is responsible only for procurement of raw materials. Whenever he receives a letter from store manager, sir, we need these materials by so and so time. So procurement department manager, he will call for quotations from interested suppliers. He will choose the best quotation, with a minimum price, best quality and less time for delivery of the goods. So he will select the quotation, he will enter into an agreement with the supplier. So based on that agreement, he will receive materials. Okay, materials will be sent to stores. So from stores, the material will be issued to site. Like that, it will go on. So this is one particular operation in the company. Coming to the HR. So whenever some human force is required, whenever some labor is required, employees required, human resource manager will make an advertisement. So inviting for interviews, and he will choose this appropriate person for that job. So this is one department, one operation in the company. So procurement, human resources, if you observe carefully, they are responsible for their respective operations. But if you take finance department, so whatever purchases made by the procurement department, yes, finance department will make payment. And the employees recruited by human resource manager at the end of the period, at the end of the month, finance department will make payments to the employees. Next one, sales completed. Now finance department will make all the steps for collecting money from the debtors. Marketing department, yes, this month, they incurred advertisement expenses of 1 lakh rupees. Finance department will make payment for advertisements. Statutory compliances, this department, it is every month it is preparing documents stating that this much TDS we need to pay, this much GST we need to pay, and these are the returns we are required to file. Like that, they are taking care of their operations. Now it's finance department to release funds for payment of TDS, payment of GST and all other taxes. If you observe carefully, operational controller is responsible for controlling his particular part of the company only. His responsible part only. Whereas finance controller is responsible for the organization as a whole. That's what, if you read first 2 points, you'll get a clarity. Financial function of an overall organization, whereas operational controller, particular part of a company. So those duties vary from business to business depending on its operations. Both these people, operational controller, financial controller, they prepare budgeting. They prepare budgets, forecast. They will forecast and they will report everything. These 3 things are common for operational controller as well as financial controller. But operational controller will prepare budgets, forecast, financial reporting with respect to the operations to which he is in charge. Whereas financial controller, he will prepare budgets, he will forecast, he will prepare reports for organization as a whole. This is the difference. Recent MTP paper, I guess this question was asked for 7 marks. Yeah, this question was asked for 7 marks, 6 points. If you write clearly all these 6 points, you'll get a minimum 6 marks. Next one, 9.2, internal financial control for financial reporting. In this first one, authentication of financial statements, signing of financial statements. On the financial statements, if you open any listed company financial statements, you will find the signature of the authorized officers. So who can sign financial statements of a company? First one, chairman of the company if authorized. Chairman if authorized. Suppose company is not having chairman, or company didn't authorize the chairperson. Board of directors didn't authorize chairperson. In that case, 2 directors out of 2, 1 shall be managing director, should sign the financial statements. Second one, CEO of the company, CFO of the company, CS of the company if appointed. These 3 people are appointed, then these 3 people has to sign the financial statements. Not appointed, no need. Understood? So on the financial statements, the following person's signatures are compulsory. Chairman if authorized by board, or 2 directors, 1 should be managing director. CEO, CFO, CS if appointed. In case of OPC, you can see only 1 director. Minimum number of directors is 1 director. So 1 director signing financial statements of OPC, it is said to be valid. It is said to be valid. It is a valid authentication of financial statements only. Now, along with financial statements, you need to attach audit report. That means those financial statements are nothing but audited financial statements. And you need to attach notes annexed to, that means notes to accounts, audit report as well as board report. Financial statements shall not be circulated individually. Financial statements shall be attached to, notes to accounts, audit report and board report. Next one, board report. See, this is the report by the directors to the members. See, who is carrying business operations? Members or directors? Directors on behalf of company, they are carrying business operations. Members are just making investments into the company. Whenever company need funds, members will make investment. Now, what are the activities, company performed last 1 year? What is the position of the company? What is the company performance, financial performance of the company? Everything, board of directors will communicate to the members through a report called board report. It is the report by directors to the members. Now, if you look at the contents of the board report, the web address where annual return has been placed, annual returns of the company placed. So every company is required to prepare annual returns and they are required to place it in the website. So website address, number of board meetings in the last year, previous financial year, how many board meetings were conducted. Director's responsibility statement. Being a director, he is responsible for taking care of company properties, company assets, and he should prepare financial statements in accordance with accounting standards only. Like that, some responsibilities are there. So they need to furnish their responsibilities, director's responsibility statement. Next one, details in respect of frauds reported by the auditors other than those which are reportable to the central government. See, frauds. Here, reporting of frauds, 2 types. One is fraud amount. If it is 1 crore or above, auditor is required to report to the central government. If fraud amount is less than 1 crore, no need to communicate with central government, just communicate with the directors. Now, directors have to disclose the details of the frauds. So, the persons involved in the fraud, how much amount we lost, and what are the remedial measures we implemented for recovering that loss, for mitigating that loss, for recovering the amounts. That's it. That's what, details. A statement on declaration given by the independent directors. Yes, we are independent. We are not having any interest in the company. We can make independent decisions. So like that's a statement. Next one, in case of a company covered under section 178 subsection 1, that is, nomination and remuneration committee, stakeholder relationship committee, yes, company policy on directors appointment and remuneration. Obviously, members will appoint directors, but this nomination and remuneration committee will recommend a person to act as a director of a company. The recommendation will be done by the nomination and remuneration committee. So on what basis they are making a recommendation, on what basis they are making a recruitment process. So furnish those policies in the board report. Of course, this clause is not applicable to the government companies. Next one, auditor qualifications. Auditor reservations. Every reservation, adverse mark, qualification, disclaimer made by the auditor, company secretary in practice. So with respect to those things, the directors have to provide their comments or explanations. Understood? Suppose auditor told some accounting standards were not complied. Now director has to explain why they are unable to comply accounting standards. So explanations or comments by the board. Particulars of loans, guarantees, investments under section 186. Next one, particulars of the contracts or arrangements with related parties. So simply disclose related party transactions in the board report. Company state of affairs, company financial position, amounts if any proposed to carry to any reserves. Yes, during the current year, company earned a profit of 10 crores. Out of 10 crores, 4 crores transferred to reserves, 6 crores, yes, company is willing to pay in the form of dividends. So furnish those points in the board report. Material changes and commitments, if any, affecting the financial position of the company, which have occurred between the end of financial year and date of the report. See, 31st March 2024 is the year closure date. Yes or no? Yes. Do you think as on that date company will prepare financial statements? Company will prepare board report? No. Company will take some time to close its books. Imagine, company closed its books and company prepared financial statements on 31st May 2024. These financial statements are dated 31st March only. Financial statements for the year ended 31st March only. But they were prepared on 31st May. Now, during these 2 months, any changes in the company, any material commitments, significant means significant changes, significant commitments affecting the position of the company, you have to disclose those details in the board report. And company policies in conserving the energy for future generations, how they are using technology, and how they are preserving foreign exchange reserves, foreign exchange earnings through exports, outgo through imports. So company policies, they have to disclose them in board report. And a statement indicating development and implementation of risk management policy. Yes, we are carrying business operations. Definitely certain risk is involved in carrying business operations. So how we are going to mitigate that risk? So this is our risk management policy. We are going to avoid competition in this manner, and we can survive in this competitive world like that. The details about policy developed and implemented by company on CSR, corporate social responsibility. So companies to which CSR is applicable, they need to spend at least 2% of their last 3 years average profits on the welfare of the society. So for that, they need to have a CSR committee. They should frame a policy. They should implement those policies. So details about the policy furnish in the board report. Listed companies and every other public company having such paid up share capital as may be prescribed. A statement indicating the performance of the board and formal annual evaluation of the performance of the board, its committees of individual directors has been made. This particular duty is not applicable to all the companies. This is applicable only to the companies like listed companies and prescribed public companies. So what this point is telling, at the end of the every year, at the end of the every financial year, the directors board has to make a self evaluation in what areas we are lacking, in what areas we are perfect. So how we are going to improve our lacking areas, how we are going to overcome those areas. So how we performed throughout the year, like that, they have to make a annual evaluation and furnish that statement in the board report. Next one, with this contents of board report completed. Next one, rights of the auditor. Rights of the auditor. The auditor is a person express opinion on the financial statements, whether financial statements are free from material misstatements caused due to fraud or error, whether financial statements are prepared in accordance with applicable financial reporting framework or not. So these are the duties of the auditor. First, he will express opinion on the financial statements. For expressing opinion on the financial statements, first he should verify books of accounts. So he should be given unlimited, unrestricted access to the books of accounts. Any doubts he is having, yes, he can ask for any information and he can seek any explanation from the company officers, company employees in order to express opinion on the financial statements. and he can inquire into the following matters. He must inquire into the following matters: whether any loans and advances were made by the company on the basis of security. Did company advance any money to anyone on the basis of security? Now, are they the terms of the loan, the terms of the advance, are they prejudicial to the interest of the company? Suppose company borrowed money from bank at 10% rate of interest, and company is giving a loan to director at just a 3% interest. Company got money from bank at 10% rate of interest, and company is giving advance to a particular fellow at 3%. This is definitely prejudicial. Why? Company is paying 10% interest to bank, whereas company is getting 3% interest from a borrower. Prejudicial, negative impact. Whether transactions of the company are represented merely by book entries are prejudicial to the interest. The provisions, if you observe provision for bad debts, depreciation, these are just book entries. These are not actual events. Whether these entries are having a negative impact on the interest of company, report them. Company not being an investment company, not being a banking company, but it is having some shares, debentures or other securities as an asset, and it sold these assets at a price less than purchase price. See, my company is not an investment company, not a banking company. I am having investments in other companies, and these investments I sold at a price less than cost. Now I need to report them. That means if I am an investment company, no need to report these cases. Investment company, they make investment with an objective of earning profits. Sometimes they may get profits, sometimes they may get losses. Okay. Whether loans and advances made by company has been shown as deposits with banks. Whether personal expenses of the directors have been charged to company revenue account. If company makes allotment of securities, whether it is allotted for cash, then whether company received actual cash or not. If it is allotted for a consideration other than cash, then observe the accounting treatment and observe the documents in case of allotment of securities for a consideration other than cash, and report them in case of any events which are having negative impact on the interest of the company, which are not regular, which are incorrect, which are misleading in nature. Report all the things. Next one, access records of subsidiary. Access to records of subsidiary. Now, for the purpose of consolidated financial statements, audit of consolidated financial statements, auditor should be given access not only to company records but also to the records of subsidiary. Is it clear? Next, duties of auditor. As I told you, he is having a primary duty to report to the members. Accounts were examined by him. Financial statements, yes, the auditor shall make a report to the members on accounts examined by him. Financial statements which are required to be laid before the company in general meeting. So he shall state in his report whether the accounts examined by him and financial statements give a true and fair view of statement of company affairs. This is a balance sheet. Profit and loss. Balance sheet for financial position. Profit and loss for financial performance. Cash flow statement. Statement showing changes in cash. In operational activity, investment activity, financial activity, like that. So auditor has to comment on all these three statements, and auditor shall prepare his report after taking into account the provisions of Companies Act, accounting standards and auditing standards. If auditor has given any qualifications or remarks in the audit report, then he shall state the reasons in that report. Why he is making a adverse remark, why he is making a disclaimer opinion, why he is giving a disclaimer opinion. So just giving a qualification, just giving a remarks is not sufficient. He need to specify reasons behind such qualifications. Understood? And auditor shall also report on these matters. Compulsorily he should report on these matters. Whether he obtained all the required information and explanations during audit or not. Whether proper books of accounts as required by law have maintained or not. Whether company have maintained proper books of accounts or not. That means whether proper books of accounts as required by law have been maintained by the company or not. So for that, check whether company is following accrual basis or not, double entry system or not, and verify the genuinity of transactions. Next one, report on the accounts of branch office of the company audited under subsection 8 by a person other than company auditor. See, for branches, company can have a branch auditor. So report on the branch office accounts based on branch auditor report. Company's balance sheet and profit and loss account, they are in agreement with books of accounts. Suppose as per books of accounts, the turnover is 20 crores. And as per profit and loss account also, the turnover is 20 crores. Now they are in agreement. Purchases. as per books of accounts is 16 crores, whereas in profit and loss account they are showing 15 crores. In order to increase the profit of 1 crore, so they are reducing the purchases in profit and loss account. Now they are not in agreement with books of accounts. Whether in his opinion financial statements comply with accounting standards or not. So financial statements shall be prepared in accordance with accounting standards, followed or not. Observations or comments of the auditors on financial transactions or matters which have adverse effect on functioning of the company. Suppose company is selling its major assets, so definitely it will affect the company's going concern. Now report those points. Director disqualified or not disqualified. If disqualified but still continuing as a director, report them. No, not disqualified, sir. Okay, mention that point. The directors, all the directors are qualified, none of the directors are disqualified. Qualifications resume adverse remarks relating to maintenance of accounts, report them. Company has adequate internal financial control system. The internal financial controls with reference to financial statements in place, whether they are operating effectively or not. So it is the responsibility of company to have internal controls. As an auditor, it's your duty to check the effectiveness of internal financial controls. Sir, how can we check effectiveness of internal financial controls? Very simple. Whether these controls are preventing the happening of frauds or not. Even if fraud has happened, whether these controls are detecting these frauds at earliest. If answer is yes to these two questions, then they are operating effectively. And such other matters as may be prescribed. See, these matters, about 10 matters. Whether the answer is negative or not, you have to report the same. And if answer is negative, you have to state the reasons. Audit of government companies, normal companies, non-government companies, auditor is appointed by members at general meeting. Whereas government companies, auditor is appointed by C&AG, Comptroller and Auditor General of India. Of course, in case of government company, the major shareholder is government. Yes or no? So in government, one of the department is C&AG. So that means government is only appointing auditor of the government company. Government is a major. See, first of all, what is a government company? The company which at least 51% of capital was held by CG or SG or SGs, one or more SG or SGs, and partly by central government and partly by one or more state governments. Yes or no? Partly by central government and partly by one or more state governments. That means major shareholder is government. So here government will appoint auditor on behalf of government. C&AG shall appoint auditor of government company. So C&AG shall appoint auditor of government company. That is the point. Now powers of C&AG. C&AG can call for a supplementary audit. So if he is not sure with respect to a particular area, with respect to, for example, sales, whether company complied accounting standard or not, so he can order for a supplementary audit, or he can conduct a supplementary audit. Second time, it's like additional audit. The supplementary audit is restricted to some areas, specific areas. And based on that, he will prepare a supplementary audit report, and this report is also addressed to all the members of the company. In case of deceased member, legal representative. In case of insolvent member, official assignee, every trustee of debenture holder, etc. And supplementary audit report shall also be placed before AGM of the company at the same time, in the same manner as the audit report. Next one, test audit. So here, if C&AG is not sure with respect to the controls in the company, internal financial controls, whether they are working effectively or not, so he can call for a test audit. So he may ensure the genuinity, validity of the transactions or not. So he is having power to order for supplementary audit. He is having power to call for a test audit. Next one, branch audit. See, generally, company auditor is the auditor of the branch. If nothing is mentioned, company auditor is the auditor of the branch. But company is very big in size, and it is having branches in all the states. It is not possible for a single auditor to audit all the entities, all the branches and head office. In that case, company can have an auditor separately for branches. Who will appoint branch auditor? Actually, members. But members can pass that power to the directors to appoint someone else as an auditor of the branches. Now, who can be appointed as a branch auditor? Qualified person. A qualified chartered accountant holding certificate of practice is eligible to act as an auditor of the branch. If that branch office is situated in India, then CA holding certificate of practice is sufficient. If that branch office is situated outside India, then a competent person, like, if you take USA or Canada, CPA is a competent person to conduct audit of branches. Understood? And these appointed persons shall prepare a report on the accounts only with respect to branch examined by him and send it to the main auditor, principal auditor, company auditor, who shall deal with it in his report in such manner as he considers necessary. If branch auditor is appointed, then company auditor is known as, principal auditor. Next one, duty of auditor in complying auditing standards. Yes, when you are preparing financial statements, you must comply accounting standards. When you are conducting general meetings, you must comply secretarial standards. Now, if you are doing an audit of financial statements of a company, you must comply auditing standards. Central government will notify these auditing standards. Central government is having power to notify auditing standards. But right now, the procedure, what is happening, NACAS, National Advisory Committee on Accounting and Auditing Standards, they are making auditing standards. They recommend to the central government. For actually, they recommend to ICA recommends to central government. Central government will notify the auditing standards, and it is the duty of every auditor to comply auditing standards. Understood? Next one. These 2 points I already told you. Fraud amount, equal to or greater than 1 crore, then auditor has to communicate the same with central government. If it is less than 1 crore, auditor has to communicate with board of directors is sufficient. Communication with board of directors is sufficient. Now, board of directors will disclose those details in the board report, including all the comments and explanations. Next one, auditor must act in good faith. This is one more duty. The provisions of these sections, they are not only applicable to company auditor, but they are also applicable to cost auditor. They are also applicable to secretarial auditor, as usual point. Non-compliance, punishment. Listed company, penalty 5 lakhs. Other companies, penalty 1 lakh rupee. This is at the end, everywhere you'll see the point. Non-compliance of conditions, punishment. Other duties of auditor, prepare audit report, signing audit report, and reporting the discrepancies, reporting the remarks in the audit report, making inquiries. Already we discussed this matter, making inquiries. 6 points are there, right? Loans and advances, personal expenses, book entries, allotment for a cash consideration, allotment other than cash consideration, I discussed with you. So he is having duty to make those inquiries. Duty to lend assistance in case of branch audit. Suppose he is a branch auditor. Now he is having a duty to report not only to the company, but also to the main auditor, principal auditor. So whenever principal auditor requires additional information, he should respond to the principal auditor. Comply with auditing standards, just now discussed with you. Reporting of fraud completed. Adhere to the code of ethics and code of professional conduct prescribed by ICI. Next, assistance in an investigation. Suppose investigation was initiated against the company. Now auditor should support investigation team. So whatever investigation team requires, that information auditor should provide. Next one, applicability of audit committee, role of audit committee. So this is important area. Last attempt, in the last attempt this question was asked for 7 marks. So applicability of audit committee. Every listed public company shall have an audit committee, and such other class or classes of public companies, such other class or classes of companies as may be prescribed shall constitute an audit committee. So for the time being, those companies, the companies having turnover 100 crores or more, paid up share capital 10 crores or more, or all these are, any one condition satisfied, then audit committee is applicable. Next, loans, borrowings, debentures, etc. 50 crores or more, then such unlisted public companies shall also constitute audit committee. And that audit committee shall have minimum 3 directors. I told you, right, company will have 15 directors. Out of 15, 3 should come forward to constitute audit committee. Out of 3 directors, majority directors shall be independent directors. Majority of the directors shall be independent directors. So majority of the members of audit committee, including chairperson of that committee, not chairperson of the company, chairperson of that committee shall be the persons with the ability to read and understand the financial statements. Next one, role of audit committee. So yes, they must go through these activities regularly. So recommendation for appointment of an auditor. So they will recommend a particular person to act as an auditor of the company. Fixation of remuneration. They will review and monitor the auditor's independence while auditing the financial statements of the company. Examination of financial statements, examination of audit report, approval or any subsequent modifications of transactions of the company with related parties. So related party transactions are subject to audit committee approval. In related party transactions, huge chance of fraud is possible. Probability of happening fraud in related parties is very high. Why? Because these people influence the transaction. These people can influence the transaction. I'll tell you one small example. See, you started one business, you are selling an article at 1000 rupees. Actually cost to you is 500, but you fixed selling price as 1000 and you are selling it for 1000. One day, suddenly your relative entered into showroom. Now to your relative, at what price you will sell the article? Obviously, you will sell that article at cost, not at selling price. There arises opportunity cost of 500 rupees. No problem. It's your business. You are the owner of the business. You are the ultimate risk seeker. So you can sell it for cost or you can sell it at a price less than cost. But now imagine it is a company and you are the director. I'm the owner. I invested money into the company. With that money, you are carrying business operations. One day, your relative entered into the showroom. Now you started selling at a discount. It's a loss to me. It's a loss to me. You should not be influenced looking at the relative. So that's what, all these transactions with related parties are subject to audit committee approvals. See, this audit committee is not applicable to all companies, first of all. So wherever audit committee is applicable, so in those companies, in those cases, those companies, yes, related party transactions are subject to audit committee approvals. Scrutiny of intercorporate loans and investments, valuation of undertakings, assets of the company wherever it is necessary, evaluation of IFC, internal financial controls, monitoring the end use of funds, how companies using funds, which was raised through public offers or private placement cases. And audit committee may make omnibus approval for all the related party transactions which are repetitive in nature. Suppose we entered into a contract with one related party to the company. So every month there will be one transaction with that person, like the 12 months 12 transactions. These 12 transactions are for same business only, so they are repetitive transactions. Now instead of giving approval to each and every transaction whenever they happen, give approval, omnibus approval for all the repetitive transactions at once. Next one, transaction with related, in case of transaction other than related party transaction, where audit committee doesn't approve the transaction, it shall make its recommendation to the board. Audit committee shall make a recommendation to the board. So these are the transactions where audit committee approval not taken. First of all, audit committee can make a recommendation to the board. In case any transaction involving an amount not exceeding 1 crore, less than 1 crore is less than or equal to, not exceeding means less than or equal to 1 crore, is entered into by a director or officer of the company without obtaining approval of audit committee. So these are the transactions entered into by you without my approval, and it is not ratified by the audit committee within 3 months from the date of the transaction, such transaction shall be voidable at the option of audit committee. So first of all, related party transactions are subject to audit committee. Any transaction involving any amount not exceeding 1 crore, if it is not approved by audit committee, and even if it is not ratified by the audit committee within 3 months of happening the transaction, then such transaction becomes voidable. That means if they want to continue, they can continue, or if they want to cancel, they will cancel those transactions. And in case if they cancel the transaction and loss arising due to such cancellation, anything, that concerned director shall indemnify the company against loss incurred by it. Of course, this particular concept is not applicable to the transactions between holding company and its wholly owned subsidiary company. Wholly owned subsidiary, see H Limited, W Limited. W Limited, in this 100% of capital is held by H Limited. So any risk, any reward, complete 100% belongs to whom? H Limited only. So transactions between, of course, W Limited is a related party to H Limited. Subsidiary is a related party. Understood. So now transactions between these two doesn't require any such kind of approvals. Next one, other powers. Other powers, may call for comments of the auditors about internal control system. So they can attend for a meeting. Audit committee members, they can call for a meeting. They can ask a auditor to explain about the qualifications, remarks mentioned in the audit report. Next, investigate into any matters in relation to the items specified above. Next one, auditor of the company and KMP shall have a right to be heard in the meetings of audit committee. So in audit committee, you will find 3 directors. Majority will be independent directors. So whenever audit committee meeting was constituted, in that audit committee meeting, KMP as well as auditor is having a right to attend and right to be heard with respect to audit report matters. Understood. Of course, they are not entitled to vote. Auditor, KMP, they are not entitled to vote, but they are having the right to be heard in the meetings wherever they are considering the audit report. Disclosures in the board report as usual. Next one, whistle mechanism. Whistle mechanism. See, this is a mechanism established by the company for directors or employees to report genuine concerns. Genuine concerns. See, company is not managed by a single person. If you take a big company like Reliance Industries Limited, it is managed by thousands of people. Top level management, you can see middle level management, low level management. Now I'm working in middle level management and an officer above my level. So what he is doing, he's manipulating cash. He's manipulating company assets. He's misappropriating company assets. And I came to know this matter. So immediately what I can do, I can report to the a whistle mechanism committee, a committee for whistle mechanism. I can report directly to that. This is almost like, reporting to police. Suppose, you are in a society, in front of you some robbery is happening or one person is trying to kill another person. Immediately you'll call police in order to stop those illegal or, that unjustifiable activities. Yes or no? Similarly, when you are an employee of a company or a director of a company and you witnessed some misappropriation, some frauds in the company, now you can act as a whistleblower. You can communicate what happened. You can support to the investigation team. So that's what whistle mechanism. So in this mechanism, it will provide adequate safeguards against victimization of persons who use such mechanisms. Suppose I told you in my first example, I told you that so I observed my officer is doing such activities. Now immediately I reported to this committee, I reported to the board. So officer is misappropriating the cash. Definitely I'll be under threat. My officer can do anything. So he may try to terminate me. He may try to levy some kind of punishments on me. He will do like that, yes or no? Now I'm a victim. So for protection, for adequate safeguards against victimization, this mechanism will provide necessary steps. Details of establishment of such mechanism. And next one, the companies which are required to constitute an audit committee shall oversee whistle mechanism through the committee, and if any of the members of committee have a conflict of interest in a given case, they should rescue themselves. So they should recuse themselves, and others on the committee would deal with the matters on hand. The ultimate objective of whistle mechanism is to promote whistleblowers. Why whistleblowers? See, these people, they immediately report whenever fraud happens, whenever some misappropriations, manipulations are going to take place or happen. Immediately the people will detect and the people will communicate with them. So that's the reason you have to maintain adequate standards for protection of these whistleblowers. And audit committee, if company is having audit committee will take care of all the activities of whistle mechanism. So in case of other companies, board of directors shall nominate a particular director to play the role of audit committee for the purpose of whistle mechanism. Whistle mechanism shall provide for adequate safeguards against victimization of employees and directors. Just now I told you. In case of repeated frivolous complaints, complaint which is not that much important, not serious, being filed by a director or an employee, the committee or nominated director may take suitable action against concerned director or employee, including reprimand. As I told you, frivolous complaints means, which is not having a serious thing. It is not that much serious. It doesn't require proper attention. But still, this person is making, sir, there is a complaint, sir, come and take action, like that. In case any person is misusing the whistle mechanism concept, in that case, action will be taken by audit committee or nominated director. Next one, rights of shareholders. Last but one concept. So first of all, how one can become a member of a company. This first 3 points is all about, becoming member of a company. How one can become member of a company. In 3 ways you can become a member of a company. One is subscribing to MOA. Subscribing to MOA, you can become member of the company. Next one, every person who agrees in writing to become a member, who agrees, wait, what happened? 1 second, ma. Yeah. Every other person who agrees in writing to become a member. So this will happen in the case of prospectus, private placement, transfer or transmission. If you observe these 3 cases, whenever company makes public offer, yes, interested candidates for the subscribing securities, they will file an application with company, and that application is in writing. Of course, writing includes typewriting. Next one, in case of transfer or transmission, you can see both transferor and transferee will execute a transfer deed. Both transferor and transferee can execute a transfer deed, and based on the transfer deed, transferee can become member of the company. The next one, private placement, also the same situation. Last one, every person holding shares of the company whose name is entered as a beneficial owners in the records of depository. After 1992, when SEBI came into the picture, in the year 1996, a Depositories Act was introduced. According to this act, listed companies will not issue securities directly in the name of public. So what actually happens, between company and public, 2 persons, NSDL, CDSL, National Security Depositories Limited, Central Depository Service Limited. So what these depositories will do, they will receive all the securities of company and they will hold on behalf of public. NSDL, CDSL, they are like banks. Depositories, nothing but banks. So they maintain accounts of the public. Whenever a person purchases share, so those shares will be credited to a person account. Whenever that person sells shares, that person, the number of shares in that person account will be debited. So now the depositories, these depositories will maintain a registers. These registers are nothing but register of beneficial owners. Now whose names were entered in this beneficial owners records as a beneficial owner, now he is also a member of the company. So company, simply it will enter the details of members who are holding shares of the company directly, and it will enter the name of NSDL, CDSL. In the records of NSDL, CDSL, you will find the details of the public who are holding the shares of the company. Understood? So even if your name is entered as a beneficial owner in the records of depository, you are a member of the company. So simply subscribing to the company memorandum of association, you can become member. Subscribing to the new shares, you can become member. Transfer of existing shares by an existing member, you can become member. Acquisition or purchase of share, you can become a member. Acquisition of its shares by devolution. Example, transmission of shares, you can become member. Conversion of convertible debentures, you are holding convertible debentures. On the maturity date, company converted debentures into shares, you will become a member. The differences between subscribers, just observe carefully. Fundamental difference between subscribers who agree to take shares at the time of formation of company and person who agree to take shares later is that farmer become member immediately on incorporation of company. Yes, if you look into the effect of incorporation, once company is incorporated, all the subscribers to memorandum of association becomes members automatically, whereas other members who agreed to take shares become members only after their names are entered in the register of members of the company. So once your details are entered into the register of members, you'll become members. Rights of members under Companies Act 2013. Last attempt this question was asked for 7 marks. So as a shareholder, as a member, he will be given rights. He can exercise rights. Sir, what are those rights? A right to vote, right to requisition in management and administration chapter. I told you, members with 1/10 of paid up share capital entitled to vote, or members in case of company without share capital, members with at least 1/10 of the voting power can make a requisition, call for EGM. I told you, right? Right to receive notice of general meeting, right to appoint proxy, right to appoint a representative to attend the general meeting. This is for a body corporate. For governor, president also, right to appoint representative is there. Right to require the company to circulate resolution. Next one, right to get certificate of share, right to transfer shares, right to inspect register of members, register of debenture holders, and right to obtain a copy of minutes, inspection of minutes. Next one, right to file an appeal with the tribunal for cancelling the variation of shareholders right, and right to participate in removal of directors by passing ordinary resolution. Understood? So these are the rights a member can exercise. Next one, yes, some of the rights were mentioned, in a Supreme Court judgment in Life Insurance Corporation of India versus Escorts Limited. You can see here, participate in the management of the company. So yes, members can elect directors, so they can participate in the management, not directly. I'm appointing one person as a director. See, I'm having 60% share capital. I appointed one person as a director. Now, the director participating in the management of the company, indirectly, I know what is happening in the company. Or no? Enjoy profits of the company in the form of dividends. In case of oppression or suppression, you can file an application, you can file a petition with the tribunal. In case of mismanagement, in case of winding up of a company, you can file a petition with tribunal, and to share surplus on winding up. The event of winding up, once you start selling all the assets and once you settle all outstanding liabilities, whatever surplus is there, being a member, you can enjoy that surplus. This third topic also completed. The last topic of corporate laws, the definition of KMP. Definition of KMP. 6 people comes under KMP. Who are they? CEO of a company, managing director, manager. 3 people, okay. CS, 4th person. Whole-time director, KMP. CFO is also KMP. Such other officer not more than one level below the directors who is in full-time employment designated as KMP by the board. So in a company, you can observe hierarchy: top level management, middle level management, low level management. Top level management, you can see board of directors. So next to the board of directors, for example, finance manager is there. Next to finance manager, assistant finance manager is there. Next to assistant finance manager, yes, accounts manager. Next to employees of accounts department, like that, a hierarchy is there, for example. Now board of directors wants to name this finance manager as a KMP. Can they do it? Yes, they can do it, but the point is, this person should be and immediately next to the directors, immediately next level to the directors, not second level or third level. Next one, he should be a full-time employee. If these two conditions are satisfied, then board of directors can name that person as KMP, and that person is also a KMP under Companies Act 2013. A managerial person, my important person. Without this person, company activities can't, company cannot make activities like that. This person is very much significant. This person will take care of activities of the company. Next, such other officer as may be prescribed. In future, government may prescribe some other officers as key managerial persons. In that case, those persons will also be called KMP. Is that clear? So with this, corporate laws marathon is completed. 40 marks. Finished. Clear? Hello students. In this lecture, I will revise business ethics chapter, which is section D of paper 5 business laws and ethics. The biggest advantage of this chapter is its weightage. From this chapter, you can expect 1 or 2 multiple choice questions. Each carries 2 marks. And 2 descriptive questions, each carries 7 marks. So the combined weightage is 16 to 18 marks. And even if you look at the number of pages of this chapter, this chapter contains around 20 pages. So 20 pages chapter is giving you the weightage of 16 to 18 marks. So don't ignore this chapter. Everyone prepare this chapter. And the biggest disadvantage of this chapter is all the questions look similar. and student writes wrong answer to the question in the examination, and thereby he loses valuable marks. So follow me carefully throughout this marathon. You'll find this chapter very easy. Understood? So first one, meaning of ethics. So let me tell you one example before I start marathon. One day when you are walking on the road, you found one wallet. In that wallet, 10,000 rupee money is there. Some bank debit cards and credit cards are there, and Aadhaar card of a person is also there. Maybe he is the owner of the wallet. Now in front of you, there are two alternatives. Alternative 1, contacting the true owner and returning wallet to the true owner. Alternative 2, enjoy with the money in the wallet. Now which alternative you will choose, which alternative you will select is all about ethics. Understood? So ethics is all about selecting right alternative over wrong alternative. So calling true owner and returning wallet to the true owner, that means you are acting as an ethical person. You are adopting ethical practices. Is it clear? See, ethics is derived from Latin word ethos, which means character. Only human beings will have a character. Non-human beings, non-living things, next the animals will not have this word called character. Understood? Ethics is a set of rules that define right and wrong conduct. Ethical principles help you to choose the right alternative over wrong alternative. Ethics is a social science. It's not mathematical science. 1 plus 1 equal to 2. 2 into 2 equal to 4. It's not like that. It all depends on social practices. It deals with the concepts such as right and wrong, moral and immoral, good and bad behavior of dealing with another persons. Ethics is the fundamental principle of decent human conduct. For decent human conduct, definitely you have to follow ethics. Understood? As I told you, ethics is a social science. It is all about study of a society, study of a persons in the society. In choosing the right alternatives, moral options, good options when you are dealing with another person. Ethics are a set of moral principles that guides a personal behavior. And these morals are shaped by social norms, cultural practices, and religious influences. Suppose one day your neighbors, your elders entered into your home. Now immediately what you will do? So you will greet them. It depends on your culture. In one culture, people used to greet like this, namaskar, how are you, like this. In Western culture, if you observe, the greeting is like giving shake hand. Understood? So ethics and all these morals are shaped by social norms, cultural practices, and religious influences. Understood? Business ethics and corporate ethics are often used to describe the application of ethical values to the business activities. So adoption of ethics, application of ethical principles while carrying business operations is nothing but business ethics or corporate ethics. Professionals are also individuals who exercise specialized knowledge and skills when providing service to the customers or to the public. Example, doctor, chartered accountant, cost and management accountant. So when you are providing services to your customers or to the public, yes, you must possess competent knowledge, specialized knowledge, and you should provide all those services in ethical manner. Is it clear? And coming to the types of ethics, we are having three types of ethics: meta ethics, normative ethics, applied ethics. Meta ethics, normative ethics, applied ethics. Meta ethics deals with the nature of moral judgment. It looks at the origin and meaning of ethical principles. Example, you should not lie, should not tell lies. You should respect elders. You should not steal properties of some other persons. So this comes under meta ethics. What is right, what is wrong. That's it. This is right thing, this is wrong thing. It is all about meta ethics. It simply focus on origin of ethics and what is correct, what is incorrect. That's it. Normative ethics. This is practical ethics. It is concerned with the content of moral judgments and the criteria for what is wrong or what is right. In normative ethics, the main focus is reasoning, reasons behind ethics. What is correct, what is incorrect, meta ethics will tell you. Why it is correct, why it is wrong, normative ethics will tell you. So meta ethics focus is on origin of ethics, whereas normative ethics focus is on reasoning of ethics. Suppose when you are traveling on road, when you are using a vehicle and when you are traveling on road at traffic signals. So if red signal appears, you should stop. You should not jump red signal. It is meta ethics. Why we should stop at red signal? Why? The reason is to prevent accidents. So accidents, because of accidents, there will be a loss of human life, there will be a loss of public properties. The roads might get damaged, one thing. And second thing, person met with an accident, he may lose his life. Loss of one person life, definitely the family gets affected. So reason behind ethics is all about, normative ethics. Reason why it is right, why it is wrong. Next one, applied ethics. Applied ethics looks at controversial topics. The best example for applied ethics is business ethics, professional ethics. It looks at controversial topics. See, every time, every human person will be placed in a situation where he will be given two alternatives. One is correct alternative, the other one is incorrect alternative. Correct means good alternative, moral alternative, just alternative. The other one is immoral, a bad alternative. Now, choosing right over bad is all about ethics. So, in all these controversial topics, so applied ethics plays a crucial role. For example, war, animal rights, capital punishment. Right now, war is not an acceptable practice. But some 500, 600 years back, war is an acceptable practice. To increase the area of kingdom, to increase the kingdoms, what kings used to do earlier times? One king used to declare war on another king. So if the first king wins the war, the second kingdom becomes part of the first kingdom. So if you observe, the kingdom, the size of the kingdom gets increased. So revenue to the king gets increased. With that increased revenue, he can take welfare activities. So war is a acceptable practice. War is an acceptable practice earlier. Right now, war is not an acceptable practice. Understood? So applied ethics always looks at controversial topics. Importance of ethics in human life. Let me take you as an example. You are a student. Right now, coaching is completed and you are going to appear to the upcoming exam. You are going to appear upcoming examinations. Yes or no? Imagine you are left with 3 months time for revising all the concepts of CMA Inter. In front of you, 90 days time is there. Each day, 10 hours you can spend on reading. So 900 hours you are having to complete preparation of CMA Inter and you can attempt examination. Now each day you will have two alternatives. One alternative you enjoy. Okay, postpone the schedule. So tomorrow I will read. So today let me watch movies. Let me play cricket. So this is one alternative. And the other alternative, completion of schedule as and when is required. So today, yes, you fixed schedule of reading business ethics. So completing that schedule. So come on, tell me which alternative you will select and why you will select that alternative. So definitely I will select the alternative, preparation only, sir. I'll postpone all the enjoyments after examination. So because of choosing this alternative, you can accomplish your goals. You can perfectly attempt exams. You can definitely achieve success in the exams. Once you qualify these examinations, once you become a cost and management accountant, so you can definitely get a good job, or you can choose a practice as a career, or you can start a business. So your standard of living gets increased. Yes or no? Your standard of living can be improved. So right now your income earning is zero, but once you finish, CMA Inter and CMA Final, once you become a cost and management accountant, you will be placed in a job, or you may start your own practice, or you may start your own business. So your income earning gets started quickly. With that income earning capacity, you can lead a good life. Not only you, your parents and your next generation, that means your kids. So all three generations depends upon your preparation. Yes or no? So now tell me, choosing a right alternative over bad alternative is nothing but ethics. Let's look at the content. Ethics is a requirement for human life. It is our means of deciding a right course of action. Only through actions you can achieve your goals. Without ethics, your actions will be random and aimless. So no achievement of targets. It's just random and aimless. Even with an ethical standard, we may be unable to pursue our goals with the possibility of success. Yes, of course, following ethics alone is not sufficient. Hard work is also required. So what I'm telling you is just following ethics, one cannot achieve goals 100%. Along with ethics, hard work is also required. To the degree which a rational ethical standard is taken, we can correctly organize our goals and actions. What is your target? And for achieving the target, what are the inputs you need? What are the actions you need to perform? You just try to correlate them. Any flaw in our ethics if you are not following correct ethics, if you are not following correct option, it will reduce your ability to be successful in your future, in your endeavors. A proper foundation of ethics requires a standard of value to which all goals and actions can be compared to. A system of ethics must further consist of not only emergency situations but day-to-day choices we make constantly. So some students, if you observe, a week before examination, a month before examination, day before examination, they will start preparation. So they will spend 24 hours. Okay, 6 hours of sleep time. Okay, apart from sleep time, they will try to invest 18 hours time, before examination. I'm telling you, sorry, I'm asking you, is it a correct practice? So practicing ethics only at emergency situations will give you, do you think it will give you desired results? No, not at all. So you should follow ethics in your day-to-day lives. It must include our relations to the others and recognize their importance not only to our physical survival but to our well-being and happiness. Next, nature and relevance of ethics to the business. So this concept, this relevance of ethics to the business. On this concept, we are having 3 to 4 questions. So don't get confused with these 3 to 4 questions. So try to understand the concept and remember the concept. Clear? And many students, they're remembering the examples and they're reproducing examples in the examination. But that is not a correct practice. That is not at all a correct practice. You have to reproduce the content of the each and every question answer. Understood? So it is very important to remember the content, not the examples. Even in your examinations, they are not asking practical scenarios. They are asking you direct questions. Is it clear? Next one, nature and relevance of ethics to the business. Sir, why business people should follow ethics? Let me give you one small example. And this example is sufficient for all the questions which are connected with business ethics. So follow me carefully, ma. So today, a business organization is having multiple stakeholders. Let me give you one small example. Every business organization, yes, you all know business is an economic activity, yes or no? So it involves, procurement of raw materials, processing materials into finished goods, and selling these finished goods to the customers. And next one, rendering services to our clients. So business is an economic activity. Next one, ethics is a set of rules that help you in selecting the right conduct over wrong conduct. Now listen to me carefully. Business organization, for producing finished goods, definitely they need raw materials. So they get raw materials from suppliers. And using a labor, machinery, so they process these raw materials. So they convert these raw materials into finished goods. And they will sell these finished goods to the customers. Now from these sales, yes, every business organization is liable to collect and pay goods and services tax to the government. Yes or no? Of course, negative list, ignore. Negative list of goods and services, you ignore. I'm telling you a common point. At the end of the year, whatever profit, this business organization is having, on that profit, they need to pay income tax to the government. Now, if you observe carefully this particular business organization, now how many people are connected with this business organization? One is supplier, next employees, labor employees, next customers, central government. Yes or no? Not only these people, investors, for purchasing machines, for purchasing raw material, definitely you need investment. Yes or no? So this investment, yes, investors will make investment. Few investors are, owners of the business organization, and others are creditors, non-trade creditors, like, bankers. So these people will provide finance to the organization in order to carry business operations. Now, as a manager or as a CEO of this organization, you need to protect the interest of all the persons connected to this business organization. How? You need to make timely payment to the suppliers. You are having funds, but you are not making payment to the supplier. If supplier is calling you, you are telling that I'll make you payment after 1 week, I'll make you payment after 1 month. This is not ethical. So make timely payment to the suppliers. Make timely payment of wages to the employees, salaries to the employees, wages to the labor, salaries to the employees. And we are having other acts like Gratuity Act, Bonus Act, Provident Fund Act. Obey all those laws and accordingly make payment to the employees. Next one, provide the goods, produce the goods, and sell the goods to the customers according to the customer expectations. Understood? So what customer needs? First, you study the needs of customers. Accordingly, produce the goods and sell the goods. So provide the best quality goods at reasonable prices and make payment of taxes to the central government in a timely manner, so that you can be part of development of the economy. You can be contributor to the development of the society, development of the country. Next, provide adequate returns to the investors and make timely payment of all installments to the creditors. So all this comes under ethics only. Are you all getting my point, students? Everyone. Now let's look into the material ones. Organizational culture, management philosophy, and ethics in business each have an impact on how well a business performs in the long term. See, many business organizations, they failed to perform in long term. So they came into the industry and they performed in short term and they failed to run in long term. The reason is lack of ethics. It's exactly lack of ethics. See, any person can cheat one person only once in the lifetime. If you cheat one person in lifetime, the other person will definitely lose trust over you. If you sell cheap quality products at cheaper prices to the customer, one time he will purchase, looking at the price, he will purchase. But after consumption of the product, if he come to know that this product is very cheap, the quality of the product is very cheap. Understood? This is not at all a reasonable thing. So this business organization is trying to cheat us. So if customer gets that kind of conclusion, if customer is at that kind of conclusion, he will not look at you. If customers are not coming to you, definitely your business is a failure model and you will end up with coming out of the market. You can't achieve a long-term success. Understood? So organization culture, that means organization beliefs, their policies will have an impact on the business in long term. No matter the size, whether you are a small industry or whether you are a big company, whether you are a profitable company or not for profits company, suppose charitable organizations, business ethics is compulsory for long-term success. The management team sets the tone for how the entire company runs on day-to-day basis. So it's the management, management is responsible with the designing these ethical policies, training the employees to adhere to follow these ethical policies. Building on a foundation of ethical behavior helps create long-lasting positive effects for a company, including the ability to attract and retain highly talented individuals. If you are making payment of salaries on timely basis, if you are making payment of bonus on timely basis, definitely you can recruit talented individuals and you can retain them in a long run. And it helps you in creating positive reputation in your locality. Running a business in an ethical manner from top down builds a stronger bond between individuals on the management team, further creating stability within the company. See, let me tell you one small issue. See, there are two types of managements. One management, in order to make employee work productively, so one management is offering incentives. So if you complete this target within this time, so you'll be given 10% bonus, 10% of your salary as bonus, or 20% of your salary as bonus. This is one management. Other management, it is telling like this: if you are unable to finish your work, I'm going to remove you. I will terminate you, or else 50% penalty. You have to pay 50% of your salary as a penalty. So now tell me, which management is good management and which management is bad management? First management is good, sir. With respect to first management, the employees feel a friendly atmosphere in the organization and they will try to work for the growth of the company. Now coming to the second management, here employees feel they are like this: if I am unable to finish the work, my salary will be cut. So without any productivity, he will try to finish the works. He will not bother about, he will not focus on the errors, he will not focus on the mistakes. He will try to complete the work within the time. And moreover, whenever time comes, he will try to earn unlegal or undue advantage from the company operations. For example, in the second organization, employee is having a responsibility to enter into an agreement with a supplier. Now employee, he will try to collude with supplier. He will ask supplier like this: supplier, you supply material at higher prices. 80 rupees is the price of the product, right? You provide invoice 100 rupees. So you will get a gain of 20 rupees, right? 15 rupees you keep, 5 rupees give it to me. So like this, if employees start doing these practices, So 20 rupees is a loss to the organization. And why that employee is doing like that? Because the top level management is not creating a friendly environment. It is trying to deduct the salaries whenever employee is committing a mistake. So because of these practices, definitely organization will lose a lot of profits. At one point of time, a shutdown will take place. That organization will shut down. Understood? Everyone getting my point, students? So you should create a friendly environment among the employees. When management is leading an organization in an ethical manner, employees are also following those footsteps. Employees make better decisions in less time with business ethics as a guiding principle. This increases productivity and overall employee morale. So offering bonus one management, whereas punishment another management. You can observe where you find the productivity of employee. When employee completes work in a way that is based on honesty and integrity, the whole organization benefits. Or else, employee will try to earn commissions from the company operations. It leads to loss to the organization. The importance of business ethics reaches far beyond employee loyalty, moral strength of a management team bond. As with all business initiatives, the ethical operation of a company is directly related to profitability in both short and long term. See, at the end of the day, investors will look at the profits of the organization. If it is in profits, definitely investor will assign with the organization, or else investor will come out of that organization. Yes or no? And not only investors, employees also. If employees are getting regular salaries on timely basis, they will work in that organization, or else they will resign from that organization. The reputation of a business from surrounding community, other businesses, individual investors is paramount in determining whether a company is worthwhile investment or not. So these are the factors affects investment. Understood? If a company reputation is less, obviously no one will come forward to make investment in that company. So yes, organization will lose investors, organization will lose the value of share or the value of the business. With consistent ethical behavior comes increasingly positive public image. There are few other considerations as important to potential investors and current shareholders. Next, to retain a positive image, business must be committed to operating on an ethical foundation as it relates to the treatment of employees, respect to the surrounding environment. You should promote environment protection practices and fair market practices in terms of price and consumer treatment. Business ethics is an applied ethics. As I told you beginning only, business ethics is the best example of applied ethics. Businessman, take a example of CEO, take a position of CEO. He will have two alternatives. One alternative, yes, produce a cheap quality product, sell it at a normal price. But because of this, what happens? Exploitation of consumers will happen. Consumer health gets affected. So this alternative is not a good alternative. And the best alternative is produce a product with a better quality and sell that product at a reasonable prices. So this definitely helps organization to achieve success in long run. Next one, 7 principles of ethics in public life. Important topic. So you can expect this question for 7 marks. See, in the year 1994, the Prime Minister of the Prime Minister of Britain country, the British government appointed a committee called Committee on Standards in Public Life. So what is the name of committee? Committee on Standards in Public Life. See, this committee is for advising the Prime Minister on ethical standards of public life. And this committee was established in October 1994 in order to examine the current problems, current concerns, current situations about standards of conduct of all holders of public office. Holders of public office means, ministers, MPs, Member of Parliament, MLAs, bureaucrats, and all these civil servants, IAS, IPS officers, IRS officers. Next, IPS includes, IPS means police only, right? So again, asking police separately, no. So all this comes under, holders of public office. So what is the main objective? What is the main duty of these people? MLAs, MPs, civil servants. So they should take action which results into the public welfare. Understood? So they work for the welfare of public. They work for public. So all the holders of public office, so they should follow these principles. First, this committee identified the current concerns about the standards. And next, this committee is for making a recommendation regarding changes in present arrangements which might be required to ensure highest standards of propriety in public life. Yeah, sitting in the position of prime minister, it is not possible to him to interact with the public and what are the problems faced by the public, so how the problems will be solved. So that's why, what prime minister will do. Prime minister, under prime minister you'll find, bureaucrats, you'll find the public servants. So through public servants, prime minister can know the problems of the public, and these people, holders of public office, are directly connected or directly available to the public. So if these people are working in a good manner, definitely public gets benefited, or else public will be at loss. Understood? So to review the current scenario and to make recommendations in order to enhance, in order to improve the standard of living, yes, the British government appointed a committee, and the 7 principles of public life were set out by Lord Nolan for the first time in the year 1995, and this keep on amended over a period of time. And the 7 principles are selflessness. It is all about choosing a public interest versus personal interest. As a holder of public office, you should work for public interest only. You should not try to earn profits from your duties. Understood? Suppose you are a police, or imagine you are a judge. A case came to you. The person who committed crime, who committed offense, is offering you a good amount, like some 10 crores. So please take this 10 crores. Acha, fine. Let me change my example. You are a IRS officer, you are a commissioner of income tax. A case came to you. In that case, a person, he didn't pay income tax of 30 crores. Now, as a commissioner of income tax, you must issue an order asking him to pay 30 crores tax, next interest and penalty. But that person offered you 10 crores bribe. Now, what you have to do? So 10 crores amount is coming to me. This is one alternative. Other alternative, imposing interest fine, giving order to that person. If I give order to that person, government will get a revenue of some 50 crores, including interest fine, it is 50 crores. So if I choose this option, I'll get 10 crores benefit. If I choose that option, government get 50 crores, I get nothing. So for me, it is 0. So now which option I should select? So this 10 crores is definitely a tempting option. Personal interest, definitely a tempting option, but you should not select this option. You should be selflessness. You should select an option which gives benefit to the public. So you should select the option of imposing a fine interest. You should issue an order. Understood? Selflessness, it is all about public interest versus personal interest. Next, integrity. So holders of public office must avoid placing themselves under any obligation to people or organizations that might try inappropriately to influence them in their work. So you should not stand in a position, where you are biased to someone, some group, or where you are taking a decision which is favorable to your personal family members, your relatives. You should not do like that. You should make a decision which is beneficial to the public at a large. Objectivity. So you should be strictly impartial. You should be fair, and based on the evidences, based on the documents, you should make a correct decision, even without any discrimination or bias. You should act as an unbiased person. Accountability, answerability. Accountability means answerability. So you should place yourself under the public. So you should feel public is a great personality, public or great persons, and always whatever decisions you are taking, whatever actions you are implementing, so at the end you should be answerable to the public why you did like this. Understood? You should not feel yourself as a superior. Yes, I'm superior, all the public are next to me only, so whatever I tell, public has to listen. You should not be like that. Understood? Next one, openness. Holders of public office should act and take decisions in an open and transparent manner. So whatever decisions you are taking, why you are taking the decisions, you should answer to the public. Next one, honesty. That means truthful. Next one, leadership. You should exhibit these principles in their own behavior. They should actively promote and robustly support the principles and be willing to challenge poor behavior whenever it occurs. So yes, whenever a lead comes, whenever a change of arrangements comes into the picture, you should take a initiative. You should ask public to comply all these policies. Are you getting my point, students? Suppose government introduced a policy. Government introduced a policy, for example, Swachh Bharat. Swachh Bharat. Now you should take initiative for implementing these policies, and you should make all the people to follow these policies. Understood? See, one point I can tell you: holders of public office, they get salaries from the taxes paid by the public. That's what, they are public servants. They should serve public. Are you all getting my point, students? Even MLAs, MPs, they are people representatives. Their agenda is to serve people. Their agenda is to serve public. So they should place themselves in a position to satisfy all these 7 principles. Are you all getting my point, students? Everyone, very important topic. So what are those 7 principles of ethics? Come on, tell me, what are those 7 principles of ethics? Selflessness, integrity, objectivity, accountability, openness, honesty, leadership. Remember all these 7 points. Very, very important. 7 points for 7 marks. Next one, code, committee on standards in public life. Remember these committee names. Remember these years. It is important for multiple choice questions. Next one, relationship between ethics and law. See, I can tell you one small point. Law is a set of codified norms. Ethics is a set of moral practices, moral principles. The main difference between ethics and law, as I told you, it is a set of codified norms. A parliament first, it will draft a bill. Once the bill is approved by both the houses of the parliament, it is sent to the president for consent. Once president gives consent to the bill, it becomes act. Understood? Act plus rules plus judgments, all put together, we call it as law. Ethics, it's just a moral principles. Understood? And these moral principles, they keep on changing from time to time. Example, previously, earlier days, we had a concept called sati. When husband died, wife should also die along with the husband. And there is a concept called untouchability. So in society, people were divided into 2 groups: higher caste groups, lower caste groups. Lower caste groups should not sit along with higher caste groups. Lower caste groups should not eat along with higher caste groups. They should not reside along with they should not reside with higher caste groups. They used to reside at a place far away from higher caste groups. So untouchability concept is also there. Right now, can you see these concepts? Sati, untouchability? No. So when environment is getting changed, when the society is getting changed, we are eliminating old practices and we are entering into the new practices. So ethics is something, it is not static in nature, it is dynamic in nature. It keeps on changes with the changes in people behavior or something like that. Understood? Whereas law, it is fixed. Law is fixed. Once law is framed, you have to follow that law until it gets amended, until it gets repealed. Are you all getting my point, students? And one small point, ethics starts where law ends. Ethics starts where law ends. It is not possible to codify everything in a law. It is not at all possible. We will recognize good practices. In law, what we do, we will recognize good practices and we will recognize bad practices. Good practices, you have to follow. Bad practices, if you follow bad practices, you will be punished. Understood? So law obviously comes from ethics, but complete ethics you will not find in law. That's what, ethics start where law ends. Law and ethics both serve similar purpose of guiding human conduct, make it conducive to the civilized social existence. They enforce a sense of right and wrong. Law refers to a set of codified norms which are enforced by the state. State means government. They act as external obligations. You have to fulfill them. Whether you like them or not, you have to fulfill them. Suppose at a traffic signal, red signal appears. You have to stop. No, sir. I will go, sir. I will go, sir. No. It is not possible. External obligation. On the other hand, ethics refers to set of norms which guide our internal compass and judgments. Like I told you, finder of lost goods. So if you are an ethical person, you will try to find out the true owner and you will return all the things to the true owner. It's your internal compass and all about judgments. Ethics guides you, internal compass and judgments. Law is external, ethics is internal. While laws apply uniformly to all, irrespective of religion, culture, and area, everyone should follow the law. Sir, I came from a traditional family, sir. So I'll do these practices when I incorporate a company. So I'll file all the annual returns on a good day only, sir. I will not file annual returns on bad days, sir. Like we are having the days, right? We will see the days like, for example sake I'm telling you. we are having 2 days like Amavasya. Next one is Purnami, full moon day. The other one is no moon. So, sir, I'll file all the annual returns, all the financial statements on good day only. Even if the 60th day, actually annual returns shall be filed within 60 days of conclusion of AGM. 60th day is not good day, sir, so I won't file it. Can I do like that? Not at all. So law is uniformly applicable to all, whether you came up from one religion or other religion, it is immaterial. You have to follow law. Ethics vary from person to person. They change more frequently than laws. Very frequently, ethics gets changed. Whereas laws, it's a fixed thing. Until and unless it gets amended or repealed, you need to follow those laws, whether you like it or not. In case of breach of law, government is having a right to punish, hence work as a medium of retributive justice. That means, not only committing mistake, even if you attempt to commit mistake, you will be punished. Understood? You try to kill a person, you killed a person, or you attempted to kill a person. Both the cases, you will get the punishment. So this will act as a measure from preventing of happening offenses. On the other hand, ethics were generally not at all enforceable. Yes, breach of law enforceable, breach of ethics not enforceable. The relationship between laws and ethics is a complex one. Many laws are representative of ethics of the time, and they have been shaped by what is considered ethical. Now, discipline, accepting, promise keeping, prudence. Next one, all these were recognized in Indian Contract Act. You can see, promise keeping. If you breach the contract, you'll be punished. Understood? So ethical practices were recognized by the law. Not all ethical practices, only few. The idea that everyone is equal before law is derived from the value that human is born equal. At the same time, laws also shaped ethics. Laws have shaped ethics. Yes, a laws related to untouchability. Next one, abolition of sati, abolition of patandars. So all these also shaped ethics. If there is no law regarding untouchability, then people might have followed the same practices. So entire public is divided into two groups: higher caste, lower caste. Higher caste will not look at lower caste people. Higher caste people will not encourage lower caste people from getting good jobs. Understood these scenarios? Next one, law can never be so exhaustive. Law is never an exhaustive thing. So if you start writing a law, it never ends. Why? Because the environment is dynamic in nature. So covering all the aspects, it is highly impossible. Even if you cover today, the tomorrow is a new thing. Tomorrow will be a new thing. How can you cover the future things? You can predict and you can write a law. But the point is, in future, suppose if things gets changed very quickly, then how can you guess them, and how can you make them part of law? Understood? In such scenarios, ethical behavior should come from within. Best example, previously robbery happens. Robbery used to happen at banks or at your homes. Yes or no? So thieves used to come to your home and they will rob something. Right now, you are keeping money in a bank. Yes or no? Everything is digitalized. Now for making a robbery, what these people are doing, they're making a hacking. They're hacking your bank accounts and they're transferring all the money in your account. So all this comes under cyber crimes. So it is not possible in earlier days to detect a cyber crime or to identify cyber crime and to punish the people who are committing these cyber crimes. Earlier days lawmakers don't know about this concept. Right now, when we are looking at these things, yes, we started framing laws to cover all these things. Are you getting my point? So previously robbery is a crime. Right now, hacking is also a crime. Hacking some personal information, personal data is also a crime, like that. There are many scenarios where laws cannot exist, as we cannot have strict laws to scrutinize every small act of corruption. Even with laws, some unethical practices continue to exist, such as violence against women, domestic violence. Laws and ethics are equally important and go hand in hand. Next one, values and attitudes of professional accountants. See, after clearing your CMA final examinations, you'll be cost and management accountant. As a cost and management accountant, you're having three alternatives. One is practice career, CMA in practice. The other one is employment, and the last one is business. So about business, I discussed with you so far. Now I'll discuss with you, I'll revise the things regarding practice and employment. So once you achieve your qualification, either you may select either of these three options. Business ethics, so far I discussed with you. Now practicing as a practicing cost accountant or as an employee of an organization, what you have to do what ethical practices you have to implement from day one onwards. So that is all about, role of professional accountants. Role of professional accountants in business, role of professional accountants in their profession. Understood? So the roles professional accountants take on a vast array of other roles in a business of all sorts, including public sector, not-for-profit sector, regulatory bodies, professional bodies, and like that. So as a professional accountant, you will have no, your scope is not a limited scope. That's what your scope is, not at all limited. You will have unlimited scope. Suppose as an engineer, as a designer, for example, I may design a project. For designing the project, I need some resources. For procuring these resources, who should help me? Finance department should help me. Next one, once the design is completed, now I should start building up the project according to the design. For that, I need resources. Who will manage all those resources? Finance department. For getting these resources, finance department has to make payment. Finance department has to make a sufficient finance reserves so that it can help me in developing the design and developing the project. Now once project is ready, so I should explain to the clients and I should get orders from the clients. Once the project is sold, so whatever money is getting, finance department will collect that money. And as an engineer or as an employee of the organization, I expect a salary and I expect a bonus at the end of the project. I expect some additional benefits. And who should take care of me? Finance department. Who will be present in the finance department? You. Cost accountant or a management accountant, you will be placed in the finance department. Now you should take care of all these activities. That's what I am telling you. As a professional accountant, your scope is not at all limited. Your scope is unlimited. Your scope includes public sector, private sector, not for profit sector like charitable organizations, regulatory bodies, professional bodies. The wide ranging work and experience find commonality in one aspect, their knowledge of accounting. So common thing, you know all these departments. At the end, you have to carry accounting. You have to account each and everything. Yes or no? Everything, but in an ethical manner. Sir, how ethics help in this accounting, sir? See, ma'am, you're a cost accountant. Some bills came to you. Bills regarding production came to you. Out of 10 bills, 9 bills are connected to the production. And another one bill, it is, it's a personal expenditure of a director. It's a personal expenditure. It's not even a business expenditure, personal expenditure of director. Now, as a cost accountant, you should consider only these 9 bills in finding out the cost of production and in finding out the sale price. Sir, what happens if you include this one bill? The cost of production gets increased and sale price may not be reasonable. Ultimate burden you are shifting to the public. It is not at all correct. It is not a correct ethical practice. Understood? So looking at the bills, looking at the cost, first you need to recognize which cost is a direct cost, which is an indirect cost, which cost we should apportion to the product, and finally arriving to the cost of production, and finally adding some margin to reach the selling price. Understood? So just I'm having accounting knowledge, debit what comes in, credit what goes out, debit the receiver, credit the... Yes or no? Are you getting my point, students? So simply knowing the principles of accounting, I know I'm having a knowledge of accounting alone is not sufficient. You should work beyond it. Professional accountants in business have the task of defending the quality of financial reporting right at a source where the numbers and figures are produced besides the cost accounting. Like the counterparts in taxation or auditing, professional accountants in business play important roles that contribute to overall stability and progress of the society. Yes. Now, if you include this one bill, what happens? Cost increases, profit comes down, payment of taxes to the government will also come down. This is the personal expenditure of director. You should debit that expenditure to the director. Understood? So you must make for that amount director as a debtor. Collect that amount from the director. That's it. So don't follow simply whatever they tell. Apply your common sense. Next one, of course, ethics is all about application of common sense only. A competent professional accountant in business is an invaluable asset to the company. These individuals employ an inquiring mind to their work founded on the basis of their knowledge of company's financials. All the examples I discussed with you are connected with these points. Everyone getting my point, students? So just look at these points. Cost management. Cost management is an activity of managers related to planning and control of costs. Managers have to take a decisions regarding use of materials, process, product designs, and how to plan cost or expenses to support the operating plan for the department or section. Now, when you are appointed as a cost accountant, now you have to take care of all these things. So what is the material required for producing a product? What design we are following? While following these designs, what would be the cost, expected cost? You have to make all the decisions and you have to make allocation of these resources accordingly. Then only you can reduce the cost. Cost reduction means terminating employees, half of the employees, and asking remaining employees to work overtime. Understood? It is not like that. Terminating employees and allowing other employees to work overtime, it is not a correct ethical practice. Next one, all these activities come under cost management. Information from accounting system help managers in cost management account activities. So like what, at what prices suppliers are ready to supply the material, and what is the quality of the material offered by the supplier. So best quality at reasonable prices you have to select, and you have to procure those materials. If raw material is superior quality, then the finished good will also be a superior quality product. Understood? But the cost accounting system and the report it generates is not the cost management system. It is a part of cost management system. Accounting system, cost management system looks similar, but they are not same. Accounting system is a part of cost management system where cost accountant will make a decision, will interpret the situation, and will make a reasonable decision. Cost management is not cost reduction alone. The cost control is also there. It is much broader. Organization generally increases advertisement expenditure to increase sales, increase research and development expenditure to promote new products. Here, the managers are deliberately incurring additional cost in a period, compared to previous periods, as they expect more profits from such decisions or expenditures. Cost management system has to ensure that the cost is incurred with the expectation of a profit. Understood? So each and every rupee you are spending with an intention of earning profit only, and that too in ethical way only. Clear? Role of management accounting. Now here, the designation offered to you is a management accountant. So definitely you will have these three things. You have to perform all these three things. One is problem solving. Next one, score keeping, attention directing. First, you need to identify the problem. For that, first you need to fix the standard. And compare this standard with actual results. What is the standard result and what result we achieve? Comparison will give you variances. So those variances you have to identify, and you have to frame a new strategy or a new policy to control those variances. It's like standard costing. For example, at the beginning of the year you'll be given a budget. So for producing 1000 units of a product, yes, some 50 lakhs is a budget offered to you. At the end of the year, the actual cost for producing these 1000 units went up to 60 lakhs. So definitely, yes, there is a problem. Yes, problem in this particular department. Identify the problem and identify the variance. What is the variance between standard and actual, and try to eliminate that variance. So problem solving. Next one, score keeping. Score keeping records the results of various actions of the managers and helps in assessing whether the results expected from various actions are realized or not. So what actions actually implemented by the managers in the operation department, and what is the result of the department? So compare them, identify the variance. The score keeping function is a combination with expected results and comparative analysis of scores of various companies, divisions, and departments. And this comparative analysis of present period scores as well as with previous period scores will give you an opportunity of focusing attention of the manager to improve the things. Example, best example, last year 10 crores is the turnover, profit is 2 crores. Now the turnover is 20 crores, whereas profit is just 3 crores. In spite of increase of turnover by 100%, the profit increased to only 50, profit is increased by 50% only. Turnover doubled, whereas profit it is just 50% got increased. So what is the reason? Identify the area, pay attention, and try to resolve those errors. This is all about, implementing ethical practices in the business. Next one, business code of ethics and its relevance to the business. Previously, I discussed with you relevance of ethics in business, but this is, framing a code of ethics. Every organization should frame this code of ethics, and it should train their employees. It should train their managers. Everyone should be accustomed to follow those ethical practices. Understood? So a business code of ethics is a body of policies based on laws. Obviously, organizations should frame these policies based on the applicable laws and values that a company wants all employees to follow. All companies can set their own value based policies as part of company brand. Understood? See, some organizations, if you observe carefully, some organizations, after selling the product, periodically, like weekly or monthly, they will call their customers and they will ask them whether they are satisfied with the customers or not. Whether they are satisfied with the products or not. If there is any complaint, they will record the complaint and they will try to resolve those complaints in the newly, in the upcoming products, whatever the production is taking place. So they will try to incorporate new things in order to resolve all those complaints. And few organizations, after making sales, they forget about their customers. Getting my point, students? So one organization ethical policy is like this, always keep in touch with customers, always try to resolve the customer complaints whenever customer is facing a problem. Other organization policy is not like that. No, obviously customers will assign to the first company organization and customers will leave the second organization. So second organization, it can't achieve it in long term. First organization, it will achieve success in long term. So while framing this ethics, you have to consider these following elements. Promoting green business practices. So whatever wastage is coming from your products, try to recycle them. Eliminate, try to reduce the wastage first of all. And all your practices, all your operations should be environment friendly. Suppose your particular factory is emitting pollution, air pollution. So make arrangements to separate poisonous ingredients from the air getting from that machine and release that air. Next one, the same cleaning company could require that all products follow specific environmental standards of safety for people, pets, and the environment. Next, obeying the law. Obviously, everyone is required to follow the law. Following the laws is nothing but you are acting as an ethical person. Next one, caring and consideration policies. So every organization should take care of their employees. Every organization should care their employees uniformly, equally. So there should not be any discrimination. You should not be biased, giving fair treatment to one employee and unfair treatment to another employee. You should not do like that. Next, confidentiality and privacy policies. This is the major thing. The reason, why the organizations, why the business entities are losing the customers. Suppose you are a student. Yes, let me take an example. You are a student, right? While registering in a website, any website, you are giving your personal information like your mobile numbers, your mail IDs. Now, if that organization is not maintaining confidentiality and privacy policies, it leads to the loss of your information to other business entities. Now, what happens the very next day, all the coaching institutes will try to call you. So we are offering this course at this price. So come and join, pay now, like that. What happens? It creates irritation. It definitely creates irritation. Yes or no? Now you will start blocking these contacts. Let me tell you my personal example. So what happened, a year back, what I did, I opened a demat account with one broker. I don't know how my phone number and my mail ID got placed, how it was made available to the public. I don't know. Daily minimum 3 calls I used to come from the other stockbrokers. So we will offer tips, just pay us 20% commission. Are you trading? Are you active trader? So we will give you tips. We will give you tips. Almost, if you observe my phone, my call list, 60 to 70 numbers are in my block list. 60. Whenever a spam call comes, I use it to block immediately, even without answering the call. I use it to block it. The loss of personal information leads to loss of customers only. Many companies, agencies have fallen prey to the hackers stealing client information, proprietary data. One code of ethics section can require that employees maintain confidentiality while handling and when handling customers' personal and private information. Next one, professional appearance policies. Your employees should have a proper dress code. Even in your schools, if you observe, dress code is there. Now you're having a dress code, definitely, it creates a uniformity, it creates a good environment among the students. Or else what happens, rich student will always try to wear a rich clothes. Middle class student will try to wear reasonable clothes, and a poor class, a poor family student, he will wear some dirty, ugly clothes. Are you getting my point, students? But having a dress code, so all the students looks equal, so fair treatment. Similarly, in a company also, all the employees of the organization must follow a proper dress code. Understood? And the dress should, this could include a uniform shirt for service providers, a suit tie for accounts representative, a business casual for Fridays. Even if you go to a vehicle showroom, the managers in sales department, they wear one kind of dress. And if you go to service department, where vehicles gets washed, the workers of the department wear another kind of dress. Next one, value chain. So yes, very important, business code of ethics and its relevance to the business. So 5 points are there: promoting green business practices, obeying the law, caring and consideration policies, confidentiality and privacy policies, professional appearance policies. 5 points, very, very important. Next, value chain. See, value chain, it's a visualization of complete business as a sequence of activities. Business organization, it get materials from suppliers. Once processing is completed, organization will supply goods to the wholesaler. Wholesaler will supply goods to the retailer. From retailer, end customer used to get the product. So this is the complete chain. In this complete chain, at every point, some value addition will take place, and that value addition has to take place according to the needs of the customer. According to the needs of the customer. Yes, from supplier we are purchasing a raw material. As a manufacturer, I'll produce a bulk quantity. For example, I'm engaged in sugar manufacturing unit. I processed, for example, on a given day, I processed some 3 tons of sugar. 3 tons of sugar. If you open godown, you will find 3 tons of sugar. Now, is it possible for an end customer to purchase 3 tons of sugar? Can I ask customer like this, if you want to purchase it, or else don't purchase? It is not possible. It's not a correct. Now, coming to the wholesaler, what happens? These 3 tons of sugar will be divided among some 10 to 20 wholesalers, equal quantities. Wholesaler, what he will do? He will send small quantities to the retailer. Retailer will finally sell the product to the end customer. Now, end customer, what is his requirement? Maybe 1 kg or 2 kgs or 5 kgs. So according to that, packing will happen. Packing of the material will take place, and it's very easy to the end customer to get a product at a reasonable cost as well as a reasonable quantity. So directly manufacturer can't satisfy end customer. Directly it is not possible. So in this chain you can observe like this, raw material supplier, processor, wholesaler, distributor, retailer, and finally end customer. Whatever activities is happening in this plane, in this chain, so value chain activities we call it as. Management accountants provide decision support for managers in each activity of a value chain. How? So what is the need of the end customer? So accordingly carry processing activities. Even in sugar, you can see the size of the crystals. Some are very small, some are medium, and some looks like a big thing. Now end customer, what is his requirement? A small size crystal sugar, or medium size or large size. So for that, definitely these management accountants provide input for making a valid decisions. The design of management accounting system has to take into the consideration the needs of the managers, the new themes and challenges that managers are facing currently. Coming to the elements of value chain, 4 elements are there. You have to remember all these 4 elements. In examination, they will ask you question like this: value chain and its elements. Now you have to write all these 7 points, then only you will get 7 marks. So value chain elements, we are having 4 elements. One is customer focus. Whatever product you are producing, whatever service you are rendering, it is according to the needs of the customer. It's not like this, producing a product and asking customer to purchase that product, whether customer is willing to purchase it or not. You are forgetting about it and you are asking customer, come on, purchase it, purchase it. It's not an ethical practice. It is not at all an ethical practice. So identify the needs of the customers, accordingly produce the goods, accordingly sell the goods. Next, the key success factors. So cost, quality, time, innovations are the important key success factors. Produce the product at a less cost with a reasonable quality and supply the product at a right time. If innovation is possible, improvement is possible, come on, implement all those improvements. Continuous improvement. Every time some small change, small improvement must be compulsory. Or else what happens? Customers will go to other business people. Customers will go to other organizations. At the end, you will finish. You have to shut down your operations. Best example, if you take mobiles. Previously, when I was kid, I used to watch only keypad mobiles. Next, touchpad mobiles. In touchpad mobiles also, you can see the improvisations. Yes or no? Processor improvements in the processor, the camera quality, and the size of the memory. So everything is getting improvised over a period of time. So innovation related to this area in costing is Kaizen costing. Even a small improvement is also a mandatory. Next, value chain and supply chain analysis. Value chain as a strategic framework for analysis of competitive advantage was promoted by Michael Porter. And management accountants have to become familiar with the framework and provide information to implement the framework by strategy planners. These strategy planners, they will frame strategies. For that, they need inputs, and it is you, as a management accountant, should provide valuable information. Understood? So the requirements of the customer, availability of resources, availability of machines, availability of labor, all these things helps you in framing a perfect strategy. And that perfect strategy will help a business to run in long term. Next one, mission statement of ICI. In one attempt, this question was asked. So total some 13 points are there. You have to remember these points. Mission statement of ICI: the cost and management accountant professionals would ethically drive enterprises globally. It's not a drive, it's drive enterprises globally. It's not within the state or within a city or within a nation. So all the entrepreneurs, they should flourish globally by creating value to the stakeholders. Stakeholders is a broader term. Shareholders are part of stakeholders. Understood? Stakeholders includes customers, suppliers, labor, employees. Next, government, financiers, investors, shareholders. Everyone comes under stakeholders. Whereas shareholders means the person who is holding shares of a company. In the socio-economic context, society point of view as well as finance point of view, you should create value from society point of view as well as finance point of view. True competencies drawn from the integration of strategy, management, and accounting. Integration by integrating the strategies framed and management techniques, accounting things. So integrating all these things, yes, the institute is expecting the professionals would ethically drive enterprises to flourish globally, and thereby creating a value to the stakeholders, not only the society point of view but also finance point of view, socially as well as economically. An institute has promulgated the following standards of ethic conduct. What are they? Maintain all times independence. You should be independent. Next one, don't express opinion without assessing your relationship with the client. If you had any financial relationship with the client, don't accept that engagement. You should be independent. You should be independent of thought, action, as well as you should be independent while reporting the things. Suppose if you find a mistake, a fraud in the entity, and you had a relationship with the entity, suppose the CEO of the company is your relative. Now you can't tell them the frauds. Why? Because if you disclose the frauds, what happens? The CEO may lose his job. So first assess your relationship. And then accept the engagement, audit engagement, or any kind of works. When preparing cost or financial reports or statements or expressing an opinion on cost, financial reports or statements, disclose all material facts known to such member. So when you are expressing opinion on the cost reports or financial reports, if you are expressing a disclaimer opinion, a negative opinion, adverse opinion, first of all, you have to disclose the facts why you are expressing that opinion. Or else, your opinion or your reports may create some misleading among the investors, among the stakeholders. Understood? So why you are expressing the opinion, what are the material facts found by you while reporting or while auditing, you have to report them. Next one, not to disclose or use any confidential information. So don't disclose client's confidential information, or don't disclose your employer's confidential information. Best example, my client is in beverages company. For developing a formula, he invested some 10 crores rupees money. The formula for producing a beverage, manufacturing beverages, he is having a formula. For developing that formula, he spent 10 crores. Now, as an auditor or as an employee, I used to know that formula very easily. Now, I should not sell that formula to my competitor, to the organization competitor. If I sell it, what happens? This organization which already invested 10 crores, it is selling product at 20 rupees. And that organization, just with the zero investment, it started producing the same product and started selling at 10 rupees. Why 10 rupees? Zero investment on the formula. Why 20 rupees? 10 crores investment on the formula. Now people, they didn't think about the developer of the formula. They think about the price of the product, and they will start buying 10 rupees product. Finally, this organization will shut down. So don't disclose confidential information. Next one, inform employer or client. Employer means when you select job career. Client means when you select practice career. In practice career, you will have clients. In job career, you will have employer. So inform employer or client about his interest, which such member, employer or client would reasonably expect to be informed. So whenever you come across some things, some frauds or some errors, immediately inform the client. And if he is having any relationship with the client, just disclose that relationship. So what are all the things a client or employer should be heard? Immediately communicate them when you face such kind of situations. Next one, don't bargain or don't acquire any fees other than remuneration from the employer. So without employer knowledge, without client knowledge, don't expect extra remuneration. If you want extra remuneration, first contact your employer or your client. See, there is no confusion at all, ma. I'm telling you clearly, if you choose practice career, the word client is appropriate. If you choose job career, employer is appropriate. Understood? See, as an employee, you are entering into contracts with supplier, and you are telling to the supplier, don't tell to my boss, I'll do one thing. So your price is 80, right? I'll make it as 85 rupees. So you'll get 5 rupees benefit, right? In that 2 rupees pay me commission. Is it ethical practice or unethical practice? Unethical practice. Take all reasonable steps in arranging any engagement as a consultant to establish a clear understanding of the scope and objectives. So understanding the scope and objectives of the work is very important. And before you start the work, make an estimation of the total cost of that assignment and communicate with your client. Conduct himself or herself towards other members with courtesy and good faith. Suppose you are a senior member of institute and a person recently qualified. He also a cost and management accountant. You are a senior cost and management accountant. Now you should create a friendly environment with your juniors also. So you should have some courtesy and good faith. Next one, not to accept any engagement to review the work for the same employer except with the knowledge of that member. Already a person A was appointed as a cost auditor to a company C Limited. Now C Limited approached you to conduct cost audit. Now before accepting that engagement, you should communicate with the existing cost auditor or retiring cost auditor. Sir, I was appointed, can I carry the work? Do you have any objection? Please raise your objections. So first communicate with the existing member or retired member, and then accept the engagement. Not to attempt to gain an advantage over other members by accepting a commission. Suppose that company C Limited is offering an assignment to the cost and management accountants. Okay, for this service, they are ready to pay 70,000 per month. 70,000 per month. Now you are offering something to the employee of C Limited. I'll give you 10% of fees. Please assign that work to me. Don't assign work to that person. Assign work to me. Every month I'll pay you 10% of my professional charges to you as a commission. So don't do that kind of practice. Not to maliciously or in any other manner which may adversely reflect on public or professional reputation or business of another member. Suppose you came across some frauds in the factory, frauds in the company. Now you should report them. If you are not reporting them, what happens at one day, at one point of time, they get revealed, and people will lose confidence on that company. People will lose reliabilityness on that company. Reliability. People will lose trust on that company. So it leads to the damage to the public only. So don't get involved into the matters which creates a damage to the professional reputation. At all times, maintain standards of competency. Undertake only such works if you are competent to perform. Suppose they are asking you to conduct a system audit, and you are having a zero knowledge with respect to systems. They are asking you to conduct a audit in a computerized environment. You are having a zero knowledge in that computerized environment. Now don't accept the task. That's it. So remember all these 13 points. Next one, primary norms of business ethics. Norms means standard practice, and these primary norms of business ethics may include personal responsibility, corporate responsibility, loyalty, respect, trustworthiness, fairness, community and environmental responsibility. As you all know, today a lot of stakeholders are interested in the business organization. Like, customers expect quality products at reasonable prices. Employees expect a timely payment of salaries. Investors expect good returns. Creditors expect a timely settlement of their dues. Government expect a timely payment of taxes. As a business entrepreneur, you have to take all the steps to protect, to safeguard the interest of all stakeholders. And it is possible only if business entrepreneur maintains business ethics. Personal responsibility. Each and every employee, whether working at executive level or entry level, is expected to show personal responsibility. This is possible by completing tasks which was assigned to the employee. Corporate responsibility. Business organizations have responsibilities to their employees, to their customers or clients, to their board of directors. Next one, loyalty. Today, business organization cannot survive without employees. At the same time, employees can't survive without business organizations. Understood? So, business organization and employees, they are mutually dependent on each other. So, both business organizations and their employees are expected to show loyalty. Employees should also be loyal to their co-workers, managers, and the company. Customer loyalty is very important to attract a business through a positive reputation, good reputation. Understood? Next one, respect. Respect is also an important business ethic, both in the way business treats its clients, its employees, and the way its employees treat each other. Next one, trustworthiness. So trustworthiness is possible only through honesty, transparency, and reliability. When you supply quality products to the customers, customers trust that business organization. When you make timely payment of salaries to the employees, employees trust organization. So employees should feel they can trust the business to the terms of their employment, to keep the terms of employment, and clients and customers should be able to trust the business with their money, with their data, personal data, contractual obligations, and confidential information. Next one, fairness. Every business organization should provide or should treat each and employees in a fair manner. So they should not provide fair treatment to one group of employees, and they should not be unfair with another group of employees. Understood? So each and every employee should get a fair treatment. Next, community and environmental responsibility. So you are carrying business operations in the society. You have to take all the active steps, active measures in order to reduce the waste and in order to protect the environment. So finally, promote a safe and healthy environment. Next one, internal code of ethics. A code of ethics in a business is a set of guiding principles intended to ensure business and its employees act with honesty and integrity in all areas, in all facets of its day-to-day operations, and to only engage in acts that promote a benefit to the society. So whatever employees are doing, so employees should do each and everything only for the benefit of organization. Organization should take steps for the benefit of society. According to CFAI website, members of CFA, Chartered Financial Analyst, including CFA, and the candidates for CFA designation must follow the code of ethics. So what are those code of ethics? First one, act with integrity. competence, diligence, respect, and in an ethical manner with public, your clients, your prospective clients, future clients, your employees, that means co-workers, or your subordinates, next colleagues in the investment profession, and with other participants in the global capital markets. As a CFA, you may be an employer or you may be employee, but you have to maintain, integrity, competence, diligence, respect, and you have to do the things in ethical manner with the public, with the clients, with the prospective clients, with your employer, with your employees, with your colleagues who are there in the investment profession, and with all the other participants in the global capital markets. Place the integrity of investment profession and interest of clients above their personal interest. Simply client interest over personal interest. You have to take steps for the benefit of your clients, not for your self benefits. Use reasonable care and exercise independent professional judgment when conducting investment analysis. Suppose you are having investment in one company and that company is not performing well, but in order to raise the investment value, you are encouraging, you are motivating all other global participants, all other investors to make investment in that company. When investments keep on growing, the value of company will grow. So like that, don't make any judgments, like that don't make any decisions. Practice and encourage others to practice professionally. So stop doing malpractices. Promote the integrity and viability of global capital markets for ultimate benefit of society. And next, maintain and improve their professional competence and strive to improve the competence of other investment professionals. So try to improve your competence skills. Yes, this is possible by attending seminars regularly, by reading the books and analyzing the markets on regular basis. Next one, business ethics is an art or science of maintaining harmonious relationship with the society and its various groups, employees, customers, creditors, suppliers. Next, as well as reorganizing for the right or wrong of business conduct. Now, every business organization should maintain business ethics. So while drafting these ethical principles, they have to keep these 6 points in their mind. So business organization must maintain business ethics, and the business ethics must have the following features. First one, code of conduct. So what is correct, what is incorrect? Yes, what to do, what not to do. Provide a code of conduct. Next, provide protection to the social group. So provide guidelines to protect employees, understood, to protect customers, to protect the suppliers. So social group means employees, customers. Next, provide basic framework. Need willing acceptance from all the employees. Next, education and guidance. Once your code of conduct is ready, so educate employees, provide guidance to the employees, and you communicate with your investors that following ethical practices, it is not against to the making profits. So here we will make profits, but ethically. So here we are not looking at short-term profits. Here we are looking at long-term profits. Like that, educate your investors. Understood? Next one, principles of business ethics. Every business organization must maintain business ethics, and those business ethics must have following principles. One is avoid exploitation of consumers, avoid unfair trade practices. Next, fair treatment to the employees. Let me give you one example. In many reels, in YouTube or Instagram, you might have gone through these reels. Supplier 1, supplier 2, two suppliers will be there. First supplier, he will sell goods at 100. Second supplier, actually 120. Now looking at supplier 1, he will reduce price to 80. What supplier 1 will do? He will also reduce price to 70 in order to get more customers. Now what supplier 2 will do? He will purchase all the things at 70 rupees. Now stock with S1 is 0. Stock with S2, yes, he is having a supplier 1 stock and he is also having his own stock. Now once the stock of supplier 1 is completed, now what supplier 2 will do? He will become a monopoly and he will fix the price like this, 200 rupees. So initially what he did, he exploited, fellow suppliers. He exploited fellow producers. And finally, he is exploiting consumers by fixing high prices. So consumer, in order to purchase that product, he is left with only one option, that is supplier 2. So definitely he will purchase the things at 200 rupees from supplier 2. So this is unfair trade practice. Understood? So avoid exploitation of consumers, avoid unfair trade practices, and provide fair treatment to the employees. If employee performs well, give him incentive. If employee is not working well, then punish him. That's it. No, you should not act in a biased manner. Understood? Next is 7 principles in business ethics. 7 principles in public life is different. 7 principles in business ethics is different. Understood? 7 principles in business ethics. You must be trustful, keep open-minded, meet obligations with employees, with customers, with suppliers, have clear documents. So whenever you enter into an agreement with supplier or employee or customer, have a clear documentation. Next, become community involved. So whenever you are making a decisions, so don't take decisions in isolated manner, involve community. So you must make actions, or you must implement actions for the benefit of community too. Maintain accounting control. So maintain accounts and be respectful. Next one, areas in business ethics. Areas in business ethics, we are having 3 areas. One is corporate social responsibility. So out of profits you earned, some portion of profits you should spend on society, for the development of society, upliftment of society. Next, fiduciary relationship to the stakeholders. So today, if you observe company type of organization, you had a concept called separate legal entity. Company is separated from its owners. Company is managed by board of directors. So investors, shareholders, on the trust of directors, they are making investments. Now maintain that confidentiality. Maintain that trust. Maintain that trust. So whatever trust is placed by the shareholders on the company, yes, the board of directors, board of directors should maintain that trust. So fiduciary responsibility means act of trust and confidence. Understood? Next, industrial espionage. Industrial espionage. So it means, appointing spies in our competitor companies. So identifying the biggest competitor, to know the trade secrets. What we are doing, we are sending our employees to work in that company in an illegal manner. So it is simply spy. So avoid these kind of things. So areas in business ethics, total 3 areas are there: corporate social responsibility, fiduciary responsibility to stakeholders, industrial espionage. So this is important from multiple choice question point of view. So identify the area which is not covered in the business ethics. Like that, they may ask you. So 3 correct options you can find: corporate social responsibility, fiduciary responsibility, industrial espionage. These 3 are covered in business ethics. So the other option which is not correct, you have to highlight it. You have to select it. Next, emerging issues in business ethics. The biggest problem, the biggest concern, having business ethics. First one, business is suffering and troubles by lack of proper directions and is struck on issues like logic, reasons, etc. If you take law, it is a set of codified norms. Whether you accept it or not, you have to follow it. Whether you are in favor to the law or whether you are against to the law, at the end you have to follow the law. You have to make payment of taxes. Understood? But coming to the ethics, these are not codified norms and these keep on changing. As you all know, society, environment is dynamic in nature. So ethics is also dynamic concept. So these keep on changes. So many business organizations suffer lack of proper directions. The issues like fairness, justice, honesty are the main issues that are posing complex dilemma to the businesses. So here the point is, a business organization should maintain a balance between profit objective and ethical objectives. See, he should not focus on ethical objective ignoring profits. He should not focus on profit objectives ignoring ethics. So he should maintain a balance, or else there creates a dilemma. A wrong or biased decision can have a profound impact on the goodwill of a company as well as its market position. Next, general business ethics. Ethics of human resource management. Now, while appointing, while selecting employees, while recruiting employees, while fixing the remuneration to the employees, you have to maintain ethics. Ethics of sales and marketing, ethics of production, ethics of intellectual property, knowledge and skills. So if you are the owner of intellectual property, right, if you are having the rights over intellectual properties, use those rights. Don't copy or don't infringe some other person's intellectual property rights. This is also ethics. Understood? So you are the developer of a formula. You use that formula. Suppose another fellow developed the formula. Now you are copying that formula. It is unethical practice. Next one, common unethical practices by executives of a corporate. First one, corruption. It may be financial or non-financial. Corruption, getting some illegal advantages. You should not do like that. Understood? Corruption means getting illegal or unwanted advantages. Next one, greed for profit or turnover. So for getting more and more profits, you are supplying cheap quality products at higher prices. So this should be eliminated. Next, accommodating a group, maybe employees, vendors, customers. This is like groupism. So you are selecting employees, you are selecting suppliers who are acting in favor of you, and you are providing benefits to them only, ignoring others. This is unethical practice. Leak of knowledge, leak of professionalism, external pressures, ego and dominance of top management, ignoring the right things. All these are common unethical practices. This can be asked for 7 marks. By writing these 7 points, you can score 7 marks. Understood? Next one, need for business ethics. Sir, why business organizations need business ethics? The first one is to stop business malpractice. I told you, right? Avoid unfair trade practices. If you promote them, so what happens? Customer gets exploited, so which is not at all good. So business malpractices are harmful to the consumers, and business ethics helps to stop business malpractices, like avoiding unfair trade practices. Next, improve customers confidence. Business ethics are needed to improve customers confidence about the quality, quantity and pricing of the products. When you provide best quality product, right quantity at a reasonable price, so it leads to customers confidence. If customer is confident on the organization, that organization can flourish in long run. Next, for the survival of the business, so business ethics are mandatory for survival of the business. Without business ethics, they can't run business in long run. Next one, for smooth functioning, so business entities follow all business ethics, then only the employees, shareholders, consumers, dealers and suppliers will be happy. So they will provide or they will give full cooperation to the business entities. Next one, safeguard customers' rights, consumers' rights. So consumers are having many rights, like right to health, right to be heard, right to safety, right to be informed, right to choose, right to redress. So business ethics help business organizations to safeguard consumer rights. Consumer satisfaction. So ultimately, a business organization can survive only if it meets the needs of the consumers. Understood? So first, identify the needs of consumers and produce the goods, sell the goods accordingly. So consumers will be satisfied only if business follow all the business ethics and hence are highly needed. Next, develop good relations. Business ethics are important to develop good and friendly relations between business and society. Understood? So only ethical business organizations gets confidence. It creates confidence among employees, among customers. So it creates a good relationship with these stakeholders. Healthy competition. By avoiding unfair trade practices, it creates a healthy competition. It brings efficiency, producing goods at a low cost, optimum utilization of resources. So you can increase production with a given cost, or at the given level of output, you can reduce your cost. It's all about efficiency. Hence, it is always welcome. Next, importance of labor. So business must give proper wages, salaries to them and provide them a better working conditions. So this is all about need of business ethics in a business organization. Next one, importance of business ethics. See, all these topics looks like same. The need of business ethics, importance of business ethics, advantages of business ethics. At the end, all these three concepts will give you same conclusion. Same conclusion. So in my point of view, they are not different. But in examination, from examination point of view, if they ask you importance of business ethics, you have to write these points. If they ask you need of business ethics, you have to write these 8 or 9 points. Understood? So that's what I told you at the beginning. The biggest disadvantage with this chapter is identifying the questions. Understood? So importance of business ethics. Public expects business to exhibit high level of ethical performance, social responsibility. Encouraging business firms and their employees to behave ethically is to prevent harm to this society. First, public expectation. Next, you can prevent harm to this society by adopting ethical practices in the business. Next, promoting ethical behavior in order to protect business from abuse by unethical employees, unethical competitors. When you are ethical, customers will support your organizations, so your organization will be safe. You can survive even in the hectic competition, even in the competition in the market. High ethical performance also protects individuals who work in businesses, and it improves consumer confidence. Next one, business organization become conscious of social responsibilities. So today, having business ethics, so they will take care of environment. They will try to they will initiate actions to protect environment, and they will try to improve the public livelihood. Next, create good image of business. That means goodwill only. Next, it increases profitability. When you are able to retain more number of customers in the long run, obviously your turnover will increase, your profits will also increase. Even you can survive in the heated competition. And safety from legal perspectives. When you are ethical, when you are following all the rules and regulations, all the applicable laws, you can escape from punishments. You will not be punished. Understood? Next, advantages of business ethics. It creates competitive advantage. And even in heated competition, your company can survive, your organization can survive in long run. Goodwill of the firm improves or hikes depending on its response towards its ethical issues. Next one, productivity through rigid, firm and sincere workers as well as other business chain members. Productivity gets enhanced, goodwill will, good reputation will increase, productivity will increase. Through increasing morale and trust, business can increase their market share. So when your employees are working hard and when you are having a positive image in the society, definitely you can retain existing customers, you can attract prospective customers, thereby you can increase your market share. This is an advantage. Publicity. Yes, publicity because of well and ethical performance. Acceptance of products of the company by the public. So once customer place confidence on your products, yes, your products will be sold very quickly. Overall growth of the society. When you are growing, definitely society will grow. How? When you grow, you'll get more profits, you can pay bonus to the employees, and you can you can conduct some corporate social responsibility activities. So it leads to overall growth of the society, makes change management very easy, and value integration with quality and strategy. So these are the advantages if you adopt business ethics. Next one, a recognition of ethical issues in businesses, identifying ethical problems. Having code of conduct, having basic framework, educating employees. Okay, to some extent they will work, but beyond the extent, sometimes even if company is maintaining ethical values, ethical principles, it may lack in some areas. So it is very important to identify those concerns. So first, learn to recognize ethical issues in the most is the most important step in understanding business ethics, where we are lacking. So are we rendering services in a timely manner to our customers? Are we satisfying our employees? Are we making payments to the suppliers? So where we are lacking, first identify the area. An ethical issue is an identifiable problem, situation or opportunity that requires person to choose among several actions that may be evaluated as right or wrong, ethical or unethical. And business, such a choice often involves weighing monetary profit against what a person considers appropriate conduct. Sometimes we must look at the areas, we should not place importance on the profit. We must look at the areas where ethics, where we are lacking ethical principles. The best way to judge the ethics of a decision is to look at the situation from others' point of view. Now, sitting in a business entrepreneur's position, you may think about profits, you may think about continuous growth, but you just change your position to customer, or you just think about your competitor. So how they are thinking, what they need. So based on that analysis, make appropriate decisions. Many business issues may seem straightforward and easy to resolve, but in reality, In reality, a person often needs several years of experience in business to understand what is acceptable or ethical. So initially when you start business, yes, it looks like very easy to follow all these ethical principles, but in reality it is very difficult to implement them. Over a period of time, over several years of experience, you can solve some unethical issues, you can resolve some unethical issues, and you can promote ethics. Ethics are also related to the culture in which a business operates. So in which state, in which region you are operating, so that region, that society norms, the cultural practices will also play a crucial role in deciding the ethical principles. Next one, improving ethical behavior in business. Improving ethical behavior, see, it is possible, it is influenced by three important factors. What are they? Employee moral standards, each and every individual moral standards, influence of managers and co-workers, and opportunity to engage in misconduct. So first, identify the moral standards of each and every employee. Based on that, you you design a framework, you design a code of conduct, try to protect the interest of employees, and the influence of managers and co-workers. And last one, opportunity to engage in misconduct. If you are unethical, if you are not making a payment of salaries in a timely manner, now employees, what they will do, they will try to sell or they will try to destroy organization properties. Understood? So they will try to take some valuable properties, they will sell and they will survive, but this leads to a disadvantage to the organization, which should be eliminated. So when you are ethical, definitely opportunity to engage in misconduct can be eliminated. It is very difficult for employees to determine what conduct is acceptable within a company if the firm doesn't have ethical policies and standards. So first, frame ethical policies and standards. What is right conduct, what is bad conduct, what to do, what not to do. Educate employees. Professional code of ethics are formalized rules and standards that describe what a company expects of its employees. Next, code of ethics, policies on ethics, ethical training programs, ethics training programs advance, that means improve ethical behavior, because they prescribe which activities are acceptable and which activities are not acceptable. Next one, so yes, punishment for violation of the rules and standards. So have this in your basic framework. Next, the enforcement of such codes and policies through rewards and punishments increases the acceptance of ethics standards. So if employee is implementing ethical practices, ethical principles while doing his job, yes, pay him some reward. And if an employee was found having following some unethical practices, punish him. So this will also increases the acceptance of ethical standards by employees. So in this manner, you can improve ethical behavior in the business organization. And coming to the last topic of business ethics, it is emotional intelligence. Definitely, I expect 7 marks question from this topic. It's just 1.5 page or 1 page topic. Damn sure I expect 7 marks from this topic, emotional intelligence. The emotional intelligence is also known as emotional quotient or EQ. So first of all, what is emotional intelligence? It is the ability to understand, use, manage your own emotions in positive ways in order to relieve stress, communicate effectively, empathize with others, overcome challenges, and diffuse conflict. Suppose if you are in happy mood, obviously everything looks positive only, and you are very comfortable in that situation, you feel very comfortable in that situation. But think about sadness. Suppose you fixed some goals and you are unable to fulfill those goals, you fail to achieve those goals. So definitely it's a sad moment. Now in that sad moment, how you are able to understand the situations, how you are able to use your emotions, how you are going to manage your emotions in order to come out of that bad phase or sad phase. Understood? So emotional intelligence helps you build stronger relationships, succeed at school and work, achieve your career and personal goals. Sometimes what happens, in your work, in your office, actually your capacity is you can handle only 6 works in a day. You can handle 6 works in a day, but one day your boss called you and he assigned you some 10 works. So definitely it is beyond your capacity. Of course it is beyond your capacity. So emotionally you feel very bad. See, I'm doing all the works properly, so I can do only 6 works. How he can assign 10 works to me? It is not possible. So first of all, don't overthink. Don't overthink. So think about the available resources and think about your targets. Try to convert those things into your actions. Okay, it's okay, fine, okay, you can't do 10 things, but first start the work. At the end of the day, it's okay even if you complete 8 works or if you complete 9 works. So convince your boss, okay sir, I did only 8 works today, balance 2 works I'll do it the very next day. So it's all about managing your emotions when you are in a sad phase or bad phase. It can also help you to connect with your feelings, turn intention into actions, and make informed decisions about what matters most to you. Next one, emotional intelligence is commonly defined by 4 attributes. 4 attributes. One is self-management. It's your ability in managing your own emotions in healthy ways. Take initiative, follow through on commitments, and adapt to changing circumstances. Next one, self-awareness. It is your ability in identifying your emotions, your thoughts, your behavior. So management means ability to manage. Awareness means ability to recognize. That means identify your weakness, your strengths, and have self-confidence. Next, to social awareness. It's your ability to understand the emotions, needs, concerns of other people and pick up emotional cues, feel comfortable socially. So what society is expecting. So if you are emotionally, if you are very much emotional and if you are unable to read the society needs, social needs, definitely you may end up with some bad kind of some bad behavior like that, or you may not lead a good standard, you may not have a good standard of living. Understood? Next, relationship management. You know how to develop and maintain good relationships. So relationship management is all about ability to maintain good relations with colleagues, with employees, with employers, with customers, with clients. That is understood. So what are the 4 attributes of emotional intelligence? Self management, ability to manage your feelings, emotions. Self awareness, ability to recognize your strengths, weakness. Social awareness, ability to understand the needs of the society and needs your needs in the society. Next, relationship management, ability to develop and maintain good relationship with neighbors, with employees, employers, customers, and clients. Next one, effects of emotional intelligence. See, you have to maintain emotional intelligence all times, or else what happens, without emotional intelligence, if you are unable to control your emotions, if you are unable to manage your emotions, you cannot achieve success in long run. You cannot achieve success in your career. So in order to achieve success in your career, so you must maintain emotional intelligence. So performance at school or work. High emotional intelligence can help you navigate social complexities of the workplace, lead, motivate others, and excel in your career. And if you lack emotional intelligence, what happens? It will affect your mental health. It will affect your physical health. Uncontrolled emotions create stress. It will have impact on your mental health, making you vulnerable to the anxiety and depression. If you are unable to understand the situations and get comfortable with the situation, or if you are unable to manage your emotions, definitely you will struggle to form strong relationships. This is applicable not only in the business, it is not only applicable to the business people, it is also applicable to everyone, right? You take a kid in a school, school child to business entrepreneur, each and everyone must have emotional intelligence. Physical health, if you are unable to manage your emotions, you are probably not managing your stress either. This can lead to serious health problems. Uncontrolled emotions leads to uncontrolled stress. It leads to blood pressure, suppress the immune system, increases the risk of heart attacks. That means finally your physical health is going to get damaged. Next one, relationships. I told you, emotional intelligence helps you to maintain good relationship with your fellow employees, colleagues. Next one, employers, neighbors, customers, clients. So if you lack emotional intelligence, you will lack a good relationships. By understanding your emotions and how to control them, you are better able to express how you feel, how you understand. This allows you to communicate more effectively and forge stronger relationships both at work and in your personal life. So, with this, the revision of business ethics is completed. The total 15 marks is in your hands.